Why should people do that? $5 million, great life in India.
Yeah. I was thinking that exactly, right?
But guys, such a great end to the weekend coming up per se, right? Because what happened in cricket yesterday was great. Mahakumbh after 45 days has ended, plus all the global news flow.
The underdog triumph.
Underdog triumph. So great stuff.
Always bet on the underdog.
Okay, well, the Indian market is kind of feeling like the underdog right now, let's be honest, which is why I'm going to pull up the implied open before I get to the global setup and a little bit of a detailed global setup because so much happening right now. Well, there you have it. Be happy to see green completely flat. And that is how the Indian markets have been behaving, better than being deep down in the red. Mixed day of trade as far as US markets are concerned. The Dow closed in the red, but the S&P 500 broke that 4-day losing streak as well. It was all about NVIDIA post-market hours. NVIDIA has beaten expectations in its fourth quarter. Revenue up 78% for the quarter, 114% year on year. The guidance is also pretty robust. But yes, the impact of DeepSeek is something that will keep plaguing NVIDIA. And the post-market stock movement was also quite below par. Key economic data will be in focus. Remember, the big talk as far as US markets is concerned are those very worrying consumer sentiment indicators which have come in. But this week, on Thursday, you have weekly jobless claims, which will be out. On Friday, the PCE data, which is a very key inflation indicator, will be out, so that becomes important. I think what's happening with bonds is also worth a mention. Treasury yields have slipped as of course, concerns about economic growth. The 10-year is at 4.26%, but bonds are now showing an inverted yield curve pattern. And that's important because that is seen as an indicator of recession. It's not a guarantee, but it's an indicator. So what is happening? The 10-year yield is below the 3-month yield. And that is what a lot of economists, the Fed sometimes, will be seeing as an indicator of recession. So watch out for the impact of the inverted yield curve. Having said that, this happened in 2022 and no recession has hit the US since then. So it's not completely fail-safe. Crude prices, meanwhile, are trending lower as traders are anticipating peace deal between Ukraine and Russia. The Brent is at the $72 mark. Asian markets open in the green. Japan's GDP data has come in better than expectations at 2.8% in quarter 4. So that is good. Very quickly on what's happening with President Trump. He's on a Trump tracker. He's reiterated tariff hike plan in his first cabinet meeting and said duties against Canada and Mexico will take place. He's also talked about 25% tariff on EU. And of course, the golden card everyone's now talking about. I think it's interesting. We should do a poll whether the golden card is actually going to be something that people like or not. But let's listen into that soundbite very quickly.
We're going to be selling a gold card. You have a green card. This is a gold card. We're going to be putting a price on that card of about $5 million, and that's going to give you green card privileges plus. It's going to be a route to citizenship, and wealthy people will be coming into our country by buying this card. They'll be wealthy, and they'll be successful, and they'll be spending a lot of money and paying a lot of taxes and employing a lot of people. And we think it's going to be extremely successful.
Okay, all right. So we're going to obviously be speaking to Richard Harris in just a short while, but then we should be setting the context before that conversation. Tamanna, two of the points that you raised, I thought were the most critical conversations this morning. And one has to do with the fall in the 10-year yield, and the other, of course, has to do with the dollar. Watch out for both of those. Neeraj, what do you think about that? Because if you're talking about...
Richard Harris can't hear you.
Yeah, he can't. Unfortunately.
But I can.
Yeah.
So you can ask me.
So while we get that frame sorted, and while we get Richard Harris on the... Okay, fine. I'm told that we finally have Dr. Richard Harris joining us this morning, Chief Executive at Port Shelter. Dr. Harris, thanks so much for joining us this morning. We were discussing the various updates overnight and the fact that once again Donald Trump has made headlines. There's uncertainty about the whole tariff conversation, but in the last week you've seen the 10-year bond yield move from over 4.5% to below 4.3%. What are the implications? Why is that happening, and how do you look at emerging markets in that context?
Well, I think the markets are moving all over the place because everything's uncertain. You know, most of Trump's policies now are being made on the steps of Air Force One. He seems to be speaking on the hoof. It seems ironic that he would try and encourage people to come to the States for a relatively small sum of 5 million US when he's trying to close the border.
Good evening to you. Let's piece this. There is, after a really long time of US exceptionalism, we are starting to see the first signs of maybe, just maybe, some bit of slowdown. And parallelly at the same time, China is doing multiple moves to up its economic growth, give comfort, what have you. Is this the first sign of the dollar at the margin thinking of moving to the EMs after moving back to the US for the last 3-4 months at the very least?
Well, I've been calling this the great pivot. You know, we are in a situation where China is starting to recover. There's been an enormous amount of reflation going on. The government clearly has a real desire to get the economy moving. And I think eventually all of that stimulus is going to end up in the stock market. Whereas you've got the US where things are very uncertain, where the consumer's now not so sure what's happening, where you've got threats of higher inflation, threats of tariffs, threats of immigration controls. All of these things, I think, are quite bad for the US. And as a result, we've situation where very expensive US is likely to yield to much cheaper parts of the world as international investors start to look in that direction. I think China will be the main beneficiary. But at the moment, I think as long as markets don't collapse overall, I think EMs will do quite well. And that should be positive for the Indian market too.
Dr. Harris, hi, Tamanna here as well, and great to have you on the show as always. Just trying to get your sense of the impact we could see of tariffs playing out, and what now President Trump is saying on tariffs on European Union. How do you see that playing out, even as he's pretty clear that he is going ahead with tariffs on Mexico and Canada?
Well, I think the whole thing with tariffs, I think the biggest issue that's coming out now is not whether you put 10% or 30% or something on certain goods. The big thing is that it's really damaging the respect that America has had in the rest of the world. You know, America is now not trustworthy. There's a lack of credibility. Where are they going to go next? And yes, you can say that perhaps Europe took America for granted, certainly in terms of the nuclear umbrella. It's gone on for 70, 80 years now, and it probably had gone on too long, and the Europeans have managed to reduce their defense spending to extremely low levels at the expense of the American nuclear umbrella. You can argue that, and that's certainly true, but you can't destroy the trust and credibility that's built up over the last 80 years and expect to have a positive outcome out of that. So I think the tariffs, while they are important, the key thing is that America's credibility has now been damaged. Nobody knows now what's coming down the pipeline.
Dr. Harris, thanks so much for joining us this morning. A very interesting perspective for us ahead of the start of trade today. All right, let's also lay the context by talking about what happened day before yesterday. And we've got a little bit of catching up to do with the global markets, but let's talk about what foreign institutions did and in fact what the flows were. You had selling once again to the extent of over 3,500 crore rupees, and domestic institutions bought about 3,000 crore rupees worth of equity. You had a pretty narrow range for the benchmark Nifty 50, and it ended more or less unchanged at over 22,500. It was a 110-point range, and you ended off the high point of the day. The breadth was favoring declines, and you had 31 stocks in the Nifty 50 that declined. Broader markets ended lower, falling about 1% or so from the day's highs. The mid-cap index and the small-cap index ending lower by about 0.5% or so. Metal stocks fell on the back of trade tensions, and they will be in focus today as well. Neeraj will tell you about that in just a bit. Realty, PSU banks, oil and gas all lost more than 1%, and auto, led by M&M, gained, but the gains were capped for the index as a whole. The number of stocks that saw selling, there were a list of stocks that saw selling on the back of an exclusion from F&O. There are 16 stocks that will not be carried forward in the next contract. And some of those saw very heavy selling. The likes of Dr. Lal Path Labs, you've got Canfin Homes, Atul Limited, Naveen Fluorine, Ipca Lab. We're thinking that this is the reason why they saw that very heavy selling. For example, Dr. Lal ending with cuts of over 7%, Neeraj.
Yeah, I mean, and interesting moves per se, for sure. The question though today is that are there cues which are setting us up for positivity? So the cooling dollar, and then the dollar index has cooled off quite substantially from those 110 odd levels to maybe 106, 106.5. Rising China flows, could it mark positive sentiment for EMs? I think that's the question. And there are so many global experts who had said that what is China's problem back then in 2024 is not just necessarily China's problem. EMs are viewed as a basket, and therefore it could actually hurt everybody. But be that as it may, this is good for EMs per se. I think more importantly, the risk from an India perspective, we've seen so many moves happen. The budget move by the government, RBI doing liquidity, then CRR cuts, then doing the rate cut, then doing one more measure on liquidity last week, and now the risk weightage reduction, which could help banks and NBFCs lend more aggressively in the retail segment. I think it's a big positive. It's a big macro positive, aside of the fact that it's a positive for banks and NBFCs, and we'll talk about that a bit. But I think from a bank Nifty perspective, I think it's a very large positive. For a consumption perspective, it's not a bad move either. So one more step by the Reserve Bank of India, which has been on a bit of a roll, I must say, in trying to support the economy. So full marks there. And metals, and we'll talk about that later on, but metals, it may be a trading play at best right now in people's minds. But you look at every metal company saying that at the current steel prices, Tata Steel is on record saying that current steel prices, it's difficult to set up new capacities as well. So the replacement cost argument is looking very attractive. The only thing, viewers, not the only thing really, but just keep in mind, we've been talking about various records being broken by the current downtrend. One more in threat today would be the November series ending in a red, and this would be 5 straight FNO series, which ending in the
negatively.
red. Yeah, and negatively, which last happened 28 years ago. So many moves out there to show that, okay, काफी selling हो चुका है. Does it mean it will reverse? Who knows?
You know, I love this, that, you know, you're the eternal optimist, Neeraj, and we speak about this week after week. Unfortunately, last few weeks, the next one has been worse, but things are cooling off. I think some of the luster about America after Trump, and because of the economy, is also cooling off. And remember, what you're seeing in India is an impact of all roads lead to the USA. As people are realizing what is playing out there, economic data is looking a bit dodgy. Maybe there will be a reset that we can hope for. All right, let's talk about stocks and some news that we need to cover that could impact markets and specific stocks today. I'm going to start with Ultratech Cement. So, of course, the big news is that they're going to enter the cable and wire industry. So, another foray and another diversification from the group. 1,800 crore capex is what is penciled in. The company will be setting up a plant in Gujarat by December 2026. And the rationale for this is to expand Ultratech's presence in the construction value chain. Now, if you look at what the group is doing, after paints and jewelry, the group is now diversifying into cables and wires. A few questions here, there, and this is why I've given it a neutral. While, you know, diversification on the face of it always sounds interesting. Does Ultratech share anything in common with the wire and cable industry? Is there a very clear synergy? Well, not really, because there's a negligible synergy in raw material sourcing, distribution, or transportation. Even the factors that influence both businesses are fairly different. In cables and wires, it's electricians, while in cement, it's contractors. And neither cement dealers sell wires and cables. So where are they going to find that overlap is something we'll have to see. Let's take a look at what analysts are saying, and there are quite a few views out there this morning. One of the views is that investments into a non-cement business is likely to raise concerns over capital allocation. JM Financial says it could raise investor concerns due to investment in an unrelated line of business, that's Axis Capital. The foray into wires and cables could hurt positioning as a pure cement play. That's what Citi is saying. And of course, Jefferies also say that question of capital allocation may emerge as investors may ask, what next after this? So watch out for Ultratech. We'll discuss in more detail all of the aspects and pros and cons. And of course, Neeraj will talk about the other players in the space, because that's what we saw with paints, right? what happens to the existing players. But there's so much to unpack, and financials is going to be in focus. NBFC is in focus. Clear thumbs up there, because the RBI has eased risk weightage for bank loans to NBFCs. Bank loans to NBFCs will be restored to levels before November 2023 circular. Remember, in November 2023, risk weights on bank loans to NBFCs were raised to 125% from 100%. So what does this mean? Very simply, it was becoming more difficult or expensive for banks to finance non-banking financial institutions. But the new circular comes into effect from April 1st. So they've eased off this. RBI has also clarified that microfinance loans by banks will be exempt from high risk weights. Net, this is a bit of a reversal of the RBI stand, or I would say loosening the grasp a bit on microfinance loans on lenders who were lending to people with more credit risk. So home loans, education loans, vehicle loans, and gold loans. So microfinance loans by banks will now attract 100% risk weight instead of 125%. The stocks to watch, I would say, would be a Bandhan, for example. Several of those NBFC players who have been under pressure because the RBI is tightening the reins. Maybe under the new governor, Sanjay Malhotra, a bit of easing up has happened. And possibly all of these NBFCs have also come back on track. I just wanted to put out for you what CLSA is saying on financials. And I like this line because their note has this line. It says, "Dene wala jab bhi deta hai, to chappad phad ke deta hai." I thought that's an interesting way that CLSA found to describe it. The situation of the Indian banking sector with respect to the regulator is somewhat reminiscent of this phrase, says CLSA. After a lot of regulatory lightening in 23 and 24, there's been a change in the stance of the RBI, and now the RBI has reduced risk weights on microfinance, on banks to NBFCs. I would say look out for the entire pack. The biggest beneficiary, as per CLSA, of this is Bandhan Bank. So that in focus, we should pull up that stock as well. Very quickly, third one, Bharti Airtel. Thumbs up there. They have now confirmed that they are in discussions with that group for the merger of the DTH businesses. These discussions aim to explore a potential combination of Tata Play and Bharti Telemedia, structured to be mutually agreeable. DTH is, of course, direct-to-home business under Tata Play, and Bharti Telemedia is a subsidiary of Airtel. Morgan Stanley has a view. They've maintained equal weight with a target price of 1,650, and they say in bilateral this conversation has binary outcomes and could swing in either direction. It would imply consolidation and will strengthen Bharti's industry positioning. Consolidation of a four-player market that has been seeing subscriber losses for the last several years is a positive and will strengthen Bharti Airtel's playbook of bundling multiple services and increasing stickiness of customers. Having said that, it's a small part of the overall business. So the EBITDA and SOTP contribution and revenue contribution is not too big. But I think it's interesting that there is consolidation in this business, which it sort of is a in-between kind of a technological move, right? Everyone went from cable maybe directly to OTT and direct internet lines, and your Tata Play kind of services got stuck in the middle.
Yeah,
DTH.
Yeah, most certainly. So interesting times for a lot of businesses and a lot of pivots happening in this space, as we are seeing in our business too.
Yeah, in terms of distribution, where's the consumption happening? And we're seeing that very clearly.
So it doesn't matter. Watch us wherever you want. We're all here.
It's available across the board. That's the moot point. Let's talk about the stocks that I've chosen, and I'll start with a thumbs up first. Dr. Reddy's Laboratories, in the context of you could say, I don't know about increased scrutiny, but you've been hearing a lot of reports and notifications sent to the exchanges by pharmaceutical companies of observations by US FDA post-inspections. And in fact, they have conducted, the US FDA, an inspection at the company's API or active pharmaceutical ingredient facility in Bolaram, Hyderabad. And the company has gotten an establishment inspection report where the FDA has classified the inspection as voluntary action indicated. And what that means for the facility is that it can correct any deficiencies that have been found voluntarily. The FDA has not felt the need to intervene itself and place regulations or stop production or any of the other negative things that could have emerged post an inspection. And this is certainly going to be a positive. In the context of what you saw on Tuesday in particular, where the stock was down over 3%, you could see an immediate reaction to this development. SpiceJet. Now, a lot of you will look at this and the return to profitability with a net profit of 25 crore thereabouts in the third quarter and say that this is a positive. But if you look under the hood, it is not, because the return to profit was an account of a rise in other income. I know that the arguments will be made that if you adjust for that, then the losses will have narrowed versus the comparable quarter, but it doesn't go away that you have other income that stood at 419.6 crore rupees, and that large part of that other income has come from restructuring of lease obligations with lessors. What is more important, in my opinion, is if you go to the P&L statement and you look at what the auditor, which is Walker Chandiok and Co. LLP, is saying, the company's accumulated losses amount to about 8,083 crore rupees, and the current liabilities have exceeded the current assets by 3,818 crore rupees. These conditions, together with other matters, indicate the existence of material uncertainties that may cast significant doubt about the company's ability to continue as a going concern. Now, when the auditor gets up and says, I know that this is not the first time, but they have reiterated this despite the company getting back into the black. What else are they saying? Based on the management's assessment of future business projections and other mitigating factors, as described in the said note, which is dependent on improvement in operations of the group, settlement with vendors, and additional fund raises, the management is of the view that the going concern basis of accounting is appropriate for preparation of the accompanying statement. So it is, in a lot of long words, essentially saying that the auditor feels that it should be, or there is a case for it to be removed as a going concern, no longer a going concern, but the management has made the case for a going concern. So it is a thumbs down, in my opinion. Watch out for an immediate reaction on the street though. Utkarsh Small Finance Bank is a neutral. The board has approved a raising of 750 crore rupees through equity, and this could be through any multiple means. No purpose of the fundraise was announced, but the company had a capital adequacy of 21% as of the 31st of December. It was down from 22.4% on account of a weak operational quarter. In fact, the bank had reported a net loss of 168 crore rupees in that December quarter. So one to watch out for in trade today.
Okay, very quickly, the stocks on my mind. Tamanna spoke about Ultratech's move. Now, the impact of that, if at all. So, Polycab, KEA Industries, RR Kabel. Now, I've given it a thumbs down simply because of one reason. One is the Ultratech foray, but the question that I ask is, can Ultratech's entry into the sector mark further fragmentation and lead to a valuation derating? I think that is the key question that people work with. What happened to paints? It hasn't dislodged Asian Paints at all, but it has brought down the prices, and therefore there's a bit of a valuation derating. However, brokerages are constructive, I must say. So while I believe it's a thumbs down, the thumbs up comes in from Nuvama, for example. They say that it is likely to sustain, the sector is likely to sustain a strong 13% CAGR. Entry of Ultratech may only have a modest impact at best in FY28 or onwards, and because of the fragmented nature of the industry, etc., etc. So that is one. And for example, on a specific stock, Jefferies has a note on KEI. They say that 55% of KEI sales consist of power transmission, industrial cables and exports, which require 2 or 4 years for pre-qualification. So Ultratech is some time away from getting that as well. And the 7 to 8% net profit margin should limit new competition's pricing discount scope. So bear that in mind. So maybe, just maybe, not as bad news, but I do believe that today you will see a bit of an immediate reaction on Polycab, KEI, RR Kabel. Then the street will think of it. Very quickly, before we get the next guest on, Nuvama Wealth is the second stock on my radar. It's a thumbs down because Blackstone-backed PAG mulls sale of the 1.2 billion stake in Nuama. Now, this may not necessarily bring the stock down to its knees, but I think it caps upsides because if there's a large supply is going to come in the next few days, the street will be wary of giving it large upside. So bear that in mind. In the third set of stocks, and that is on which we have the next guest as well, are the metal names. China is going to inject at least, apparently, going to inject at least $55 billion worth of fresh capital into several big banks. Now, this is important because one more move in the set of moves that China is doing to revitalize its economy, and usually that augurs well for metal names. And in fact, on that particular piece, let's get in an understanding of whether Indian steel companies per se and metal names by and large will essentially have a positive move as a result of this or no. Let's get in our guest, Aditya Velekar. He's Senior Analyst of Metals at Axis Securities. Aditya, good having you. Thanks so much for taking the time out. We've seen metal names globally show a bit of a reaction to this move yesterday. How important would it be for some of the Indian metal companies, particularly in the steel sector?
Yeah, good morning. So I think this is a continuation of their September announcement when they declared a stimulus last year, that they have hinted in the September announcement that they will be going for recapitalization of the banks. So that is their continuous drive to stabilize their banking sector, and which serves as a financial bulwark for the entire Chinese economy. Then there is a need to lend to troubled borrowers, especially in the real estate sector, where there are a lot of bad loans. So this move, in turns, the connection with the metal sector is that the stabilization of the real estate sector is quite critical, and with the recapitalization of the banks, it gives more financial bulwark for the banks to lend to these troubled borrowers, especially in the real estate sector. So that is one supportive area where the steel prices and metal prices will find some support. Although the immediate reaction will need to be monitored with the real numbers, especially with respect to pricing of real estate, which will be translating into prices of steel and other base metals. So it requires continuous monitoring. Also, one point which I want to highlight is that on 5th of March, they will be going for their policy meeting where they will decide their fiscal policies and monetary policies.
Okay.
Two-session plenary meeting. So that is one area we will be keenly watching out.
Yeah, most certainly. But I'm just trying to understand the fact that there is some bit of an uptick that we've seen in metal names globally. Could there be would you view any kind of uptick today as a sentiment reaction and a trading play at best? Or are you constructive on the Indian steel companies, and what China has done only adds to the thesis, if you will?
In the Indian context, I will say that the valuations have become more palatable now, and the stocks are positioned in such a way that any the positive news coming from China or rest of the world will provide positive sentiments to the Indian metal and steel stocks. So that is a position. So this news, although not very significant needle mover, but it is a positive news for the entire commodity space in general. However, at the same time, we have to look at the dollar movement, the rhetoric of Trump regarding the Trump tariffs and all. So there are a lot of news flow which are happening simultaneously with respect to trade barriers and all. So that is also putting some amount of question mark on the demand, long-term to medium-term demand visibility of these metals and steel names. So it is slightly difficult to take a call, but as I said, the valuations are slightly bottomed out, so that will act as a support. And overall, if these positive news, especially coming from China with respect to stabilizing their economy, and if they set up a good GDP target of, say, around once again at 5% and raise their fiscal deficit to 3.5%, that will act as a trigger for these metal companies to outperform as our benchmark indices.
And Aditya,
So that is
anything that you're positive on? If I were to ask you for your top pick in this space, what would it be?
We are positive on aluminium names, so both Hindalco, Nalco, also on Vedanta.
Okay.
Vedanta has a good trigger with respect to a special situation of demerger, and Vedanta Aluminium will act as we could see some value unlocking with respect to Vedanta Aluminium, as aluminium prices are still strong. So aluminium is our preferred bet in our metal pack. In the steel, we prefer names like JSPL, Tata Steel, and JSW Steel. SAIL, we are not very constructive because of the inefficient operations and expansion plan which it executed historically. Then we also like metal plays which are basically converters like APL Apollo Tubes, which is based slightly on the domestic demand, and if that picks up, these metal tubes companies could find support.
So aluminum is favored, Hindalco, Nalco, Vedanta to look out for, and some of those steel names there. Thank you so much, Aditya. We'll take a very short break. On the other side, we bring you top trading strategies and so much more news to cover, stocks that are going to be in focus. Stay tuned for all of that and more.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of the...
Welcome back. This is India Market Open. We're taking a look at the futures and options space right now. Let's see how things could potentially pan out. Well, this Thursday, of course, it's also the weekly options expiry. But, in terms of that, if we could have the rates on the screen for futures, yeah. So as far as the rollovers are concerned, that stands at around 59%. And of course, along with the weeklies, we also have the monthlies. And we haven't seen too much going on except for consolidation around the 22,500 mark. We are starting to see a little bit of a pickup in March open interest. Moving on, let's also take a look at the Bank Nifty futures. And that's once again is showing you about 56% increase rollovers. Again, if this number does close in somewhere near 75%, it will look like it's going to be rollovers very strongly towards the short side, considering it's not been a very encouraging month at this point in time either. Let's move on and talk about a handful of other factors. So we do have a lot of calls being written between 22,700 and 23,000. Today, of course, we will continue to see more traction around 22,500 and 22,600 in terms of the Nifty, given that it is expiry, but you cannot rule out a relatively, I would say, a volatile one, especially because we are looking at the 5th straight month of weakness and subdued cues as far as markets are concerned. At some point in time, you start seeing a little bit of movement towards a direction. But since it is the last trading day of this particular week, so this particular month, we're going to talk about those stocks which saw unwinding, and naturally we saw something like Godrej Consumers in focus, but besides that, not too much to talk about. All in all, I reckon that today will be yet another day where we are going to expect a little bit more volatility to come through. As I mentioned, especially given we've seen it's been the 5th straight month of subdued cues coming in.
100%. Thanks so much for getting us those details, Agam, and certainly brace for volatility at the end of this series. Let's talk about a pack that could be in focus today, and we've already addressed it to a certain extent, but let's talk about the details of what the RBI did, the Reserve Bank of India, and the changes that it has announced, rolling back changes that it had made in November of 2023 to increase the risk weights on bank loans to NBFCs. We've got Subhana joining in to tell you about the context, of course, and the implication. Who gets the biggest benefit? Subhana, that's the question that I want you to answer today.
Hi Alex, good morning.
Morning.
So yes, NBFCs and banks, will benefit the most from this move. Now there are two things to this. Now the first measure, what the RBI has done is that they have lowered the risk weights, where they have rolled back, to November 2023 circular, where they have lowered the risk weights from 125% to 100%. Now bank lending to NBFCs had increased. So what the RBI was nudging so far that NBFCs should diversify their borrowing. So in that regard, bank lending to NBFCs was increasing, so they had increased the risk weights. Now that they have lowered the risk weights, a lot of lower rated NBFCs or non-deposit taking NBFCs could benefit from this, because access to capital will be cheaper for them. So FY26, we can see that borrowings for NBFCs could become slightly cheaper. Now in another move, what they have done is that they have clarified that bank loans to microfinance institutions will be exempted from such high risk weights. Now back in November 2023, when they had announced higher risk weights on personal loans, overall consumer credit and bank loans to NBFCs, they had excluded housing loans and gold loans and such other loans. So they had not specifically mentioned MFI loans then. So in another circular, they have clarified that MFI loans will continue to be exempted from high risk weight norms, which means that internally, when the MFI stress had begun, a lot of banks had increased their internal risk weights to such loans. Now they can normalize those risk weights. They can normalize their internal credit risk parameters. So this is going to be a big move for banks and NBFCs. It's a major relief for the sector.
Okay. Thanks a lot for that, Subhana. Well, certainly watch out for some of the banks which had the CET1 unraveling to happen, right? High CET. So the brokerage view is that the likes of Bandhan Bank, IndusInd Bank, Federal Bank, IDFC First Bank are the buckets which will actually have the best kind of impact, positive impact as a result of this. So you probably expect some of these to have a fairly sharp reaction. The spotlight is also on Jubilant FoodWorks, by the way, as they are set to host their maiden in-person analyst meet today. Mahima joins us to tell us what is to be expected from this meet. Mahima, good morning.
Good morning. So yes, as you rightly mentioned, this is the first time that they're physically meeting. This is the first physical analyst meet. Now, just to give context, in terms of Q3, the companies performed well. They did see a strong pickup in growth. The same-store sales growth also was in double-digit, and the delivery side of business was better performing as compared to Zomato and Swiggy. Of course, on the back of a lower base as well. Now, in terms of what to expect, two brokerages have come out with notes. Jefferies has said that the industry overall is facing an urban slowdown, but QSR Industries has seen a pickup in Q3. They want to know as to what is auguring this growth. The second aspect is that industry trends and outlook for demand environment for QSR overall in the outlook. In terms of what is ailing dine-in sales and what are the factors that can recover the dining sales, in terms of the delivery charge and impact on margin, because so far they've waived off their delivery charges, which is kind of weighing down on their margins on the back of competition coming in from likes of Zomato and Swiggy. Of course, their view on platforms like Zomato and Swiggy will be something to understand. In terms of expectation of DP Eurasia, which reported a weak Q3 profitability, Popeyes Jefferies wants to know the medium-term guidance with respect to this particular segment of Jubilant FoodWorks, and any update with regards to the outlook for brands like Hong's Kitchen as well as Dunkin', and any plans to add new brand in the medium term is something that they are wanting to ask. Now, Macquarie is seeking clarity on India EBITDA margin trend, Domino's sales and store count trends, and also operating metrics for Popeyes. They're saying that how digital strength can be used in dine-in is something to watch out for. The commentary on that is something to watch out for, and cost control and discounting on aggregator platforms is something to keep an eye on. They also seek to understand the levers for expansion in sales as well as store growth, and the pace of margin expansion is something to look out for. So these are the overall expectations that these brokerages have come out with. That is something that they look forward to seek clarity from in this particular physical analyst meet.
Got it. All right. Thanks, Mahima, for getting us those details. And we'll get you details post the meeting as well. But for now, let's take you through the watch list that we have. And we've already discussed quite a few stocks. These might be different from those. Tata Power is first up on the watch list. It is set to invest 30,000 crore rupees in Assam. The second one is Realtel. Once again, it's been in the news in the recent past on account of order wins. The latest one is a 168 crore order. There are several MOUs that have been signed in Madhya Pradesh in the recently concluded investment conclave. KP Energy as well as KPI Green Energy have signed MOUs with the MP government for 1.8 gigawatts worth of projects. Dr. Reddy's Laboratories, this was on my list. It has gotten an establishment investigation report for its Hyderabad facility, the API facility. We spoke about this. It's a positive for this company. Mastech is in the news as well. It has gotten multiple contracts worth $85 million.
Kaplan Point Laboratories is the other one. The unit has received the final approval from US FDA. GR Infra has entered into MOU with Assam government for 270 crores. More importantly, financials like Bandhan Bank and IndusInd Bank, RBI normalizes risk weightage norms and it should be positive for them. And Hindalco, Kotak upgrades the stock, sees about a 16% upside. And speaking of the Aditya Birla Group, Ultratech Cement's plan to enter into the wires and cables business with an investment plan of 1,800 crores, I thought, but maybe it is more. Mihika Johnson with details of the entire set of implications for all the players involved here and what it could mean for Ultratech individually too. Mihika.
It's an 1,800 crore investment. You're right about that. Over the next 2 years, they're planning a plant in Gujarat. But the question lies if Birla Group as a whole is over-diversifying. In terms of your past ventures, they did announce India jewelry ban. They were going to invest close to 5,000 crores and open 100 stores in the next 18 months. And they aim to make it one of the top 3 jewelry retailers in India within 5 years. Another one was Birla Opus. We've spoken a lot about it. It's the paint brand. They announced its entry in 2021 and launched products in 2024. And the company does target 10,000 crore revenues and to turn net profit positive in FY28. And the Birla Group as a whole is already in a battle in 2 segments. One is a telecom with Bharti Airtel and Reliance Jio, and in the apparel segment as well with Reliance, Trent and Shopper Stop. Now, what was common, Grasim, in the paint industry and what helped, and you saw kind of pressure on other paint companies, is that the distribution network of Birla White and Birla Wall Care Putty, and around 70% of its dealers also sold paints, which helped Birla Opus and made the dealership reach second when you compare it to Asian Paints. But when you compare Ultratech and whether it has anything common with the wire and cable industry, the simple answer right now is no. They have negligible synergies in terms of stuff like raw material sourcing, distribution, as well as transportation. And the influences are also different. In cables and wires, it is electricians, whereas in cement, it is contractors, and neither cement dealers sell wires as well as cables. In terms of what could go wrong, well, amongst wires and cables is growing faster. One is because of higher demand from sectors like power, data centers and other infrastructure projects. But on the flip side, cables do take 2.5 years in terms of product development, manufacturing and other things. For wires, on the other hand, the time to enter the market is low, and some analysts do believe that because of Ultratech's better brand recall, it would help. Lastly, potential financial impact. I'll just go through over that. 1,800 crore capex has been announced, an assumed 4% 4.5x asset turnover gives a revenue potential of 8,100 crores at a 10% EBITDA margin, 810 crore EBITDA level, which is 4% of the FY27 consensus estimates. But there is investor concerns about the capex allocations that brokerages have been citing.
Okay, capex allocations is one concern, but Megha, and thank you for that and for that big picture about whether the group as a whole is over-diversifying. I think the real focus today will be on the others, right? What happens to Havells, what happens to Polycab and others in the space? So Praveen Sahai, research analyst at PL Capital, joining us to put light on that. Praveen, very good morning. First, let's start with your take on Ultratech's foray into the cables and wire space and what happens to current players, organized players in this space.
Yeah, hi, good morning, everyone. So definitely the entry of Ultratech with a very high capex announcement of 1,800 odd crore considered to be the way forward competitive intensity to heat up in the sector. But definitely in this sector, it's not like putting up the capacity, especially in the cable. It further takes around 3 to 4 years time frame for a lengthy approval process to supply of the cables. Whereas wire is quite easy as compared to the cables to venture out, it's required a distribution and the brand is already with Ultratech. So I think they will start with where they had not disclosed, but I believe they will start with the wire. I believe with their a lot of penetration in the retail in the different verticals. So this definitely treated as a sentimentally negative for the existing large peer set. Also, we know that large part is in the wire and cable is organized, or around 6 players account for around 54-55% of the market. So definitely it's going to be a pressure to them way forward. It will take time, I believe. But the one thing is the near term, these companies got re-rated massively post COVID from a 15 times to a 45 times, 40 times. With the entry of such a big player, definitely put a pressure on their valuation, I believe.
Okay.
In the near term.
So let's delve a little deeper into this, Praveen. And your point is well made that the wire space is what will see increased competition first, and then eventually it will move to the cable space purely because it's going to take a little time to have that kind of penetration, right? So having said that, what is the initial impact that you see? Could you see it as early as the next financial year in terms of pressure on pricing? And what is the implication of that on the earnings of the existing players? Who gets hit first? Because you saw that play out in the paint space as well, where there was pressure on pricing, margins have contracted. Could you see that here as well?
Usually time frame for commissioning of any plant is 18 to 24 months. What they had also highlighted by December 26, they are expected to commission their Brokerage plant. Even if I look at the delivery of machinery for the plant, this is both imported as well as domestic. There is a delay of 3 to 4 months already because of a higher competition and the global scenario. So that is the one part. Second thing is for optimal utilization, what we are saying of a 3 times or a 4 times of asset turn on their investment. For optimal utilization, if they are venturing out in the wire, definitely the wire companies initially will face the heat. Largely, if I look at the Havells have a 60 to 65% is a wire contribution in their business of wire and cable. Then you have a Phenolics cable, similar kind of a contribution. RR cable is 70% wire. There are a lot of smaller players in the wire segment, regional players are there. So I believe that is start from the smaller player to the major, those who are in the wire. And then, as I said, that the cable takes another 3 to 4 years time frame to come to an optimal utilization or become a sizable player. Then we will see the Polycab or a KEI will get some kind of an impact because of that.
Praveen, just one quick question. With an assumption that the stocks go lower, a lot of people will draw parallels to what's happened to paints, wherein while it's Ultratech or Birla's entry hasn't dislodged the numbers per se, but the valuations got derated and stayed lower. So my question is, if the numbers come off, right, if the stocks come off, would that be a buying opportunity, or would you believe the overhang could persist for a while on a Polycab or a KEI or a Kabel?
Yes, you are right. This is the first sentimentally negative, and that will directly hit the valuation, which got a great re-rated.
Right.
So whatever the correction we will see because of devaluations, it will maintain.
It will maintain.
Not maintain, but because this 1800 odd crore of investment at the initial pace, it's considered to be very high. And what I believe is it will not stop here. They are venturing out in this business because the ROC profile is better off than the cement, and definitely they will go ahead and take the lead as well. So I think whatever the correction will come in the valuation, it will sustain for some time for the peer set.
Okay. Really appreciate this, Praveen. Thanks so much for taking the time out and giving us your thoughts. Much appreciate. Okay.
Thank you.
Let's get in our experts today on the show to try and understand how do they view trade. Kunal Rambia, founder at The Street, Nirav Asher, head equity research analyst at Latin Manala on the fundamentals. Gentlemen, both of you, thanks so much for joining in. We've discussed some of the specifics. Maybe, Kunal, time to look at the broader aspect. The indices per se, Bank Nifty might have a bit of an uptick today as well. How do you view both the key indices from a trade perspective?
Morning, Neeraj bhai. Morning to all our viewers and everyone. So if you look at the Nifty, yes, we saw the overcrowded bus at 22,800. Everyone was talking about that particular support, but that's already bridged. And now we have seen the lower closing for almost 2 consecutive days. Nifty is right now trading at 22,550. But if I go back and connect the extreme bottoms of Feb, March, April and May 2024 and make a particular trend line, the support is rightly placed at 22,550 itself. I think this can be a good support even from the midterm to long-term perspective, not initiating any buy at this level because for buying, we need momentum, which is as of now missing. So if the Nifty reclaims 22,800 in the couple of coming days, then we can expect the rally still 23,300 to 350. And as you rightly mentioned, sir, Bank Nifty is outperforming, and that's in the broader range of 48,250 to 49,750. Now, if Bank Nifty holds on to these levels, I think the sideways momentum with positive bias is likely to continue in Bank Nifty.
Okay. Kunal, hi, morning, and morning to you as well, Nirav. Nirav, I'm coming to you on the pack that Kunal also expects to be active today, which is the banking pack, and we've talked about why those risk weight changes and what it will do to incremental lending in the space. And apart from the NBFCs, of course, the small banks are going to be affected as well. IndusInd, you're talking about Bandhan Bank, you're talking about maybe even an RBL Bank. What would you say about these? IndusInd in particular, a lot of people have spoken about the valuation correction, and does it become more attractive right now?
Well, the changes which have been effected by RBI are definitely sentimentally positive as far as certain banks are concerned, and definitely they are going to benefit IndusInd Bank, players like Federal Bank, RBL Bank to a certain extent, IDFC First Bank. But I think even at this point of time, there is no sector leadership in the market. So I think banks too have been lagging behind. We've seen very less momentum. So at best, I think we can see some sentimental positive as far as these stocks are concerned.
Okay, Nirav also with us this morning. Nirav, great to speak to you as always. I want to actually get your view on the easing up of which the RBI has announced on microfinance lenders, on NBFCs. We've identified Bandhan Bank as one stock that may move today. But how much of a relief do you see after quite a tight grip in this? And which are the top NBFCs on your list?
Well, at this point of time, I think what we have seen is that NBFCs were under tremendous pressure because there was a perception that they are doing a kind of reckless lending, which has been disapproved by the regulator. And I think now with the easing of the norms, definitely the disciplined players are likely to benefit in a big way. And I think our top pick in this play is definitely going to be Bajaj Finance at this point of time.
Finance. Kunal, you like Bajaj Finance? You like Bandhan?
Absolutely. So we have been discussing about Bajaj Finserv in the past. In fact, Bajaj Finance is equally looking attractive. On the chart, we can expect the support of the counter at nearly 8,300. Counter is already in momentum. The fresh breakout is placed at around 8,500. The targets can be 8,750. Keep trailing the stop loss because the trend is extremely strong.
Okay. So Bajaj Finance is something that Kunal is interested in. What are your top picks this morning?
So I have shortlisted a couple of counters. The first is Adani Green Energy. Now this counter has come down significantly and holding on to 820 levels really strong. And what we saw was last 2 days of again consolidation near the low itself. So with the stop of around 820, one can initiate a buy and the targets can be 875. The second is the Kaveri seed, which we have been discussing on our show quite some time since long. Now, this counter is again in good momentum. In fact, on the previous day, this counter was up by around 5%, showing good momentum. So, with the stop of 1,000, one can initiate a buy, and the targets can be 1,080. And the third is Gala Precision Engineering. This counter is been in sideways consolidation and showing good volume activity and consolidation again. So, with the stop of 980, one can go long. The targets can be 1,050. And in all three, I would advise to trail the stop loss rather than booking the profits.
Okay. All right. So those are Kunal's picks. Gentlemen, I want to come to you in just a bit on SpiceJet, but first let's set the context for that. You've got the numbers that came through finally for not just Q3 but Q2 as well. That was pending, and it's a return to the black in the third quarter. We've discussed this already, but let's bring in Mahima, who's going to tell you about the key highlights, but also what a couple of brokerages are saying, I believe. Mahima, I've pegged it as a thumbs down because of the auditor note. What did you see in the numbers?
Right. So, I'll start with the key highlights first in terms of, the key metrics that have kind of improved. There's an improvement of around 18% in available seat kilometers for SpiceJet. PAT has boosted, of course, because of a one-off income. But overall revenue passenger kilometer rose around 23% QOQ. Passenger load factor has gone up to 84% versus that of 81% in last quarter. And cost per available seat kilometers has also improved quarter on quarter. In terms of the Q2 and Q3 numbers, in Q2, revenue was down around 36%. EBITDA loss stood at around 210 crores and net loss was around at 442 crores. In terms of Q3, revenue was down 35%. EBITDA stood at around 85 odd crores. Margins at 7% and net profit at 25 crore. And this is, of course, because of one-off income. And just to give context as to what this is exactly, it is returned to profitability and this is on account of rise in other income, which stood at around 419 crore, and this other income came from restructuring of lease obligations with lessors. In terms of a brokerage note, InCred came out with its note on earnings, and it's saying that they believe that scale up of its operations could reduce in FY26 going ahead. SpiceJet will be able to retain the entire benefits of the reduction in overall cost per available seat kilometers, and they've factored in that SpiceJet's entire fleet will be operational by FY26. Lastly, in terms of QIP utilizations, around 3,000 crore of QIP was raised, out of which 2,400 has been utilized, and overall, to give a breakup, 600 crore has been used to pay off the GST, TDS as well as EPF dues, and another settlement disputes with aircraft lessors for around 1,200 crores, which was a claim of around 1,700 odd crores. Lastly, in terms of what the auditors are saying, this has been the case for SpiceJet, before also in FY24 also in the audit report and annual report, the auditors did mention concerns with respect to going concern, but management is of the view that going concern is the basis on which accounts have been prepared. So there is a contradicting view between the management as well as the auditor, but this has been the case for SpiceJet even before Q2 and Q3 numbers are announced.
So that is interesting context. There is improvement in operations, no doubt. So therefore, from that perspective, Nirav, we've been speaking about the market leader, Interglobe Aviation, in the context of what has happened with the Mahakumbh and the kind of air traffic that you've seen, particularly over the last month or so. It's positive. But then we're talking about a small player that has seen its market share shrink but still has seen an improvement in operations. The government very clearly does not want another airline to go bust. So there will likely be support to the extent that they can give. What do you think you should do with this? If you are invested in SpiceJet, should you hold on? Should you deploy fresh based on the operations?
Well, it's better to hold on because whenever you are doing any business operation, the primary assumption is a going concern basis. This means that the company neither has the intention nor the desire to curtail materially the scale of its operations. So that would be the underlying assumptions. The second important factor which we need to take into account is that we've had a very strong run as far as Q2 and Q3 are concerned. Maybe Q4 also would have a good run, but there's likely to be a moderation in the scale of operations going forward. So this is what we definitely need to keep in mind. And I think hold the stock at this point of time.
Okay. SpiceJet in focus this morning. And, that's another one of the stocks that we're looking at. Indigo has been as well, and some positive commentary there. Kunal, I'm wondering if you're liking SpiceJet or Indigo. SpiceJet on the charts will be interesting. One of those stocks that is not for the faint-hearted, but is often
Absolutely.
lapped up by retail investors, I would say.
So, Tamanna, what technicals actually is all about is looking at the trend of the market and thinking of capturing the ongoing trend. Look at SpiceJet since listing days so far. There is no trend actually. The counter has shown good momentum for the short term, those 1 or 2 years, and again it goes into sideways consolidation of lately. This counter has made good support base near 30 levels and has a strong resistance near to 80. As of now, it's placed in between. So obviously, even from the short term point of view, it's a big no as of now. Let counter come down probably near to 30s in the time to come. We'll think of initiating a buy at that time, or let the counter come out of this broader consolidation zone and think of then, at the expensive price, we'll think of initiating a buy. But as of now, there is no trend. So it's an avoid counter on the technical spread.
The interesting thing about SpiceJet though is that with the QIP money that they raised at 62, they've repaid some of the past dues meaningfully. And if Q3 is strong for Interglobe because of Mahakumbh, it has to be strong for every airline.
Correct.
And SpiceJet had daily flights from Mumbai to Prayagraj, by the way. So the flights are going full, apparently, as per people who went to Mahakumbh. I haven't.
And load factor is already at 84%. It's likely to improve
I am
further.
sure they were, because there was a lot of rush. So that will come in.
Q4 could be interesting for all airlines, including SpiceJet. I mean, we've seen last week 2 brokerage notes come in, right, on Indigo, saying that they expect a non-seasonally strong quarter to be very strong because of Mahakumbh. Citi actually laid Mahakumbh as the key factor.
Exactly. So if what's good for Indigo will be good for... I'm keen to speak with Ajay Singh again, because if you recall, he'd come and said that I want to come back on NDTV Profit when we're in the black and tell you I told you so. We did it.
Yeah. But I don't blame Kunal simply because the charts will probably not show it.
No, but
it has to be about some bit of performance.
And it's up and about. It's 5. So, but my limited point is that wait till operationally you see a profit. Right now, it is an other income move or a one-off.
Then that we should wait for a lot of companies, including some very loved companies in your platform space.
No doubt.
To operationally see profits. That sort of jugglery is all there. Okay, first ticks are. We'll wait for those to settle actually as we get the first ticks in. But it's a bit of a wobbly market overall. You've had a sentimental downturn from the last several months, deepened, I would say, in the last couple of weeks, and that's what you're seeing. So don't get alarmed seeing that 0.5% down on the Nifty. Hopefully it will settle as well. You've hardly had a minute. But let's tell you what's moving and what's buzzing this morning, if at all. Anand Rathi looking interesting. TBO Tech, I can see. I want to look at Muthoot Finance. Let's look at some of those NBFC players. Look at an IndusInd Bank, the BFSI space, AB Capital. Those are some of the stocks that I see buzzing this morning, even as perhaps what the RBI has said comes into play. Interesting move on Vodafone as well, maybe just for the first couple of seconds, 3.5% up. But Muthoot Finance one which has caught my eye. ISEC also not doing too badly on the downtrend. What is hurting? Maybe a KEI industry, a Borosil Renew, all of these seeing a bit of pain. Let's look at Ultratech. What's happening to Ultratech? What's happening to Polycab? Yes, but let's see Ultratech, which is actually announced that foray. No great shakes, just mildly in the red. But a Polycab, a Havells, all of those is what we should really look at. A KEI as well, as we said. KEI is one feeling the pain this morning. But more stocks to watch that you should track in today's trade, and Rucha is joining in with those details.
Well, good morning, Tamanna. I'll start with Mastech, a thumbs up over here because the company has received multiple contracts from a UK Public Services Department. The contracts are spread over a period of 2 years, and the total contract worth is above $85 million. So a thumbs up for that for Mastech. But looking at the order book as on third quarter, the 12-month order backlog stood at about 2,140 crore rupees, which grew by about 1.5% year over year in constant currency terms. So healthy order pipeline is what we could see in Mastech. Moving on to an earnings, Rain Industries reported its fourth quarter numbers. Remember that this company reports on a calendar year basis, and hence the fourth quarter. Revenue down about 10.3%, so a little bit of blip over here. But EBITDA came in healthy at about 238 crore rupees in profits, versus a loss of about 612 crore last time. And this kind of profits indicates around 6.5% of the margin. Talking about net loss, it came in at 161 crore versus about 1,120 crore rupees same time last year. And this is largely aided by a reduced amount of impairment loss that the company had reported this time versus last year. And the EBITDA numbers also does not include foreign exchange gain. Talking about the qualitative line, well, the lower market realization and weaker pricing trends actually affected the revenue, the top line, but healthy margins is what we could see over here. Lastly, talking about Capline Point Laboratories, the unit received final approval from US FDA for a drug which could have a potential sales of $242 million as of December 24.
Well, thanks a lot for that, Rucha, and some interesting names out there, smaller ones. You know, Cupid gets these orders and then the stock zooms a day or two and then comes off. So be careful with some of those trades as well. But I also wonder if metals are reacting at all to the China news. Globally, metal stocks did really well yesterday, but today in India, kind of flying flat. So no big moves out there. Okay, Shrikant Chauhan, Executive VP and Head of Equity Research at Kotak Securities, joins us on the show as well. Shrikant, good morning. Thanks so much for joining in. A lot of people are hoping, not believing necessarily, that 22,500 is probably the bottom. I'm trying to understand, Shrikant Chauhan. Does the bank Nifty or the Nifty give you that belief that we are close to the bottom and you can initiate long trades?
Yeah, absolutely, Neeraj. The way the market is correcting and the stocks are correcting from the highs, one thing is very clear that yes, they are hoping, but they are not believing. But I'm of the view that the markets are in excess. And it happens whenever the market goes in any one specific direction for a longer time. So when the market was around 26,000 levels, that time also it was like going up and up every day and it was not correcting. This time the market is falling on a regular basis. In fact, markets, I'm to say the index in terms of point-wise correction is lesser than the pain in the stocks. But I'm of the view that in the near term, we saw exhaustion gap. I'm to say a few days back, the market opened down nearly 150 points lower, and it is not trying to fill that. It is very close to the support levels of 22,500 since last 2-3 days. So broadly, I'm of the view that it is very close to the important support levels, and we could see a very strong rebound in the near term. That's the view. So the strategy should be to look for adding index heavyweight stocks at current levels, more on dips. And we could see a very strong rebound in next 4-5 days of time. So we should look for adding some contra bets at current levels and more on dips. I'm not expecting market to sustain below the levels of 22,500.
What are your top picks or contra bets this morning, Shrikant?
Yeah, good morning, Tamanna. I think I would like to go with we should look for targeting those stocks where the beta is very high. We like CDSL. We also like few metal companies because there I'm seeing good amount of volatile activity in the near term, and that will give more opportunities to traders. So in that space, we like CDSL, which is currently around some 1,200 levels. It is correcting from the highs, but at the same time, it is diverging positively on daily and weekly charts. So at current levels, it's a buy with a small stop loss of 1175. We can keep a target of 1300, 1325 on the high side. And the other stock which we like is Vedanta. And most of the time, whenever the stock has fallen to the levels of 405 or 400, we saw a quick rebound to 440, 445. This time also, I'm expecting a rebound, and 425 should be the target. We can keep stop loss at 400 levels.
All right, Shrikant, thanks for that, and good morning to you as well. The question is, do people have the money to buy the dip? They've bought the dip consistently over the last several months, and they've been waiting for that bottom. Let's see if that actually does come into play now. All right, let's talk about the big brokerage call of the day. And Morgan Stanley has maintained an overweight rating on Titagarh Rail, but it has cut the target price to 1,090. And Anushi is joining in to tell you why they've done that. Anushi?
Hey, morning, Alex. So it's a big change in the target price that we are looking at in terms of Morgan Stanley on Titagarh. Now, this implies a 16% of a cut in the target price for Titagarh, which is a significant one. And this is based on a couple of developments, or rather the overall outlook on the sector which is happening. Firstly, the near-term execution challenges persist, which is expected to impact the revenue trajectory of the company going forward. And this mainly pertains to their freight rail segment, wherein there are inadequate wheel sets from the Indian Railways, which may constrain their Q3 offtake going forward for the business, thus impacting the segment's overall performance. If you look at the passenger rail segment also, it has already seen about a 58% of a cut in their revenues. This is because a majority of the orders are in the designing phase. So what happens to freight rail as a segment as a whole also remains as a question going forward. Other than that, the company is a beneficiary of the robust rail capex, but if you look at the ordering, that has remained muted so far. So this is despite the 2.65 trillion budget, railway budget that we have seen. While there were no changes in the railway budget, the company stands as a strong beneficiary of this move, but so far the ordering has also remained weak. So again, the question comes on the revenue going forward for the business. Now, the other point that the note has made is also on the execution of the Vande Bharat, which has been delayed by 9 months, and this is by a change in car design plan. So overall, it's the execution which is a concern. Along with that, even the inadequate wheel sets from Indian Railways has constrained the Q3 offtake. So the deliveries are also being pushed back to later. So couple of reasons as to why Morgan Stanley, though despite maintaining the rating that they have given, they've cut the target price now to account for lower EPS forecast going forward for the business.
Okay, well, thanks a lot for that, Anushi, and this will be interesting to watch as to what happens to some of the rail companies in the medium term or the near term when the order flow has gone down. Now, guys, just a few stocks that we should mark now that the pre-open rates have settled. So the usual suspects, and just want to spend a minute or two on some of those. Ultratech Cement is starting off in the red. So the fact that some brokerages said that not all diversification really aids to sentiment might be true for Ultratech. Keep that in mind. I want to mark if Polycab, KEI and RR Kabel in the same breath are coming off. Yes, they are. And this is the point, that whether or not it dislodges the leader, Polycab, for example, from its throne is separate. The sentiment and the fragmentation of the market belief itself will probably lead to some of these stocks correcting. You know, the point is though, guys, is that what doesn't surprise me is the fact that Polycab, RR Kabel, KEI are down, and they may well stay down, don't know. But the interesting thing is the reaction on Ultratech. They've done A, B, C, the group at large, which may be great for the group per se, but for a pure cement company to now start saying that we are doing this. And yes, there are arguments being made that they have B2B clients and they can sell cables and wires to those cement B2B buyers. Maybe fair argument, but for now the street is voting that it doesn't necessarily like this diversification.
Because look at how this product category is purchased. The person who decides it is largely the electrician.
B2C agree.
Yeah.
Yeah, the argument was just that the B2B, it might still be okay.
So if someone is constructing, you will get in. You know, so that's the tricky bit about diversification. And a lot of businesses, not at the scale of Ultratech, of course, have had those hurdles because of diversification, which sounds good on paper, but how will it pan out? I think the other problem about 1,800 crores, would that have been better used in another fashion?
I don't know about that because they have tremendous capacity, don't they?
No, but they are on the run with regards to capacity. They probably need every pounds that they want to maintain that cement leadership, right? Because snapping on their heels is Ambuja, which is
100%.
buying up capacities
Consolidation,
as well, right?
The consolidation play.
Simple, it's
is ongoing.
Have you opened war on too many fronts? Is another way to maybe look at it. As
because
a group,
these are entrenched players, right?
right from telecom to paints to cements to now cables and wires, you are getting into very bitter battles.
And you're wading into territory that you've never touched before. So
I mean,
maybe you don't know them.
Could work out either way. But as far as the first stock impact is concerned, it's not really shown that way. I wonder if Nirav has a view on the debate we've been having in this studio. Nirav, what do you make of the foray into cables and wires?
Well, I think wherever they have entered, Ultratech or Grasim, I think they have entered into those areas where there is an extension of the business from the unorganized sector to the organized sector. For example, I think in the paint segment also initially they did mention that they are going to take away share from the unorganized players. Even in the case of jewelry, Indriya, basically we know that the organized players just account for a very minuscule percentage of the market share. Titan, for that matter, just has around 8% market share pan-India. So there is a lot of potential which probably we are not looking into at this point of time. Third is the wires and the cable space. Of course, it could be an extension of the entry into the construction segment. But I think most of the incumbent players are trading at very high valuations. So I think that is definitely going to come down because of the competitive intensity.
Okay, point well made, Nirav. Let's see how that reaction pans out and whether this is just an initial reaction or more sustained. But Shrikant, top picks at this juncture for you. You've seen the pre-open rates settle more or less, and what are you betting on?
Yeah, I think, today, of course, definitely we are going to see some correction in these cable-related stocks. And personally, when I was I have seen this market since last almost 15, 20 years. And whenever there is such kind of expansion we see at the top of the, or maybe we can say at the boom of the market, investors have to pay price for that. So I think Ultratech is also going to correct from here. That's the view. But for stocks, I think we need to focus again on large cap companies, especially.
Shrikant, sorry, because it's only 5 seconds left. So I'll be forced to come to you post market opens to try and understand. Maybe you will have the advantage of seeing the first 5 minutes of the trade reactions there too. But this is how the markets are starting off this Thursday morning. Marginally in the green. It is not unwelcome, guys, because Asia was mixed bag, if you will, not necessarily throughout in the green. Wonder what the IT index is doing, because banks are certainly flying away, not flying away, but in relative terms doing well. Nifty IT should come up on your screen next, just to see what IT stocks are doing. Banks 0.5% higher in trade. Nifty IT flat. Mid caps and small caps next on your screen, and let's see what those are doing. Flat for the mid cap index, the small cap index, flat as well. Maybe I have better luck than Tamanna in stocks. Let's pull them up. The heat map on the Nifty 50 this morning and see what's moving and what's not. Fair degree of green and red. Ultratech starts off 4% lower. The street is not liking it. That's the point. That's the verdict. Trent, Bajaj Auto, ONGC, BPCL, that's the other set of stocks that are there in the red. ONGC kind of giving it company, but the standout name is Ultratech and then the two-wheeler names, but Ultratech in particular 3.7% lower. What's doing well? Bajaj Finance, Shriram Finance, IndusInd, FinServ. So, well, banks and NBFCs, if you will, but not quite seeing the stable banks. HDFC Bank may not necessarily benefit too much with this risk-weighted changes that have come in, but IndusInd benefits 1.5% higher. Bajaj Finance and NBFCs by and large benefit, so higher in trade. There's some strength in Hindalco because of that Kotak upgrade, I reckon. JSW Steel in the green. Adani Enterprises, L&T, Reliance make up the other set of stocks. But the notable point is that financials on the upside coupled with a Hindalco, and Ultratech on the downside are the key catchment areas for the morning.
Yep. What will be interesting to see is that even as Ultratech is down and a bit of a surprising reaction, I mean, in the sense we called it that is the group over diversifying, but to this extent is a bit of a surprise. So what's happening to the other players in that space is something that we should also take a look at. But having said that, let's look at the broader markets first. What's happening with the mid cap and the small cap indices this morning, even as the Nifty is managing to stay in the green and keep its head above water. Not so much for the Nifty mid cap, mildly down though, nothing alarming happening over here. Likewise for the small cap, about 30 points odd down in the red right now. Let's pull up the sectoral heat map for you just for a second to give you a sense of the market, and it's all about BFSI this morning, isn't it? Metals as well. Remember, we talked about this in the morning. More liquidity being pumped into banks in China, focus on infrastructure, metal prices set to rise. Nifty metal, top performer in terms of a sectoral index this morning. So our PSU banks, Nifty Finance, Nifty Bank, it's all about BFSI this morning. Look at the top line over there. The Nifty just about holding up. On the downside, consumer durables not doing too well, even as metal prices may be set to rise. That's one impact you're seeing. Also concerns ongoing about what kind of demand is coming in and spending power. There was a report over the last couple of days from Bloom Ventures saying that a lot of Indians don't have spending power. Is that impacting the Nifty Consumer Index? Could be, could not be, perhaps. Small cap 250 showing a bit of pain right now, so that could be concerning. Let's take a look at key stocks which are in focus. And we talked about the RBI relief. We saw that play out with an IndusInd Bank, but what's happening to an RBL, Muthoot? Is that entire space up in the green? RBL about 4.5%, nearly 5% up. That's interesting. Bandhan, I want to see, one of the top picks for CLSA, with that interesting dialogue. Jab ऊपर वाला देता है तो छप्पड़ फाड़ के. Bandhan is really feeling that love today. About 7% up. Bandhan Bank, one of our top picks on our stocks to watch on our watch list this morning as well. What's the impact on the others? We talked about Ultratech, about 4% down, but what's happened to KEI, Polycab, Havells, Kabul? Polycab 10% down. So this is interesting. If the street thinks that Ultratech's diversification into cables and wires is negative, why are the other players also seeing a negative kind of hit? And to this extent, KEI 10% down, Polycab 10% down, Havells about 8% down now, Kabul also about 10% down. So that's really where the pain point is looking like. SpiceJet, let's take a look at SpiceJet. Results were okay. Auditors are concerned. That was Alex Take. He took give it a thumbs down. Street seems to agree, about 5% down right now. So there's specific stories that are playing out, but I think the big theme, Alex and Neeraj, clearly is, on the one hand, BFSI having a great day, relief from the RBI, and as far as anything in the cables and wire space, that infra space is concerned, getting quite a bit of a hit.
No doubt. Tamanna, it's a sad truth of life in competitive sports, and if you grew up playing a team game, then you know that there is maybe that one friend of yours that is not very good at the sport that you play, and you don't know which team to put them in. They want to play, and once they get into the football ground or whatever ground, they may be having a good time. They may not perform well, but the rest of the game also, or the rest of the players have to bear the brunt of them not playing well. Maybe that's something that's playing out in the cables and wire space. A player that may struggle, initially at least, and mucks up the ground for the rest of the players as well. Shrikant, I guess that to a certain extent you're seeing those reactions play out. We didn't get to discuss your picks. What would you do with some of these names? Ultratech Cement down 5% right now.
Yeah, absolutely. I think the way there is a specific news flow, I am of the view that this stock is also going to correct in the near term. It is like the next level to watch out for would be 10,500, but broadly, we could see the levels of maybe 9,500 in next few days. So it will take some time, but already the stock has broken the level of 10,500, which was its support since last almost 2 months. And now when it is breaking that, the next level to watch out for would be 10,000. But broadly, I think the stock is heading for 9,500 sort of levels. For Havells, Polycab, I think there is no point in talking at current levels because they are already down from their highs, and already we have seen good amount of correction in past few days. So a few more downward activity is not possible. But at this level, I think all these stocks are below their important support level. So furthermore, pain is definitely not ruled out in all these stocks.
So I want to ask.
But for other sectors, I think yes, NBFCs can do well.
Okay, sorry, Shrikant. Okay, Shrikant, just before we get to your idea, because I would love to understand what you're trading right now after the open. But Nirav, the question to you is 10% lower for a polycap, 10% for a KEI. Would you be a buyer at lower levels into any of these? If so, acha, you're saying a no.
No, for the simple reason, most of these stocks are already trading at 50 to 60 times trailing 12 months earnings. If we were to discount their earnings at a CAGR of around even 20% for the next 3 years, still we are paying a valuation of 32 times FY28 expected earnings. So this is too much for companies which have net profit margins of 7 to 8%.
This is very interesting, guys. What regional FMCG firms are doing to high ROE, high profitability national FMCG firms, right? Smaller players doing to large players. Now, if you're seeing larger players doing it to a fragmented industry, it's happening in paints. Asian Paints ko chhod do, Berger ko chhod do. A lot of other smaller paint companies getting beaten. Similarly, now happening here that a larger player getting into that sector because it has got high PE multiples, but it's getting to the valuation multiples of the regional or the smaller players.
But look at the
and polycap is not small, sorry, just to finish my point. But yeah, it's just a fragmented industry. Yeah.
Just making the point that it's also an industry which is getting more and more organized. The share of organized players has been consistently rising. That's also maybe why you are seeing this kind of a pressure. If it was, say, the jewelry business, the example that you gave, that there is still room for everyone to grow, then maybe it would not be that much of an impact. Here, if 80% is expected to be anyway the organized players, and then you have a big player with deep pockets coming in, the chances for the others, that's where they're going to get cut, because the upside then gets limited.
I guess to a certain extent for Ultratech Cement, it is a question of could they have used this money, 1800 crore, better? And for the rest of the players, it is a deep-pocketed player entering the space and wanting to make headroom or making inroads, and so therefore it's negative.
And the multiples are high.
For the rest of the players, it's run for cover. Frankly, now.
Yeah, but also multiples are high. So, I mean, the polycap may still remain a leader. Ultratech will not be able to probably dislodge it for 10 years.
Yeah.
But the multiples are getting corrected, which is what Neera was making, that even after 3 years out, you're paying probably 30 times, which is not great. But Shrikant, you already told us that these stocks are not on your radar. So now that 8 minutes or 9 minutes have passed, what is on your radar from a stock-specific perspective?
See, at this level, we should look for adding those stocks where there is like specific news flow on the positive side, and in that way, like Chola Finance. Chola Finance is currently trading at 1425, 1430, and there is like scope for the stock to move towards the levels of at least 1500, 1525. At this level, it's a buy. It has been consolidating, and currently around 1425. If we create any long position, then we need to keep a stop loss somewhere close to 1380. We also like Hindalco, and there also the overall trend is suggesting us that eventually we are going to see upward activity towards the levels of maybe 700. But at least in the near term, we could see the levels of, again, 650 or 660, which was this immediate previous highest level. So it's a buy at current levels around 620 to 625 with a stop loss close to 610 on the downside.
Shrikant, what about Bajaj Finance this morning? This was a call that we had this morning as well from Kunal before you came in. And obviously all of these BFSI players, I mean, it's a tale of two sets of stocks today, isn't it? Your cables and wires languishing, but your BFSI, anyone with exposure to microfinance loans looking good. Would you say Bajaj Finance one of the best bets there, Shrikant? Or IndusInd Bank, anything that you're liking there?
Yeah, we like Bajaj Finance over IndusInd Bank. The reason is because there is specific news flow. And if we see the overall technical pattern of all these stocks, then they are forming some continuation formation. Like this one has also formed pennant formation on daily basis. And after like correcting for 10, 12 days, we are again seeing reversal activity. So broadly, I am of the view that Bajaj Finance is at current levels, even at current level, it's a buy, certainly. We could see the levels of 8800 in the near term. But if we keep a view of next at least let's say 3 to 6 months, then we could even see the levels of 10,000, 10,500 sort of levels. So broader pattern is also suggesting us that it's a buy. And with the short-term view also, it's a buy at current levels because it's a breakout. With the stop loss close to 85.75, we should look for adding Bajaj Finance.
I want to talk about a player in the MFI space that is doing particularly well today, and maybe with a note of caution, right? So pull up Credit Access Grameen, which is up nearly 10%. And if you have looked at the finances and you've looked at the updates, there was an investor presentation after Q3 that spoke about the fact that consistently over the course of the year, they've had to downgrade their earnings outlook. Their asset quality has worsened. Nirav, the question is, this update, is it enough for you as an investor or potential investor to change your mind and to deploy funds into Credit Access Grameen? Because ultimately the underlying picture for them and the pressure that they have in terms of asset quality is not really something that you can perhaps fix with this.
Well, I think after having referred to all the presentation and all that, but still we are not very convinced about the story. So I think we'd stay away from the counter for the time being at least.
What about Bandhan? I just want to pull up Bandhan Bank. Bandhan Bank, just because top picks for a few of the brokerages and got hit very, very harshly when these strictures came in. So Nirav, first view on Bandhan and then I'll come to Srikanth.
No, I think we'll stay away from for the time being.
Okay. So fundamentally stay away from Credit Access, stay away from Bandhan. Srikanth, your view on both, if you are maybe feeling stuck in it, time to exit?
See, for Bandhan Bank, yes, the trend is very clearly down. It is finding a lot of difficulties to sustain at higher levels, and whenever there is a fall in the market, the stock is correcting. And it was around some 650, 700 levels. From there, all the way it is as 135, and still the stock is not showing any signs of reversal. So I'm of the view that it is better to stay away from the stock. But yes, for Credit Access Grameen, if we consider the volume of last 2 months, then there is dramatic change in that. Good amount of delivery-based volume has also happened, and based on its technical formation, at current levels, it is moving upward, and it is again chasing the upward levels, 1100, 1150 sort of. After the dismissal of 1150, we could see the levels of maybe even 1400 or 1500. So broadly, I'm of the view that the stock has already formed its bottom. Now, till the stock is not falling back below the levels of 850, we can see a very strong rebound or pullback in next few weeks. And it to the entire fall by at least 60%, then also in that case 1500 possible. So risk-reward ratio is quite favorable for Credit Access Grameen at current levels.
Okay. So Credit Access Grameen may look better than Bandhan when it comes to the charts as well. Thank you so much, Srikanth and Nirav, for speaking with us today. Interesting morning as two big announcements play out. But next up, our conversation with transformers and rectifiers. They're in the spotlight as the stock was buzzing. Before we're joined by the management, Anushi joins in with the latest on the company and their outlook.
Right, Tamanna. So if you look at transformers and rectifiers, it's been a couple of strong quarters now for the business. This is reflected in their Q3 numbers as well. And we've seen about a 51% of a growth in terms of revenue. Margins inching upwards in the range of 15% as compared to 10% last year. And net profit standing at 54.7 crore versus 15.6 crore. In fact, even if you look at the 9-month FY25 picture, revenue growth was in fact higher at 71%, with margins at 14.6% versus 7.95%. And net profit at 120 crore compared to 4.5 crore. Now, it's the order book also, which is an interesting one. The company recorded new order inflows of 631 crore. Now, their target being taking orders in high margin ticket orders as compared to what the focus was before. Unexecuted order book stands at about 3,686 crore. And if we see the inquiries under negotiation, they have a pipeline of around 19,000 crore here. wherein in the export side they want to limit the exports to 20% of the business. Coming to a couple of key developments here, they've acquired a controlling stake in the CRGO processing unit, which is in line with their backward integration targets, and this would lead to a resulting 4% reduction in their raw material costs also. Order booking here is expected from the fourth quarter of this financial year onwards. In capex plans, they have a capex project for 15,000 MVA capacity expansion, which is going to be operational from Feb-March of this year, and anticipated ordering from this is expected to start from Q1. In terms of revenue guidance, they expect a 2,000 crore of revenue guidance for FY25 with a target of 3,500 crore of revenues by FY26. So overall, a pretty strong trajectory that we are seeing in terms of where the ordering is, what the target is given by the company, and what the numbers have reflected for the business.
Thanks for that, Anushi. Mr. Chanchal Rajoda, he's the CFO at Transformers and Rectifiers, joins us right now on the show to talk about the outlook ahead. Mr. Rajoda, thank you so much for taking the time out, and good morning to you. Your Q3 numbers, of course, belie any fears of a near-term slowdown in any fashion whatsoever. I would love to understand, because we haven't gotten a chance to speak post your Q3 numbers, how do you see quarter four now that 2 months have passed, and what's the sense for the near term, let's say the first half of FY26?
In a while that we have not spoken, but as far as quarter four is concerned, quarter four is also going into the direction what we have been guided to in our own conversations. And we are quite hopeful that we are going to achieve the revenue lines, what we have projected or committed to the market. As far as quarter two, next year is concerned, FY25, we will be targeting a revenue of around 3,500 crore rupees, and FY26, I'm sorry. And we are right on direction of that. And we are quite hopeful the journey what we have started from this year will continue for quite some time.
Sorry, I missed that number, Mr. Rajoda. What is the number that you said? You're targeting a revenue of what for FY26?
3,500 crore rupees.
2,500? Did I hear that right? 3,500. Okay.
Yes, yes.
You're targeting 3,500 crore rupees of revenues. Would you? I remember an earlier conversation with Mr. Mamtora maybe a couple of quarters ago, wherein both he and your CEO had mentioned that not only are you looking at growth in revenues, but you believe that operationally the metrics could look much better as the quarters go by. So if you are circa 15% average margins for the first 9 months of FY25, you reckon you will maintain those margins, or do you reckon you can improve upon them in FY26?
Margins, certainly we are going to improve those margins because the orders what we have right now are on the better margins. Also, with the increase of the volume, my operational efficiency will increase and my operational EBITDA will also increase. So definitely you will see almost 150 BPS to 200 BPS point improve in the margins.
Mr. Rajoda, some of the analysts who look at this space closely and from a global level seem to believe that, let's say about 18-24 months ago, when there was a peak transformer supply gap, there was a lot of companies, including yourself, went on an expansion plan. Everybody is simultaneously expanding capacities. A lot of capacity, not just in India, but globally, will come on stream sometime in the current calendar year, let's say September, October. And that might actually bring pricing power lower because supply will come on stream at the same time for a lot of players. What would you say to that argument?
I think that is the scenario. I don't think that is the scenario, neither in India, neither in globally.
Okay.
First of all, just to give you small things that in India, whosoever has basically announced the capacity expansion, there is only one capacity expansion coming in this year, that is ours. The 15,000 MVA capacity expansion, what we have announced and we have started work in April, will start commercial production from the April onwards. Beyond that, we don't see any capacity coming, not only in this financial year, even in next financial year. And particularly on extra high voltage transformer segment, there is no capacity expansion is coming. So I don't see that this gap is, and even if the new capacities are coming, please understand the requirement of India is so huge that if any capacity is coming up, is going to be absorbed the demand. There is, I don't think next 5-6 years there is any possibility of that demand, and the supply gap is bridging.
So could you, I don't know, I'm throwing this out of the blue at you, Mr. Arjora, but if you have some numbers, can you share this demand supply gap for us? Would love to understand this.
I tell you that at present in India, the MVA capacity is around 350,000 level, and whereas demand is around 450 to 460,000 MVA. And as per the CEA guidelines itself, by 2029, this demand is going to be around 780,000 MVA. So you can analyze that what is going to be the scenario. And this is and the kind of initiatives government is taking, it is going to be increased. Globally also, we don't see any much of supplies are coming, and particularly to India, the global players are not there. There's no supplies coming out of global from to India market. So this is going to be remain. We've been hearing that the government is going to give some subsidy on the solar expansion. They're talking about $1 billion or something like that. Imagine that if these things are coming up, then how much is the supplies are going to be increased? So demand is going to be increased. So this is going to be remain there for some time.
Got it. Okay, then my question, Mr. Arjora, is this. I'm just trying to do the math. I heard you say that the current MVA capacity is about 50,000. You have a capacity.
350,000.
No, that's 350,000 you were saying.
Yes.
And the demand is 450,000 to 460,000.
Yes.
Okay, fine. And you see your capacity coming on stream, which is 15,000 MTA in the next financial year, right?
By end of next month.
By the end of next financial year.
Next month.
Next month. So for FY26, you would have the enhanced capacities for yourself. What about future capacity expansions, Mr. Arjora? I mean, when do they come in?
Yes, once this capacity is this capacity will start. We are planning to expand our EHV extra high voltage transformer capacity also. We are targeting that by end of the next financial year, we should have close to 70,000 MVA capacities. So that we are working on that. And globally, other players are also trying, Indian players are also trying to come into that level. So we see that some new capacities will come in next 2 years' time. But this gap is going to remain over there.
Got it. Okay. So next, you will add 15,000 next month. And by the end of next financial year, am I getting it correct that you were targeting a 70,000 MVA capacity?
Exactly.
Got it. So you will have the benefits of this 15,000 MTA capacity coming in next month for FY26. You'll have some further. FY26 batches, right? And then end of FY26, you have some more capacity coming on stream, which helps you in revenue growth for FY27.
Yes.
Okay, great. Now, please tell me, sir, do you reckon that your margins, which are currently at 15%, can they move up further to higher teens? Or is this the sweet spot for the next couple of years?
No. As I told you that the beginning of the conversation, that our margins should go up to around 17% level. And they are going to be remain at that level, 17 and 18% levels. Look, these are the sustainable margins. You can't keep increasing your prices. Whatever you need to, prices has reached to the level, and whatever you need to increase in the margins. You need to bring the operational efficiencies, do that, right? And moreover, that is, I've been telling you always that my target is into the PAT. I want to reach to the 10% PAT levels without any other income. And we are working on those directions. And we are quite hopeful that next financial I will have the PAT percentage of 10% plus.
10% plus net profit margins. Did I get that number correct?
Yes.
Okay,
yes.
by next financial year. Okay. So now my other question is, would cash flows and accruals enable you to conduct all of these margins and any further capacity expansion plans, or would you need to raise some equity capital in the next 18 to 24 months?
No, we don't foresee any such capital raise in near future. That is there. Yes, if any some good proposition comes for which is a lucrative proposition, at that time we may think. But as of now, for our present level of operations and our coming expansion, we don't see any equity raise or any fundraise.
So near term is 6 months, near term is 12 months, or near term is 18 to 24 months?
In the you don't know what is the near term. Yes, but definitely 6 months is not the near term.
Okay, so in 6 months you don't need any kind of capacity equity fundraise, but beyond that, if there is an inorganic opportunity available, you might think of any kind of capital raise.
Yes.
Okay, one last question, sir, and which is this: I heard you say that you will take your EBITDA margins to about 17-18% over the next 24 months. Now, based on the supply that might be not coming in the next 2 years, but maybe beyond, do you believe normalized margins will be 17-18% for the industry, or would normalized margins over 5 years settle lower?
It should be 17-18% is the normalized margin. Beyond that, the margins will be maybe in 1 or 2 quarters you may get the higher margins. But these margins are basically the industry margin, and industry is going to be settled at that level.
Industry margins will settle at about 17-18%.
Sure.
They will not come down to 10-12%.
No, it won't come. Say another 7 to 10 years, it won't come down.
Another 10 years, you don't think it will come down?
7 to 10 years, we don't see it is going to come down, because the kind of the growth trajectory we are and this entire country is there, we don't foresee that it is going to come.
Great. Okay, Mr. Rajoda, lovely talking to you. Thank you for taking the time out and giving and speaking to us. Really appreciate it.
Pleasure talking to you always.
Likewise. That's transformers and rectifiers. Now, remember, viewers, there were a lot of talk around how transformer capacity is coming on stream and margins will come off, etc. Here's the management saying that they are not witnessing any kind of capacities by any of the other players but them, and they do not foresee margins coming off. Very interesting. Prateek Parekh, Director of Equity and Equity Strategist at Nuvama Institutional Equities, with us to talk about the report, to talk about the market at large as well. Prateek, great having you. Thanks for joining in. Can I start off with the micro, Prateek? And just wanting to understand, maybe you got a glimpse of this conversation that we were having with transformers and rectifiers, right? And the whole power sector is in, how do I say, the people are confused because the government targets are stiff. Companies are saying things are okay, but the street fears that there will be some margin contraction for transformer companies, for wind power equipment companies, etc., etc. How do you look at this? Sorry, I'm starting with the micro, but it just ties in well with the previous conversation.
Yeah. Thanks, Neeraj, for having me over. Now, obviously, this is quite a micro point on from a sector perspective. But my 2 cents over here is that if you look at post-COVID, I think what is most unique about the current bull market that we have had post-COVID is the profitability part. In various sectors, we have seen companies see very high margins. I mean, the real theme of post-COVID is margin expansion rather than necessarily big bang demand. I mean, top line growth in over the last 5 years, CAGR is just 10%, which is very similar to pre-COVID. The big swing is on the profits part, where at an aggregate level, profit would have been 20% plus. Now, a lot of this very high margins across various sectors have come to some extent because of supply chains being scrambled up, both globally and on the domestic front. To some extent, premiumization, and to some extent owing to cost efficiencies. If you look at the study on the previous sectors, which saw very high margins in the very early stage of demand recovery, those did not sustain. Whether you look at QSR, whether you look at durables in the early stages, whether you look at chemicals, whether you look at metals, eventually supply catches up, and very high margins are very difficult to sustain unless demand revives in a very meaningful manner. So while people are hopeful that these margins sustain at such record levels, but if you go by the experience that we've seen in other sectors, generally all these sectors have had very good margins and profit tailwinds lasting anywhere between 4 to 8 quarters. Eventually, then supply catches up, and if demand is not very supportive, which unfortunately has been the case in most sectors, margins eventually cool down, weighing on multiples and stock returns per se, Neeraj. So I think the main critical driver for these margins to sustain is going to be demand, which right now is somewhat on the weaker footing, is what I would say, Neeraj.
Okay. Prateek, is that your belief for markets at large too? Because a lot of people say that while the FI flows are also the liquidity factor, but Indian growth was probably one key reason why you've seen what's happening in Q2 and Q3 and the resultant impact on the markets. And if growth were to come back, things will change. So what's your view of the current correction? Is this the level where you tell your institutional clients to go out and start nibbling, or would you tell them to wait for a bit?
Yeah. So I think, Neeraj, if you look at the main reason for the correction that we have seen in last 2-3 quarters is the weakening of earnings. If you look at the earnings per se, in F24, we had 8% top line growth, but 20% plus profit growth. We outpaced emerging market earnings by a mile. Emerging market earnings were very weak to contractionary. But what has happened in F25 is that the margin expansion has stalled. I mean, mind you, margins are still holding up at very high levels. But given that the expansion has stalled, the profit growth and top line growth have reconciled, both to single digits. And at the same time, emerging market earnings, owing to a very low base, have also come back. So in some sense, what has happened is that India's earnings premium has condensed very significantly. And as a result, the valuation premiums too have come lower. Because if you look at the last 6 months, the entire correction is more an India-specific phenomena rather than a global phenomena. Emerging markets, if anything, have actually moved up by 10 to 15% in last 6 months at the same time where India has actually corrected. This is exact reverse of what happened in 2023 and 2024. So in some sense, a reconciliation is taking place. To a reasonable extent, I would say that the India-specific reconciliation has somewhat played out. The global uncertainty and the global risk, I think those are yet to be priced in by the markets, is what I would say, per se, Neeraj. With regards to what we are telling clients from a market standpoint, have valuation compressed enough for us to go out and buy lock, stock, and barrel? Answer is probably no. If you look at it, valuations on various metrics, whether you look at market cap to GDP, price to earnings, price to book, for the broader market, they are still anywhere between half to one standard deviation plus expensive. At a time where earnings growth is weakening and there is a very serious risk to the very high margins. So to that extent, we are still somewhat on the cautious side. Having said that, we certainly do see opportunities emerging in a few spaces. The most interesting space to us at this point is the banking space in India. The simple reason is that while there as well, the growth concerns remain, but at least the regulatory aspects are getting better. And more importantly, valuations there are quite comfortable and are not really pricing in a big growth recovery of sorts per se, Neeraj. So overall, from a market standpoint, yes, it's still not yet reached a place which is very comforting to us. But there are certainly a lot of pockets where we think the worst is behind and probably it's worth accumulating some of those spaces per se, Neeraj.
Hi, Prateek, Tamanna here. Interesting take on BFSI, and I just wonder, as a call right now, and clearly no one is, I think, going to advise to come in lock, stock and barrel, but as a call right now, if there was to be some cherry picking to do, would NBFCs, the nature of Bajaj Finance, etc., be there up on your list, or would you stick to large private sector banks? Where are you veering?
Yeah. That's a good question, Tamanna. So I think at the current juncture, I'm more comfortable with the large private sector banks because there I feel as well, they took a lot of brunt of regulatory actions. Valuations there are much cheaper. And most importantly, the risk of credit cost rising substantially is somewhat lower. NBFCs too, incremental actions are turning positive, but I think I would still wait for some time over there before getting comfortable. But within NBFCs as well, there are spaces where value seems to be emerging, like gold loan financiers, some selective rural financiers as well. But I think the bigger delta or comfort as of now lies more in the large private banks, Tamanna.
So large private banks is one space that you could look at. What are the other sectors that seem to have some upside left right now, Prateek, or maybe some potential here? Are you looking at IT favorably at all? Because the core of what was moving IT, say 2 months ago with the Trump administration, etc., has not necessarily changed.
Yeah. So I think we were actually quite overweight IT in 2023 and 24, and that's added a lot of alpha to our portfolio. We've recently turned from overweight to neutral on IT, honestly, Tamanna. And our main point is that the valuations there have reached post-COVID peak, whereas the growth is still quite soft. So I think to some extent, valuations have run ahead of themselves. Growth uncertainties remain. And to that extent, IT is not the most comforting right now. The other pockets of value that we see emerging are probably in the QSR space, where we think the record low margins is leading to cost efficiencies and improvement in SSGs, and in the chemical space, where at least we think that the worst of the cycle is behind. So our framework right now, in a world where demand is uncertain, there are many disruptive forces at play, is to look at sectors where profit margins are closer to the bottom and valuations are somewhat reasonable or stocks have underperformed, Tamanna. And on that framework, I think private banks, insurance, some NBFCs, QSR, chemicals, these are the spaces that we think fit the bill, and we are more comfortable in those areas per se.
Why chemicals? I mean, I was also hoping, or the hypothesis may have been that Q3 will see decent performance, except for 2 or 3 names. It was a bit of a damp squib, really, in terms of performance in Q3. So, is it very, very bottom up in chemicals, or is it top down?
So I think it's a combination of both, Neeraj, I would say. I think the chemicals, the main story is that the worst of demand headwinds and price erosion is behind. Second, over there, a lot of these companies had done a lot of capex in F21, F22, and F23, seeing very high prices. The worst of the capex cycle is behind. And in a lot of stocks within the chemicals baskets, they have meaningfully underperformed. Now, valuations there also are not as cheap as one would probably love to have. But nonetheless, at least we think the worst of earnings headwinds in this space is behind. And given the underperformance, we feel that on a relative basis, at least, this is a space where one should look to accumulate on every dip per se, Neeraj.
A little, I don't know, thought came to my mind, Prateek, because the whole rage about platform companies, etc., seems to have sort of died down. I'm just wondering if that is one space that you're still seeing a further upside, or is that now a trend that is behind us for some time?
Yeah, again, I think that's depends on the micro factors and depends from one platform company to other. The rage on platform companies has died down because they are again entering into the whole entering new spaces which will warrant cash burn or competitive intensity per se, Tamanna. But at least I feel that on a relative basis, that's a space that one should look to accumulate, because these companies have demonstrated that even if there is cash burn, the profitability swings are also wide when the consolidation happens. And while there has been correction over there, at least that's a space that from here on incrementally looks a bit more attractive on a relative basis. But here as well, I think one needs to be more bottoms up in stock picking, depending on which platform company is in which stage of competitive intensity cycle per se, Tamanna.
Swiggy is in what stage in your view in terms of further upside?
So see, I think I won't comment on any particular stock, but I think clearly QSR as a segment is one place where competitive intensity is still on the rise. We don't see the signs ebbing over there. So to that extent, the profit forecast or the profitability focus which Street is having right now, I think could get disappointed. So maybe perhaps when these companies end their market share or the land grab phase and move more towards profit making phase, a trend that we saw in food delivery probably a couple of years back, that's where I think the maximum delta will come in these companies per se, Tamanna.
All right. Thank you so much, Prateek, for joining in. Always a pleasure to speak with you. Now, time for a very quick break. On the other side, we speak with Umesh Chaudhary of Titagarh Wagons about their growth plans going ahead. Stay tuned.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every anlom, you have to have vilom. You can't just keep doing up and up in the trading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
भाषण सुना उसके बाद मेरा पहला एक्रोनिम निकाला मैंने, वो था RRR, रिस्पॉन्सिव, रिस्पॉन्सिबल, रिफॉर्मिस्ट, और मैंने कहा रिवॉल्यूशनरी। हाउ डिड यू अराइव एट दिस नंबर ऑफ 12 लाख रुपीस?
हमें लगता है टैक्स पेयर उस लेवल नंबर से टैक्स भर रहा है, क्या उनको हम कुछ कर सकते हैं?
प्राइवेट सेक्टर कैपेक्स अभी तक वो इन्वेस्ट क्यों नहीं कर रहे हैं, जबकि आपका इकोनॉमिक सर्वे ही बताता है कि वो कैश पाइल पे बैठे हुए हैं।
अगर कंजम्पशन बढ़ता और उसके तहत लगता है कि ग्रेटर इन्वेस्टमेंट का पॉसिबिलिटी है, वो भी अच्छा ट्रिगर हो सकता है।
AI बहुत तेजी से आ रहा है, तो जॉब के चैलेंजेस होंगे, स्किल के चैलेंज पहले से हैं, तो जो ट्रांजिशन पीरियड का स्ट्रगल है, नौकरी मुझे अभी चाहिए।
पूरे साल का एक्सपोजर
Welcome back. Quick look at the markets, and yeah, you are seeing a bit of pain in the system creeping in. Not as much as for cable and wire businesses today. Nifty completely flat right now, but in the red. I would pull up the mid-cap index, the small-cap index for you just for a second to give you a sense of what's happening there and where markets are right now. The red, the losses deepening as far as the mid-cap 150 is concerned. So 0.75% down, Nifty small-cap 1% down. So you're having one of those mornings where you are once again seeing pain in the market apart from specific pockets. And those pockets are clearly non-banking financial companies. So just to recap this for you very quickly and give you a sense, the Reserve Bank of India has given some very important relief to non-banking financial companies. That's why you're seeing a Bajaj Finance up about 2%. In fact, let's pull up the Bank Nifty as well to give you a sense about where that green is coming from. Bandhan Bank, Credit Access Grameen, these are NBFCs which had huge exposure to microfinance loans. In November 2023, the Reserve Bank of India had actually come down and clamped down on these in terms of the kind of funding NBFCs could get from banks. Some relief has come in today, which is why you're seeing some green, at least in this space. Now, what are brokerages saying about this after the Reserve Bank has lowered risk weight of bank loans to NBFCs to 100% from 125%? That fresh circular has given a fillip. Puneet joining in for more on what the brokerage view is.
Well, thanks for that. So 3 key brokerage notes that are in focus on the back of this RBI measure. The first one is, of course, Macquarie. They believe that, the big message from RBI is essentially, a more accommodative stance, which bodes well for all these companies. And they feel that this will be good for the financial sector to re-rate from this point forward as well, something that's been their view for the longest time as well. They believe that the unsecured loan growth has slowed down from the 25% odd levels to 10% now in this particular quarter. And, during this period, it has now reduced as mentioned. So effectively, that kind of leverage has also come down a bit. They believe in due course, banks should see a benefit of about 20 basis points to all the way up to 250 basis point of a positive impact on the CET1 ratio specifically. They see that IndusInd as well as Bandhan Bank could be one of the biggest beneficiaries, and the stock price is also reflective of the same. And they finally see that they're expecting some reduction in terms of interest rates as well on selective basis for well-rated NBFCs. So watch out for this one. The other one, CLSA. Now, you mentioned about the title at the start of the show, of course. So, after they mentioned that, it's clearly good things are happening for the sector, and they see that, the biggest beneficiary of MFI risk weight will be Bandhan Bank. And finally, on Morgan Stanley as well, the last one, they mentioned that, business MFI loans can stay at roughly about 75% in terms of risk weight, and if regulatory conditions are met, and that's something that they are watching out for. They are expecting a little
Away
lower.
from what CLSA is saying, yes, they're saying good, but it's a full dialogue that CLSA has put out when describing what the RBI circular means for financials. This is जब ऊपर वाला देता है तो छप्पड़ फाड़ के देता है. So that describes how bullish they are.
Yes, definitely, and I think one day I'll be able to say that on air with that kind of confidence, but that day is not today. So just finishing on Morgan Stanley, I think they see mid-sized private banks as well as, should get higher benefit going forward as well. But yeah, that's the summary of those 3 brokerage reports on the RBI impact.
Okay, so which is why you're seeing some interesting moves there. Not really Kotak Mahindra Bank. We're flashing Kotak Mahindra Bank, but frankly, Kotak Mahindra Bank didn't have that much of a pain point in terms of exposure to smaller sized loans, which had higher credit risk. I would say an IndusInd Bank more on that note. But 2 big stories this morning dominating the market. One is what's happening with NBFCs and financials. The other is what's happening with cables and wires. And Ultratech, a cement company's foray into the cable and wires space. The street has not liked it, nearly 5% down right now. The cement maker is going to spend about 1,800 crores for its first factory setup in Gujarat in 2026. But why is it under pressure? What are the concerns on diversification? Mihika joins us for more.
It's an 1,800 crore investment. You're right about that. Over the next 2 years, they're planning a plant in Gujarat. But the question lies if Birla Group as a whole is over-diversifying. In terms of your past ventures, they did announce India jewelry ban. They were going to invest close to 5,000 crores and open 100 stores in the next 18 months. And they aim to make it one of the top 3 jewelry retailers in India within 5 years. Another one was Birla Opus. We've spoken a lot about it. It's the paint brand. They announced its entry in 2021 and launched products in 2024. And the company does target 10,000 crore revenues and to turn net profit positive in FY28. And the Birla Group as a whole is already in a battle in 2 segments. One is a telecom with Bharti Airtel and Reliance Jio, and in the apparel segment as well with Reliance, Trent and Shopper Stop. Now, what was common, Grasim, in the paint industry and what helped, and you saw kind of pressure on other paint companies, is that the distribution network of Birla White and Birla Wall Care Putty, and around 70% of its dealers also sold paints, which helped Birla Opus and made the dealership reach second when you compare it to Asian Paints. But when you compare Ultratech and whether it has anything common with the wire and cable industry, the simple answer right now is no. They have negligible synergies in terms of stuff like raw material sourcing, distribution, as well as transportation. And the influencers are also different. In cables and wires, it is electricians, whereas in cement, it is contractors, and neither cement dealers sell wires as well as cables. In terms of what could go wrong, well, amongst wires and cables is growing faster. One is because of higher demand from sectors like power, data centers, and other infrastructure projects. But on the flip side, cables do take 2.5 years in terms of product development, manufacturing, and other things. For wires, on the other hand, the time to enter the market is low, and some analysts do believe that because of Ultratech's better brand recall, it would help. Lastly, potential financial impact. I'll just go through over that. 1,800 crore capex has been announced. An assumed 4.5x asset turnover gives a revenue potential of 8,100 crores at a 10% EBITDA margin, 810 crore EBITDA level, which is 4% of the FY27 consensus estimates. But there is investor concerns about the capex allocations that brokerages have been citing.
Okay, well, that's a stock that's the top draw today in terms of the downtakes from the large cap space, down 5%. Now, India's budget airline flew back to positive territory, earning a profit of 25 crores, but the stock is down, of course, 5% in trade. Mahima Johnson with the key highlights of the earnings. And Mahima, as much as what matters to SpiceJet is what happens in quarter 4, but clearly the numbers seem to have played the part today.
Right. So, in terms of the key highlights of the earnings, well, there was an improvement of around 18% in available seat kilometers. The company has turned profitable, but this is because of one-off other income. In terms of the revenue passenger per kilometer rose by around 23% quarter on quarter, and passenger load factor also has risen to 84% from 81% QOQ. Lastly, cost per available seat kilometers also improved QOQ. So, operational metrics in terms of SpiceJet are improving. It came out with both its Q2 as well as Q3 earnings because Q2 earnings were pending to be reported. In terms of Q2 earnings, revenue was down by 36%. EBITDA lost to 210 crore and net loss stood at around 442 crores. But Q3 revenue was down by about 35%. EBITDA stood at 85 crore, margin stood at 6.9 and net profit at 25 odd crores. And this is of course because of a one-off rise in other income. This other income stood at around 419 crore, and this was this other income came along from restructuring of lease obligations with lessors. Now, in terms of a report on SpiceJet on the back of earnings, INCRED says that it believes that a scale up of its operations could reduce FY26 reduce in FY26. The company will be able to retain the entire benefits of the reduction in overall cost per available seat kilometer, and they have factored in that SpiceJet's entire fleet will be operational by FY26. In terms of QIP utilizations, overall 3,000 crore was raised, out of which 2,400 has been utilized. Out of which 600 odd crores have been utilized to pay off GST, TDS as well as EPF dues, and around 1,200 odd crores have been used to settle the disputes with aircraft lessors, and the claim was around 1,700 odd crores. Lastly, auditors of course have continued to flag off the going concern which is in danger, but management is of the view that the accounting needs to be done on going concern basis, and it's appropriate accompanying the company statement. So both the views are contradicting, but this has been the case for SpiceJet since last year as well.
Okay, so SpiceJet, after that initial bump up in the pre-open session, now about 5% down. So those concerns still remain. But Mahima, another story that you're tracking this morning, spotlight on Jubilant FoodWorks, as they're set to host their maiden analyst meet today. Why is this important?
Right, so this is going to be the first physical analyst meet for Jubilant FoodWorks, and in terms of context, Q3 performance has been good for the company. There was a strong pickup in growth, same-store sales growth was in double digits, and delivery segment grew better than the food aggregators like Zomato and Swiggy. Now, in terms of what to expect, two brokerage notes have come out. Jefferies has listed out a set of things that they are expecting to hear from the management. First one being the overall industry is facing an urban slowdown, but QSR industry has seen a noticeable pickup. What is leading to that growth? Secondly, industry trends and outlook for demand environment for QSR as a whole. Thirdly, what is kind of ailing the dine-in sales? Then they also want a view with respect to the delivery charge, because they've so far Jubilant FoodWorks have waived off the delivery charge considering the competition that is coming on from Zomato and Swiggy, and of course the sequential impact on the margins. Also a view on aggregators like Zomato and Swiggy. In terms of expectations from DP Eurasia, which was their recent acquisition, because they reported weak profitability in Q3. Popeyes, they are eyeing guidance from a medium-term outlook. In terms of an update along with an outlook on brands like Hong's Kitchen as well as Dunkin', and any plans to add new brand in the medium term is something to watch out for. Macquarie is also seeking clarity on India EBITDA margin trend, Domino's sales store, and of course the sales store count trends and operating metrics overall for Popeyes. They're saying that how digital strength can be used in dining, cost controls and discounting from aggregator platforms is something to watch out for, and the pace of margin expansion is something to look out for. And lastly, they look to understand as to how Jubilant will balance growth, investments and margins overall going forward. So these are the expectations and the questions that need to be asked today in the first physical analyst meet that Jubilant Foods is hosting.
Okay, thanks for that, Mahima. Now, Morgan Stanley's got a note on Titagarh. They've cut the target price but maintained the overweight. Anushi Johnson with the detailed note. Anushi.
Right. So if you look at what Morgan Stanley has done, they've maintained the overweight rating as you've mentioned, but they've cut the target price to 1,090 as compared to 1,300, which implies about a 16% of a cut to the target price they've given. A couple of concerns they've cited out. Firstly, on the near-term execution challenges that the business might face, which can affect the revenue trajectory going forward. And this mainly pertains to their freight rail segment. Again, despite being one of the major beneficiaries of the rail capex, which is there, do note that we have about a 2.65 trillion of budget allocation for railways, which was unchanged from last year. Ordering so far has remained weak. In the 9-month period, there were expectations from H2 onwards that there would be pickup in orders, but this is not translated to what the actual reality is. So industry's outlook is also somewhat of a concern going forward. Along with this, in the conference call, the management had also cited out about the inadequate wheel sets from Indian Railways, which may constrain the Q3 offtake going forward. Along with that, execution in the Vande Bharat is also something which has been delayed 9 months by a change in their car design plan, which was there. So because of these couple of factors, they have now also revised their EPS forecast and the PE multiples, because of which we are looking at the cut in the target price to 1,090 as compared to 1,300 earlier.
Okay, so that's the focus on Titagarh, Morgan Stanley on Titagarh. But let's also look at SRF this morning. The stock is buzzing up about 3% after MK released a note saying they're positive on the stock and maintain the buy rating. Why is that, Rucha?
Yes, so MK has maintained a buy rating on SRF. It has given it a target price of 3,250 rupees with an upside of 17.5%, and that is why the stock is in the green right now. Now it says that the worst is behind for SRF for all of its own businesses, and they also expect growth to coming, and this growth will largely be driven by stabilization of existing products as well as incremental contribution from newer products. So a healthy kind of product mix over here is what they expect. Now in terms of the specialty chemicals, they see a pickup, but this pickup would be gradual in nature, and they also expect firming up of refrigerant gas prices globally and expect improvement in packaging films businesses as well. So largely in terms of all the businesses, they expect growth to come in and also with a decent margin, and the company and the brokerage house believes that the company is best placed with capital expenditure ready in terms of the specialty chemicals business, which could support the gradual growth recovery over here. And in terms of agrochemicals business, this one should also aid the growth based on improving refrigerant prices globally, and that is why they have around 17.5% upside over here. Let's look at the stock price movement over the last 6 months. 11% for over the last 6 months is what SRF has given in terms of returns, and 19% over the last 1 year. So not exponential returns over here, but yes, a picture from now on seems to be really good according to MK.
Okay, thank you for that. I just want to pull up Paytm very quickly before we move to our next conversation. The Paytm stock, they've just issued a press release that they're signing in with Perplexity AI to integrate AI on their platform. Stock's not doing much this morning, just about 0.5% down, but interesting innovation there. Everyone wants a AI search engine going on every platform, and Paytm is no different. But let's start the conversation with Shreyas this morning. Shreyas Devalkar, Head of Equity at Axis AMC, joining in. Shreyas, a pleasure as always to speak with you on the channel. Thank you so much for your time this morning. Do you reckon that we'll get over these Q3 blues anytime soon? Let me start with a simple and basic question.
See, as far as earnings are concerned, I don't think it is only about Q3. So the indications were there in Q1, Q2 results as well. Probably for some reasons, market at that point in time ignored. So markets tried to focus it even from September. So if you see, market started correcting from September. As far as these earnings are concerned, the top line growth slowdown was observed even in last year. It's just that the margins were really good in some of the sectors, and that has led to good bottom line growth. But after Q2, Q3 especially, that margin lever also actually tried to reverse in some cases. And that's where these earning growth blues probably are hurting the market more now versus earlier.
Shreyas, good morning. Now, the opinion is divided right down the middle, right? This is Neeraj here, of course. The opinion is divided right down the middle about whether these valuations prompt people to be constructive on India, or should lower growth entail India trading below average valuations as well? And I'm only talking large caps. I mean, the SMIDs are, of course, still higher. Where do you stand on this argument?
It's a very interesting point, and there are multiple angles to it, and that's where I would like to get into the details of it. Because when we say large cap, and if I go by definition, it is top 100 stocks, right? You will notice that actually in this fall, top 50 stocks, that is Nifty, has fallen lesser than next 50. So the story is different in Nifty 50, the story is different in Nifty next 50, which is also top 100 on large cap. And that has fallen equivalent to mid and small. So to put it in a different way, when it comes to the valuation, the market has divided into, or got divided by September, market got divided into two halves. First half was relatively low growth companies. Okay. And those low growth companies are utilities or they were in lenders, banking, financial, insurance, FMCG, consumer durable, auto, IT, pharma, metal mining, oil and gas, entire pack, agri, infra, cement. Actually, these sectors didn't get re-rated the way other part of the market got re-rated. So I would call it as a relatively low growth and relatively lesser re-rated, or actually some of them got de-rated. Coincidentally, the weightages of this is more in the large cap, that is Nifty 50. If you take Nifty, if you take BSE 100, then the weightage of this is somewhere around 70%. And this segment of the market is actually relatively derated because, or not got much rated because there is lack of growth, and that was visible for last multiple months, or actually multiple years. So actually this market was about stock picking for last 2-3 years. Now actually it is getting into this balance of carrying low growth risk with low valuation, or carrying high valuation risk with high growth. So which are the sectors which has shown high growth and are promising, which has shown promise of showing high growth, is power, capital goods, electronic manufacturing services, EV, import substitution stories, platforms like quick commerce, fintech, capital marketplace, travel tourism on the consumption side, retail industry, part of chemical, hospitals, and real estate. So these are the high growth segment, and market has identified them. So that's why I call it out that this market is actually the stock pickers market is behind. Market has picked stocks for you in last 2-3 years by classifying them as a high growth but low, but with very high valuation, and low growth with derated or not much related.
Got it.
So as a portfolio manager, we need to balance these two rather than talking about large versus mid and small. I agree with the fact that yes, coincidentally, most of these derated are not much rated are in the large cap versus mid and small.
That's the point. And the other point, Shreyas, sorry. So, let me try and take an example of some of the pockets, right? I mean, power, for example, let's say and include transformer companies. And I'm saying that as an example because just speaking to one company half an hour before you joined us, right? And that company, I mean, you can't talk about names, but I'm just using that as an example, that Transformers and Rectifiers says that we will continue to grow at the pace that we are. But Shreyas, my question is, with those numbers, the stock after having corrected is trading at let's say circa 25 times FY27. Now, would you call 25 times under the current context 2 years out expensive, or do you believe businesses which are trading at such valuations or higher but promising very high growth are worth buying into? I'm just using this as an example, but a broad brush essentially. That's the question.
Sure. Yeah. So good that you used or posed your question with an example. But my answer is broad-based. So that is not only about transformer. That happens to your electronic manufacturing services sector, also import substitution stories as well, travel tourism and multiple such stories. Now that's where I am highlighting the point that some of this re-rating, which is some of these sectors which used to get traded at 10, 15, 20p, with growth, low debt, we said that yes, as a market, everyone said that now with lower debt, corporate India has less debt, etc., etc. Now they, instead of 15p, they deserve 20, then 25, then 30 and 35 and so on. And then what is that limit where you say enough is enough? Probably market reached that limit by September, and then now it is reversing from those. And that's where, in some cases, I would argue that yes, the market is getting to the level that one can look at them constructively, because valuations are, if not attractive or mouthwatering, they are reasonable. That is probably the word I was used rather than calling out them attractive as such. But then those pockets are far and few. And that's where when anyone is taking such a call that yes, whether I should buy blanket all the 4 stocks which are fallen by 30%, then to me that that conclusion is not true for all of them, which has fallen by 30%. So expecting that all the stocks which has come down from 45p to 35p to go back to 45 and make money may not be right. But yes, some of them, if they don't go back to say 45, but at the current growth rate, they can give us return. And that's where at the overall level, probably these pockets where you can call out that yes, now the valuations are good. Those are emerging, but they are still not to the extent one can call out that there can be a broad-based rally as such.
I'm just wondering, Shreyas, what you're making of NBFCs post the relief that has come from the RBI circular. And do you think it is a very fundamental shift in how you would view some of these companies, or is it more in the nature of a temporary relief?
See, as far as NBFCs are concerned, for some of these steps which regulators took probably in 2023, somewhere close to November. So partly it is a reversal of that, or part reversal of those steps. And it is a really welcome move. Probably it leads to better liquidity for the sector and more lending in that scenario. But if you just, instead of talking about only about what the steps taken recently, if you say the multiple steps taken, right, from liquidity improvement to all these steps as far as the risk weightages are concerned, overall the story is yes, with the proactive steps we actually the regulator took 1.5 years ago. And probably that was a really great step to take at that point in time. And with that step, probably we might have averted a problem in the retail credit, right? And now with that, at least in last 1 quarter or so, what we have observed in the listed companies result, at least that there is no, the credit quality is not worsening, at least, especially. And to that extent, since this trend, if it is continued, and then the regulator also have taken multiple steps. So with that, I think this sector can be good in that context. And other point which I also highlighted, that lenders actually as a pack, they have got derated or not much re-rated versus their valuation compared to the pre-COVID level. So generally what I tend to do is compare the valuation pre-COVID versus now, and check whether there is a re-rating, de-rating, and if there is a re-rating, whether it is 30% higher or it is a 50% or it is 2x higher. So just to take a case of IT sector. Now IT sector is probably 30% higher. They should trade at 18 types and now they are at 25, 26 type, right? So whether you are trading at 30% higher or whether companies are trading at 50%, 100%, 200% higher than the pre-COVID, the companies which are still trading at 100%, 200% higher compared to the pre-COVID, we need to really check and recheck whether that is justified or not.
Okay. I'm just wondering if you have a take on, and I know it's specific, but on cables and wires after the kind of turbulence we've seen with Ultratech announcing its entry, not done great shakes for Ultratech either, frankly, as far as the stock is concerned. But any take on this kind of expansion and the space?
This space broadly is around the 70,000 crore industry as such, doing well with the real estate sector doing well, and construction activities, including data center, etc., etc. So definitely this pack of cable and wires, and including to some extent conductors, where this entire industry is a proxy to a power growth story in India. So that space remains attractive. It has always remained attractive for the investors. Always in any case, so it's not only about this industry. In any case, obviously, whenever there is an entry of new player or so, then there is always cautiousness. So you have seen that in the paint sector earlier and so on. So whenever there is an entry of new player, then definitely all you have to rethink about how the industry will evolve. As far as industry is concerned, definitely there is a growth story. But as far as industry dynamics are concerned, that is competitive dynamics, that's how we'll shape the stock market return for us from here on.
Absolutely. Thank you so much for that, Shreyas. Speaking on some of the most current topics this morning as far as the market is concerned. But just even before we wrap, and thanks Shreyas for coming on the show, just want to tell you what's happening with cables and wires and this Motilal Oswal report that has downgraded the cable and wire companies. They've cut valuation multiples for all of the companies under their scope of coverage. They've cut valuation multiples for Polycab, KEI and RR Kabel by 20%. I mean, that's why you're seeing this bloodbath, nearly 15% down on KEI Industries right now, and I'm sure RR Kabel not doing too much better. They've downgraded the rating on KEI, RR Kabel to neutral from buy. Valuation multiples on Havells has been cut by about 10%, and they've maintained a buy. This is, I thought, interesting, a buy on Polycab India and a neutral on Havells. But pain far from over, Neeraj.
Yeah, most certainly. And Havells is clear by, I mean, just one aspect is cables and wires. The other aspects remain unhinged for the time being. But very interesting. And this remains the talking point of the day in addition to some of the financials. But it's a wrap for now on this leg of India Market Open. Thanks so much for tuning in. Up next is Ask Profit.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the trading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
भाषण सुना उसके बाद मेरा पहला एक्रोनिम निकाला मैंने, वो था RRR, रिस्पॉन्सिबल, रिफॉर्मिस्ट, और मैंने कहा रिवॉल्यूशनरी। हाउ डिड यू अराइव एट दिस नंबर ऑफ 12 लाख रुपीस?
हमें लगता है टैक्स पेयर उस लेवल नंबर से टैक्स भर रहा है, क्या उनको हम कुछ कर सकते हैं?
प्राइवेट सेक्टर कैपेक्स अभी तक वो इन्वेस्ट क्यों नहीं कर रहे हैं, जबकि आपका इकोनॉमिक सर्वे ही बताता है कि वो कैश पाइल पे बैठे हुए हैं।
अगर कंजम्पशन बढ़ता और उसके तहत लगता है कि ग्रेटर इन्वेस्टमेंट का पॉसिबिलिटी है, वो भी अच्छा ट्रिगर हो सकता है।
AI बहुत तेजी से आ रहा है, तो जॉब के चैलेंजेस होंगे, स्किल के चैलेंज पहले से हैं, तो जो ट्रांजिशन पीरियड का स्ट्रगल है, नौकरी मुझे अभी चाहिए।
पूरे साल का एक्सपोजर दिलाने के लिए हम इंटर्नशिप प्रोग्राम ले आए और इसके साथ साथ इस बजट में भी ट्रेनिंग फॉर AI इसके लिए सेंटर्स बनाए हैं।
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims?
Hi, thanks so much for joining in. You're watching Ask Profit on NDTV Profit. My name is Alex Matthew and with me is Mahima Vachrajani, and we will take you through the next 1 hour of trade. This show is geared towards getting all of your stock related questions answered. So whether they're short-term in nature or long-term fundamental, this is where you send your questions. And in fact, let's pull those numbers up on the screen for you. You can send your questions to us on the WhatsApp number that's there. Or you can send us or call us on the landline number that you see at the bottom of the screen. Let's take a look at where the markets are right now. And it's a bit of a continuation of what you've seen through the week. Weakness is what you see in the equity markets. Of course, you are more or less flat. Remember, this is where we ended Tuesday as well, flat, unchanged. We've dropped from the high point of the day. The pressure, the selling pressure is evident in the broader markets, and you're seeing quite a bit of that at this juncture. 0.8% lower for the mid-cap index, about 1% or so lower for the small cap index, as a result of which you have the market breadth that is tilted in favor of the declines. At the start of the day, you had metals that were outperforming. Let's see if that continues to be the case. Let's pull up the sectoral movers, and in fact, let's pull up all of the sectors and see what is moving in trade. You have the private banks that have now taken charge, and we'll talk about why in just a bit. I'm sure you're already familiar with some of the regulatory changes that have been announced, but the finance pack as a whole seems to be the only pocket of strength in trade today. And of course, two major talking points, we'll be talking about them with our experts as well. One is Ultratech Cement getting into the wiring and cables business, and that is proven to be a problem for the wires and cables companies. They've all gotten their wires tangled up. Let's pull up some of those names. Polycab down very substantially. KEI losing quite a bit of ground. Ultratech as well, by the way, losing ground because the street not really very happy with the allocation of resources that seems to be the plan. You have RR Kabil that is down, all of them down over 10%. And in fact, analysts saying that this is not necessarily an opportunity for you to buy. We'll find out what our experts have to say. But the other group, of course, is the finance pack. They're all doing well because the risk weights for banks to lend to non-banking financial companies has been cut with effect from the 1st of April upcoming from 125% to 100%. This will effectively make loans to non-banking finance companies from banks cheap. What you need to understand is that banks lend, yes, but they lend to non-banking financial companies who further on lend to other customers. And so if loans are becoming cheaper from banks to NBFCs, they will eventually become cheaper for everybody else as well, those that NBFCs are lending to. So a lot of these companies in the NBFC space as well as small banks are reacting positively to the news. But there's one stock that you should keep on your radar, and that's Jubilant FoodWorks. It is or has done or will soon be doing its first in-person meeting with analysts. You've been tracking this very closely, Mahima. The investor presentation is out. What does it say?
Right. So the investor presentation is just out, and they've given certain guidance, which needs to be definitely highlighted. A couple of points. They've said that they are set to open 5 new food platforms in the coming year. What they've said is that the store count by FY28 will reach to 3,000. They're saying that overall total town network will go to 700 by FY28. They're targeting brand power growth in the Gen Z segment by around 500 basis points. They aim to double their revenue and profit CAGR. So the CAGR will be in double digit, and a 200 basis points margin improvement by FY28. And they see around 3,000 plus Domino stores, as I mentioned earlier. They've also said that they are aiming to build platforms, and the platform revenue, that is their online sales revenue, will touch around 1,000 crores, and this will happen along with scaling up their digital platforms overall. Free cash flow maximization is something that they're aiming at. And lastly, in terms of profit as well as revenue CAGR, they expect a double-digit CAGR going ahead. So this is the overall picture as to how Jubilant FoodWorks is planning to scale up their business. And of course, the physical analyst meet will answer certain questions like, how competition is faring in terms of Zomato versus Swiggy. Although their overall growth, that is their gross order value growth, was better than these food aggregators, of course on the back of a lower base. But certain questions like Popeye growth, how DP Eurasia, the recent acquisition, is doing, is something to be watched out for in the physical analyst meet.
I also want to know about how they're contending with competition from the unlisted space. A lot of small players coming into the space, at least here in Mumbai. Right, the unorganized space, right? So, by the way, before we go to our experts, we should also mark Ultratech Cement and the implications of its announcement of 1,800 crore venture into the wires and cable space. Is not something that will take off immediately. Of course, capacity will have to be set up, but it has had an implication for the rest of the cables and wires companies right now, and you're seeing that on the screen. Apologies. Let's bring in Mika to tell you about what the announcement is and why some of these stocks are reacting so negatively. Mika?
The main trigger is an 1,800 crore capex plan that has actually led to around 30,000 market cap loss for Ultratech and the top 3 cables and wires business. Now the company has announced a capex plan to enter the wire cables business, and they're going to build a plant in Gujarat. But it depends on whether they enter cables or wires. For cables, it's better demand, it's been growing. However, it takes 2 to 2.5 years for product development, a lot of client approvals in place. But wires is a better segment to enter for new players, but it's seeing slow growth. Now, if Ultratech has an advantage or not, well, there's negligible synergies in terms of raw material sourcing, transportation, distribution. It also has different influencers. Wires is distributed via electrician point of contact, cement via contractors, and there's no right to win strategy in terms of manufacturing and distribution. Brokerages have also cited concerns for Ultratech in terms of how it could hurt its positioning as a pure play cement player, and concerns around its capital allocation. And then you have the cable and wire companies under pressure: Polycab India, RR Cable, KEI Industry, Havells India, Finolex Cables. All of them are under pressure. Now, Ultratech's 1800 crore investment is 22% of the total gross block of the top 7 listed players in India, and gross block is the total value of a company's investments in fixed assets before depreciation. And Ultratech's entry in this industry may first hurt the industry EBITDA pool, just like we saw in paints. Margin contraction is likely. Analysts are also saying there's a potential for a price war, and there could be an inorganic opportunity for faster expansion, and this possibility can't be ruled out. Lastly, we have Motilal Oswal has cut the valuation multiples for Polycab India, KEI Industries, RR Cable by 20%, for Havells by 10%, and they've also downgraded the ratings on KEI Industry, RR Cable to a neutral from a buy earlier, while they maintained their buy on Polycab and neutral on Havells.
All right, thank you so much, Mihika, for giving us all those details. But with that, let's welcome in our guest for the day. Vinit Bolinjkar from HR Ventura Securities is joining us now, and Akshay P. Bhagwat, Senior VP at JM Financials, is joining us now. Welcome to both of you, gentlemen, and sorry for keeping you waiting. Some important aspects needed to be addressed. And we also have our first caller lined up. Kanan from Chennai is calling in. Kanan, a very good morning to you. How can we help you?
Hi, very good morning to everyone. Yeah.
Good morning. Go ahead with your query. Yeah.
I'm holding 100 shares of Reliance Industries.
Okay.
I just bought a few days back. So I thought, the stock is just looking for the reversal zone.
Right.
But it seems like it is still falling down.
Right.
Yeah, I can hold this stock up to 2 years minimum.
Okay.
So I just want to know, I can accumulate this, but I just want to know which phase I can accumulate this stock, because it is still falling down.
Got it. Kanan, got your query. Vinith, I'll come to you quickly on this one. RIL is the counter. He's entered at 1235 levels, and he says he's a long-term investor and he can accumulate more. But what are the right levels to enter in is something that he wants to know. What's your view?
So, I think that, Reliance is an index stock, and it is going to fall in line with the market, and it will outperform the market to that extent. So, you will see a fall which is lower than the market, and you should accumulate this stock somewhere time-wise around the 15th to 25th of March. The reason for this is that, a lot of tax selling will happen in the coming days. People will be adjusting their books, and in that, there's absence in the market. So that would be a good time point to buy that stock. And on a price-wise basis, I think anywhere between 1150 and 1125 would be a good level to average your purchase.
Interesting perspective. Would you stretch that to any other counters, Vinith? And just to clarify, you're talking about people booking out capital losses before the end of the financial year, so that they can account for it in this year, and you can set that off, of course, capital losses over 8 financial years. So would you extend that thesis to any other names?
I think it would happen across the board. So wherever people are sitting on losses, they are going to book their loss. Because, if you are a new investor and a professional investor, you sitting on substantial losses. So you book your loss right now, and buy it at a lower level after a few days. And then, between April and August, we've seen over the last 3 years, this has been the pattern, where we've seen that the markets bottom out in late March, and they rally very strongly across April and May. So, and that rally will get further strength depending upon how the monsoon plays out and, how the international markets are. So I believe that, we will see a very strong rally play out in April, which will be a recovery rally. And, to take advantage of this tax selling, one should be buying strong fundamental stocks which outperform the market in the month of March.
And that's interesting perspective. I'm wondering whether our technical expert also agrees with the thesis and whether or not the bottom will be found in March. But let me go across to the first WhatsApp question today, and we've got a question on KNR Constructions. This is from Annamalai, who's writing in from Tamil Nadu, and he's bought 430 shares at a price of 317.8 or 9 rupees per share. Can he start buying more at these levels? The loss is considerable because he's bought at elevated levels, 317. The stock is currently at 225. On the technicals, Akshay, what's the view?
Good morning, Alex.
Good morning.
Technically, the setup is pretty negative. You have had last couple of months where there is a massive selling noted in the stock, right from 350 to 225 as it stands. And it doesn't stop here. Further downside till 200, 210 is in the making. So the suggestion is better take an exit in the stock and move over to some stocks where opportunity presents you for a greater return in the next reversal of the market.
Right, so that's the view coming in with respect to KNR Construction. We've got our next caller lined up. Murli from Bengaluru is calling us. Murli, a very good morning to you. How can we help you?
Very good morning to you. Yeah, I bought 200 shares of Lloyd Metals and Energy recently.
Okay.
At a price of 11.23.
Okay.
Considering their backward integration, mining boom expected.
Right.
And I thought I can hold for at least a year.
Right.
And the price has come down to 10.84 now. Whether I can average or hold it as it is. I have only 200 shares now.
Okay. So,
waiting for 1 year. 1 year I can.
1 year. Okay. So, you've studied the company fundamentally. So, I'll go to Vineet for this one. Vineet, what's the view with respect to Lloyds Metals?
So I would like to tell the subscriber that, he's got a very good company. They're expanding capacity very, very well, all through internal accruals. It is the only company in India which is not taking debt in the metal space and expanding, doing a capex of almost 20 to 25,000 crores over the next 4 to 5 years. So a lot of value addition coming in, moving in from manufacturing sponge iron and pellets to value-added products. So I would suggest this investor to hold on to this stock, not to panic. And at lower levels, you can average. Just understand one thing, that metal stocks can show very volatile trends. They've got very high volatility and they move vertically in both directions whenever they do. So the idea would be to, as I suggested earlier, that somewhere in the month of March, when you're seeing that the stocks are bottoming out, whatever be the price level, that is when he can look to average his stock.
Okay, so that's a comprehensive view on Lloyd Metal. VST Industries is the next counter that we're talking about, and we've got Sanjay Maitra, who's Moitra. I think that's the right pronunciation. Sanjay, please forgive me if I've got it wrong. Writing in from New Delhi. VST Industries is the name of the counter, and he's bought at levels of 390, wondering what to do for a 3-year time horizon. Should you hold or exit? And I will take it across to Akshay on this one. Akshay, it's a loss, and he's down about 12,000 rupees or thereabouts. What should he do? Should he average at the current price for the long term?
Technically the price structure is negative, and the way the prices are setting up, possibly 230, that's in the making. So if you're open to averaging, your time horizon is long term, then I think 230 is where you need to average it out. That is a massive support base for the stock, going by the last 5-6 years of history, and there is a good chance the stock will bounce from there. Overall, my expectation is the stock will stay in the range of 240 to 360. Buy at lower levels at the dips of around 230, 240, and look to close it around 350, 360. That's the advice I have for VST Industries.
Okay, all right. So that's what Akshay wants to say about VST Industries. Let's get our next caller on board. We've got Venkat Rao, who's calling us from Hyderabad. Hi, Venkat. How can we help you today?
Good morning, sir. This is Venkat from Hyderabad.
Yes.
1 year back, I bought HFCL shares in 150 rupees.
Okay.
So now it is trading at 85 levels or so.
84
shall I
levels, yeah.
hold it or shall I hold it or
Exit.
average it? Yeah, average it, exit it.
Yeah, what is the time frame that you have in mind, Venkat?
1 year, 2 years, 1 or 2 years.
1 or 2 years, okay. Vineet, fundamental coverage on HFCL, what would you do if you're incurring a loss right now? 150 level is a buy price.
I don't think you should be selling this stock right now. We've done some comprehensive work on the company. We had put a buy. It hit our stock price target of around 156. Now, it is selling off along with the other stocks. One of the reasons why the sell-off has been steep is that the company has not actually lived up to its statements where they said that they would be, doing a lot of defense work. Somewhere, these deals have got delayed. And, but keeping the potential of their business in mind and, the prospects of their fiber business, I think it is a very good buy at current pricing. But, the entire environment is so volatile that, taking no action on this stock would be the best way out. Just hold on to your stock and let this meltdown, play out.
So that's the view with respect to HFCL. But an interesting fact, Alex, one of our researcher had pulled out, March seasonality data for the past 10 years, and HFCL was the counter, which has given negative returns in 7 out of 10 years in March, and the average downtick in the stock was around 9.6%.
Wow, okay.
So just an interesting fact out there on HFCL. The next query that we have is on Oil India. Dr. K.N. Manikanta is holding around 140 shares of Oil India, and he wants to know whether he should hold at the current levels or accumulate. His average price is 480. He's not mentioned whether he wants a fundamental view or a technical view, but I'll take this query with you, Akshay. What are the charts looking like for Oil India?
Well, the charts are negative, but the point is that the prices are heavily oversold. This stock has had a one-way fall in the last 5 months, I think from 750 to 367 where it stands. So the probability of a recovery, since it is heavily oversold, looks very high. This recovery should ideally mature from the levels of 350 odd levels plus minus 20 odd points. So if you're open to averaging, those are the levels for, but really the last 5 months of selling doesn't augment well for the overall setup. So I'm looking only at a pullback rally, which as of now, the best case scenario looks like 450. So the advice is average at around 350 and try to look for exits around 450.
That's the view on Oil India. Reshma Bhatia is asking a question that I hope that somebody would ask, which allows me to go to Vineet on how you should play, if at all, the sharp drop in the prices of the wires and cables companies. And she's specifically asking about Finolex cables. But let me extend that, Vineet, to the rest of the counters. In conversations that we've so far had today, the suggestion was that before the entry of Ultratech, or the announcement of an entry by Ultratech, some of these companies had multiples that have changed over the past couple of years from 15 times forward to over 45 times or 40 times forward. And this is simply a reaction to a negative update for the sector as a whole. And after this drop, they're unlikely to rise very substantially because already the valuations were stretched. Do you also have that view? And would you buy into any of these names?
So, we always had a view that the valuations were quite expensive. Amongst all these, Polycab is one of the very strong contenders. And, however, we have to understand one thing that, look at the psyche of Ultratech as a group. So, Ultratech belongs to the Kumaramangalam group. They have entered into the innerwear industry through their retail format because Page Industries PEs were very high. The next thing that they did was to enter into this the paints industry, and we saw what happened to the paint industry. They had very high valuations which have come off. Companies have lost market share, and to defend market share they had to drop prices. So third thing, what is going to happen is that there can be a little bit of EBITDA pressure on Polycab and the rest of the group, given the fact that, the DNA of the Kumaramangalam group is cost consciousness. So they will drop prices. They are looking at a large capex of 1800 crores, which is about 22% of current market cap or current industry size. So they are looking for a 15 to 20% market share in the industry eventually. So until they don't get this market share, I don't think that the pricing will stabilize. So what we are going to see in these other stocks is their margins compress. There's going to be fierce war beating. But there's a very interesting angle to this also, is that I was talking to one of the companies, is that when the export potential is so bright, why don't you guys export? Because the margins in export are very good. So the volume share of exports has gone up to about 10% for the industry, and this industry can draw relief from the fact that exports can be a very big option. So the companies which drive exports will be able to protect their margins and move ahead.
Which ones would those be currently? You're saying 10% right now is exports, but is it the market leaders?
Yeah, across the board, average industry is about 10%. Okay. So the guys who have got a good coverage globally, have got a large share, will do well. So I think Polycab is one of the really strong companies, got a good brand. The other cables companies which establish their own brands, now they will do well. Diamond Cables is one who insulated into the higher end cables. That company could, probably go through the. See, Havels is, we are a little bit negative. Actually, we came out with a sell note because, over the 10-year period, their growth rates have been very choppy. They've not had a secular run like what Polycab has got. So I think one of the stocks which will suffer a lot is going to be Havels.
Understood. Okay. All right. Thanks for that comprehensive view on the cable stocks. Vineet, Akshay, do stay with us. We have to slip into a very quick break. On the other side, we'll start with Satyan's question. And it's an interesting one. Do stay tuned.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the trading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers, and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
भाषण सुना उसके बाद मेरा पहला एक्रोनिम निकाला मैंने, वो था RRR, रिस्पॉन्सिव, रिस्पॉन्सिबल, रिफॉर्मिस्ट, और मैंने कहा रिवॉल्यूशनरी। हाउ डिड यू अराइव एट दिस नंबर ऑफ 12 लाख रुपीस?
हमें लगता है टैक्स पेयर उस लेवल नंबर से टैक्स भर रहा है, क्या उनको हम कुछ कर सकते हैं?
प्राइवेट सेक्टर कैपेक्स अभी तक वो इन्वेस्ट क्यों नहीं कर रहे हैं, जबकि आपका इकोनॉमिक सर्वे ही बताता है कि वो कैश पाइल पे बैठे हुए हैं।
अगर कंजम्पशन बढ़ता और उसके तहत लगता है कि ग्रेटर इन्वेस्टमेंट का पॉसिबिलिटी है, वो भी अच्छा ट्रिगर हो सकता है।
AI बहुत तेजी से आ रहा है, तो जॉब के चैलेंजेस होंगे, स्किल के चैलेंज पहले से हैं, तो जो ट्रांजिशन पीरियड का स्ट्रगल है, नौकरी मुझे अभी चाहिए,
पूरे साल का एक्सपोजर दिलाने के लिए हम इंटर्नशिप प्रोग्राम ले आए और इसके साथ साथ इस बजट में भी ट्रेनिंग फॉर एआई इसके लिए सेंटर्स बनाए हैं।
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and
Welcome back. You're watching Ask Profit, a show that gets all your stock related queries answered, whether they're fundamental or technical. For viewers who are just tuning in, you can either call us or WhatsApp us on the number that's flashing on your screen to ask all your queries. We have our next caller lined up. Shweta from Hyderabad is calling in. Shweta, a very good morning to you. How can we help you?
Hi, good morning, Mahima.
Good morning.
My question is regarding Vijaya Diagnostics.
Okay.
And I have 90 shares bought at 1119.
Okay.
This share is showing huge volatility nowadays. One day it is increasing 15% and today it is down by again 10%.
Right.
So I want to know the fundamental view of this stock, and I would like to know whether I should average it at the current price or should I hold or exit.
All right. Got your question, Shweta. Vineet, I'll come to you. Vijaya Diagnostics is the counter. What's the view like?
They're good company. They have done very well in their micro market where they operate. But the valuations are a stretch, and we think that the stock can come off by another 10 to 15%. So I think a level of around 800, 825 would be a good level to average the stock.
Okay, all right. So that's the view on Vijaya Diagnostics. The next question is on BEML, and this is Satyan's question. He's writing in from Thrissur in Kerala. Akshay, this is for you specifically. Can it be bought at the current market price? And if so, what is the target that you would put on the stock?
First of all, the technical price outlook is negative. It is just that being heavily oversold, there's a probability of a respite rally or a bounce back. So if you're actually considering for buying, I would recommend the support at 2500 is a good level to buy. But buy from a short-term trading perspective, the probability of a bounce back from 2500 can see the stock recovering all the way till 2850. So that's more of a trading buy call. On the positional front, I think somewhere 2500 plus minus 40, 50 odd points, it can take a support, but really overall the counter is not that great. It has still a negative setup. So the best case for a respite rally from a slightly longer term holding perspective is 3250. That's the best case scenario I see right now going by the current data readings.
Okay. We've got our next caller. I believe it is Krishnan Nair. Is that right? Krishnan Nair from Delhi?
Yes, sir.
Hi, Krishnan. So you've messaged me as well. I had saved your question, but then you can ask it here. It's on GMDC, right? Please go ahead.
Yeah, I am holding around 6,241 shares of GMDC at a buy price of 405.
Okay.
That was bought, I think, sometime in July last year. And I bought it with a thought that this company is good in paying dividends, and also the earnings per share looked good to me at that time. And the dividend came in October, even though there was marginal loss of value. I thought it will pick up later. But now it seems slightly in a downward stretch. So what is the opinion on this? Should I average or should I exit?
Okay, so let me get this straight. The the thesis was that you wanted to buy this and keep it in your long-term portfolio, and you wanted it as a dividend play, correct?
Yeah.
Okay. Vineet, from that perspective, he's actually he's seeing quite a bit of capital erosion on this stock. What would you do with something like this if you're incurring this kind of a loss?
So, I would like to just tell the viewer that, whenever you buy a dividend-based stock and you buy it in a metal and mining company, you must be aware of the fact that, metals and mining, they've got very volatile trends because their prices move very swiftly and their values also change accordingly. He bought it at a point when the sector was booming, and now we are seeing a decline. So the decline is going to be steep in the stock. Having said that, since he is holding it since July, I would suggest him to continue to hold this stock. There is going to be more downside also, but around the levels of 160, 180 is where he can look to average. I am not suggesting a very recent price to buy because, as I told you, these stocks can have very sharp dips. And to, average out your portfolio truly on this stock, you must buy it when the hits are very deep.
All right, so that's the view with respect to GMDC. The next counter that we're talking about is Inox Wind. Amir is holding around 1,180 shares of Inox Wind, bought at 183 a piece, and he's sitting on a loss of 30,000 rupees. He wants to know whether he should hold or sell and book a loss at the current market price. Akshay, I'll come to you. He has a horizon of 6 months. What are the charts looking like, and what should he do?
Well, the charts are still negative, but the probability of a recovery from the levels of 7,950 to 8,000 zone looks high. So if you're open to averaging, I think 7,950 is a good level to average. You can expect a relief pullback rally from those levels, which can target around 10,000 to 10,500 in the best case scenario with a time horizon of a couple of months. So buy on dips and try to take an exit around 10,500. That's the view for Inox Wind Energy.
So that's the view with respect to Inox Wind. The next caller we have is from Chennai. Ramesh is calling in. Ramesh, very good morning to you. I believe you have a question on Jio Financial.
Yes, hi. Good morning, everyone.
Good morning.
Ramesh here from Chennai. So my question is about, like you said, Jio Financial Services, since Jio and Zomato is going to join a Nifty 50 in March 28.
Right.
So my question is, is it at the current level? Is it good to start accumulating this stock? And I'm just wondering, the fund houses, they'll just start selling that Britannia and Bharat Petroleum, which is going to exit from the Nifty 50, and they're just going to start buying this Zomato and Jio Financial Services. So can we see a sharp price hike in this share after March 28? So what I'm expecting is correct, or is it a right time to invest, or do we need to wait for some more time to start accumulating?
Got your question, Ramesh. Vineet, I'll quickly come to you on this one. Is his approach correct with respect to Jio Financials, or is it already baked in?
So, the thesis that the stock will do well because it is going to come into the index is fully well understood. But, my take is that Jio Finance, what is the business model? They've not been very specific about it. There is no roadmap to what they're going to be doing. Just because it is a Reliance company, do you want to buy it? And because it is coming in the index. So at best, what I can say is that Jio Financial will be a market underperformer until and unless the roadmap to its growth journey is made very specific by the company.
Okay, all right. I'm coming back to you, Vineet, on the next one, and it is on Philips Carbon Black, PCBL. Sumant from Hyderabad has already bought in at levels of 352, so he's in the green right now. It's one of the stocks that has gained about 5% over the last month, and I'm pretty sure that there's not too many that have gained in that time frame. He says that he's a long-term investor and he wants to know whether to continue to keep deploying in this counter, or should he hold on to what he already has? What's the view here?
So, buy on declines is what I will say. The company is very, very aggressively guided for 20,000 crore EBITDA 20,000 rupees EBITDA per ton, and which is very, very strong. And they're getting into specialized chemicals. Their value-added products is going up. Their water vertical is doing very well. So I believe that, the growth triggers are there. This company will do really well going ahead. But as I said, the buying this stock in this market is on declines and not getting courageous and going out and trying to buy false breakouts. It's best to buy these stocks when they dip down.
All right, so that's the view with respect to PCBL. We have our next caller lined up. Sundar Rajan from Chennai is calling us. A very good morning to you. I believe you have a query on Trent, if I'm not wrong.
Yeah. Good morning. My name is Sundar Rajan calling from Chennai.
Right.
I bought 60 shares of Trend, 6,400 rupees average price.
Right.
But it is price is coming down. Can I average it, or can I add some more units to average in the current price, or can I wait for some more time to add?
Right. What's the horizon looking like for you? Are you a long-term investor in Trent?
Yeah, I am long-term investor.
All right. So I'll take your question with Vineet. Vineet, he's sitting on a loss of around 92,000 odd rupees, and he wants to know whether he should accumulate more at the current levels, and he's a long-term investor. What's the view like for Trent?
Definitely accumulating the stock in piecemeals over a period of time would be the strategy to buy this stock. It has seen a stupendous rally from 3 digits to 5 digits, and it's correcting that now. While the fair value is on the higher side, around 57, 5800, buying these stocks, without catching a falling knife is the way to go. Let it bottom out. Stocks, when they bottom, they do make a, base formation, let the price stabilize. And once it stabilizes at a certain level, it is a good stock to buy into.
All right. This is an interesting question, and Arjuna Rao is asking it. Power Grid Corporation, he's not giving me his buy price, but he's saying that he's losing about 18% of value, and the stock is currently at 256 or thereabouts. Should you continue to hold? Akshay, on the charts, what's the view on this one? This is actually a counter that a lot of people had bought into, and perhaps also at elevated levels. Is there any sign that a bottom has been found?
Well, honestly, looking at the magnitude of selling which we had in the last month, it may take some more time to get a strong support zone. As of now, the current trading is suggesting that probably somewhere around 225 to 230 is the zone where the stock might potentially take a support and try to see some bounce back. So it's not a momentum-based stock. Clearly, buying on dips is what I would recommend. A lot of patience would be needed. Time would have to be given from an investment horizon, minimum 1 year. Then 230 odd levels is where you should look forward to averaging the stock.
All right, so that's the view with respect to Power Grid. We also have our next caller, Govinda from Odisha, is calling us. Govinda, very good morning to you. I believe आपकी query Waaree Energies पे है.
जी, good morning.
जी, good morning.
जी, मेरा एवरेज प्राइस है वारी एनर्जी का 2264 50 शेयर है.
ठीक है.
तो मैं होल्ड करूँ या सेल?
ठीक है, एंड ये लॉन्ग टर्म पर्सपेक्टिव से है, करेक्ट? जी, okay. Vineet, I'll quickly come to you. Waaree Energies is the counter. What's the view like?
I think one should put a hold on this stock because we believe that the renewable energy space is going to do really well going ahead. So would recommend to hold this stock at current levels.
Okay. But in your opinion, just a follow-up to that, Vineet, is this the best play in the renewable space, or would you say that there's a stronger play?
In the renewable space, I would go with Adani Green. And I'll give you the reason why, is that land is already bought. Okay, it is the best-in-class solar radiation land. Their projects are coming on stream at an aggressive pace. This year, their pace has been delayed slightly. But going ahead, the rollout is going to be very strong. So, I would rather go with the energy creators than the ancillary suppliers to these companies because, you have a 25-year window of clear profitability established.
All right. Standard disclaimer, of course, NDTV Profit is part of the NDTV Group, which is owned by Adani Group. All right, let's talk about Hero MotoCorp then. And we've got Avinash Meral, who's writing in from Indore, Madhya Pradesh, and asking about it. He's bought at levels of 4,967, which is very elevated. and he's wondering what the prospects are from this point. Vineet, I'm coming back to you. Apologies, I got a lot of names on my screen, so therefore I've mixed it up. But Vineet, I'm coming to you on this, right? So you're seeing a lot of interesting trends develop in that two-wheeler space, but most importantly from my perspective, and correct me if I'm wrong, you're waiting for resilience in the rural space to turn into significant volume growth for a company like Hero MotoCorp, which depends on that, right, in the commuter segment. What would you do? Would you hold on to Hero?
And definitely I'll hold on to Hero, because we believe that the need for transportation is very high. The infrastructure is playing out very well in the country, infrastructure development. Second thing is, what we are going to see one very important trend play out in the transportation space is that with the launch of Tesla, I believe that the inclination to buy a EV is going to be very high. So whether you're buying a Tesla or you're buying another car which is going to be an EV, or you're going to buy a two-wheeler which is electric, is going to be very high. And I think we have reached a point of inflection where that growth is going to be very strong. So there I believe the stocks which are going to benefit immensely are going to be Bajaj Auto, primarily followed by TVS. So given that fact, and Hero is very late on its launch of the EV products. So unless Hero can show that it has got the mind space to get that kind of growth, is a debatable question. And hence what I believe is that Hero Motor is a hold at these levels. It will bounce back, but once it bounces back, it is better to move to a counter like Bajaj Auto or TVS, which have shown to be of more resilient than Hero Motor.
All right. Okay, so that's the perspective on Hero MotoCorp and indeed on the automotive space. We've got a caller. Sanjeev is calling us from Noida. Hi Sanjeev, how can we help you today?
Yeah, hi, good morning.
Good morning.
I have a question on this Ola Electric.
All right.
I have 3,000 shares, bought an average price of 107, and presently I'm incurring around 1.5 lakhs loss.
Right.
I want to know what is the long-term outlook, and any level can you suggest at which I should start everything if at all it has been done?
Okay. Vineet, incidentally, since we did speak about the automotive space and you mentioned electric mobility, you did not mention Ola Electric. You talked about Bajaj Auto, you talked about TVS. What would you do with an Ola?
So, Ola, as they've launched, they've lost the mind share with the customer. So unless they're able to get that brand value back in terms of product quality, servicing, post after sales, etc., I don't think that stock is going to do very well. And in the face of competition from the incumbents who have already got a good distribution network, Ola has tried to match that with a very fast rollout of almost 4,000 centers. But to me, getting the brand quality going is very important, and Ola has not been able to do that. So that is why I did not mention Ola to you.
All right, so that's the view with respect to Ola Electric. The next counter that we're talking about is Serra Sanitary Ware. Do we have the name of the, I think, okay. Bhupen Mehta has a query on this particular counter, and he wants to know whether this is the right time to enter the counter or not. Akshay, I'll come to you. Are the current levels attractive enough to enter Serra Sanitary Ware?
Well, unfortunately not. There is still some more downside to go. Looking at the intensity of the selling, which we have noted in the last couple of months, there is a high probability that the stock may visit somewhere around 4,700 to around 5,000 odd zone. So it's a 300 odd point range where a possible bottom can be formed from a trading perspective. So wait for levels of 4,700 to 5,000. It's a 300 point range where you can consider buying the stock in tranches. Once it tests those levels, you can expect some respite rally from those levels.
Okay. Just want to clarify, Vineet. So it's a sell on Ola?
It has come off quite a bit. I would still give it a few months to, tell us what they're actually doing with it. How they're trying to regain their mind share. Since it's fallen quite a bit, I won't actually put a sell on it. I would wait for 2-3 months to see how the monthly numbers come out, and if there is any kind of upside in that, then we would revisit our decision. So I will put a hold on it for the time being.
Hold. All right. The next question is, in fact, from Swapnil, who's calling us from Pune. Hi, Swapnil. How can we help you today?
Hey, Alex. Very good morning to you, Mahima, Vinit, and Akshay.
Good morning to you. Please, go ahead.
Yeah, I'm looking for this Dhanuka, Alex. So long term, 2 to 3 years, do we see any upside for it, like 60% compounding upside? This is a fertilizer base, and there was a good monsoon, but still, last 3 months, I'm not seeing much movement upside.
Swapnil, you're talking about 16 or 60? When you say, when you say
1450, I brought it for 1240 shares.
Right. Okay. And what is the upside that you're looking at?
Around 60%, 50 to 60% compounding upside for next 2 to 3 years.
Okay. Cumulative, you're saying, right?
Yes, cumulative.
Okay. 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 Any specific fundamental view on this one, Vinit? Is that potential possible? You would require in the next 2 to 3 years, if you have to have a 60% upside, a very substantial growth in the earnings. Is that something that's on the cards?
So, we don't track this company aggressively, but what I can suggest is that, Trump has made certain announcements where, he's revoked the ban on certain chemicals, agri-chemicals. And, that it's a possibility that Indian players could be beneficiaries of this. But, I have not looked at it. So this is my limited point that I would like to put on this.
Very quickly take it to Akshay. Akshay, on the charts, 60% upside over the next 2 years, is that something that is possible?
Yes, the longer term charts are absolutely strong. It's the short, medium term, which is the pain point. So it's about timing, which is the right point to get into the stock. My sense is one more leg of downside is due. Probably 1200 can be the possible bottom area for the stock. So averaging out around 1200 is the best opportunity I foresee in the stock. Technically, 1050 is a stop loss you can keep from a risk management perspective. And if it recovers hard from 1200, you can re-expect the stock to revisit 1800 plus in a time horizon of a couple of years.
So that's the view with respect to Dhanuka Agri-Tech. The next counter that we're talking about is HAL. Rana from Delhi has purchased around 50 shares at 4,700 a piece, and this is from a 3 months perspective. He's sitting on a loss of over 72,000 rupees. Akshay, what's the view like with respect to charts where HAL is concerned?
Well, unfortunately, the defense pack has seen a severe beating, and still there is no sign of a bottom close by, at least in most of the defense names. And if I particularly were to look at HAL, then possibly 2750 odd levels is what where the stock is headed for. So clearly, there's a negative price setup, and I would recommend to exit this counter from a 3 to 6 month perspective.
All right, exit and book losses, the view coming in on HAL from a 3 months perspective. We have our next caller, Alex from Kerala is calling in. Alex, a very good morning to you. How can we help you?
Good morning. I have a query on Berger Paints.
Okay.
I am holding 110 shares of Berger Paints at the price of 449.
Okay.
I bought it recently. I bought it somewhere January, February that time.
Right.
February. I have done a fundamental analysis on this, and actually the results, last results are good actually for this up to the analyst, and they have increased their market share also.
Right.
And compared to Asian Paints, their results are much better, and they are trying to acquire AXA Global also. When we compare with the Asian and the Berger Paints, this Opus entry, in my view, I think it will not affect, because for a long time they have a footfall on the market, and Opus will try to.
Got your query, Alex. I'll take your query with Vineet. Vineet, he's analyzed the stock well. Although what he's saying is that Birla Opus might not hamper Berger Paints, but that's not true. The competition in paints, sector is playing its part. But what's the view with respect to Berger Paints and, of course, paint sector as a whole?
So we have to understand one thing is that the paint sector is an evergreen sector. So with real estate, you get new buildings. Without real estate growth, you get repainting that happens, right? So to that extent, he's bought a very good stock. Secondly, he's bought the stock after the market has, adjusted to the entry of a new incumbent. Third thing, what he has done is he has very widely said that, the market share gains have been very strong. And they're also looking to do a acquisition which can be more positive in terms of distribution and brand perspective. So I think he has chosen a very good stock. And I believe that, the worst of the paint industry mostly done with. And, Berger Paints could be the leader of the pack from here.
All right. It's time, gentlemen, to hit the rapid fire segment. You know what this means. We'll throw as many questions at you over the course of 2 minutes. Do try and keep your answers as concise as possible. The first question is from A. Mohan, who's writing in from Warangal. GMR Airport is the name of the counter. He's bought at 80 rupees a piece. Should he hold or sell? Akshay?
Well, sell is the recommendation. Resistance is at 72, expecting 64 on the downside in short term.
Okay.
All right, JK Paper is the next counter. 365 is the price at which the person has got it. What's the view like, Vineet, from a longer term perspective?
A hold.
Okay, IDFC First Bank is the name of the counter. Ankit Sharma wants to know, bought at levels of 83.3. Is it a hold or a sell? Vineet?
I would hold on to this one.
All right, Genus Power is the next counter. What are the levels looking like on the charts, Akshay?
Well, Genus Power is still negative, so I would recommend it to exit.
Okay, that was Atul's question. Peter's got the next question. JK Paper is the name of the counter. 365 is the buy price. Time horizon is 3 years. Would you hold or exit, Vineet?
I just said hold.
Okay.
All right. Venkat is holding 1,500 shares of Tata Motors at 749. What's the view like from a longer term perspective, Vineet?
Around 550.
Sula Vineyards is the name of the counter. Vineet, this one's for you. 620 is the buy price. 10 years is the horizon. Would you hold?
Definitely hold.
All right. Honeywell Auto is the next counter. What are the charts looking like, Akshay?
Honeywell, the charts are still negative, some more downside to go. If it's Honeywell Automation, probably 32,000 is where you can consider buying it.
Okay, Britannia, for the relatively short term, Ramya wants to know, because of the exit from the Nifty 50, would you sell? Akshay?
Britannia, I will hold it. Maybe it's in the process of forming the bottom, 2-3% down more, but I would recommend a hold.
All right, Ajmera Realty bought at 875 a piece. What's the view like, Vineet?
No view on this, please.
Okay, SBI at 52-week low. Would you buy for 2 to 3 years? Rajagopalan wants to know. Vineet, what's the view?
Definitely good, very strong franchise needs to be bought.
Okay, and that brings us to the end of this rapid fire segment and indeed on the queries as a whole. Thank you so much, Vineet and Akshay, for joining in, for answering all the questions that you did. All right, that brings us to the end, as I said, of this program. It's been an absolute pleasure bringing it to you from Mahima and myself, from the team that put this show together. Thank you so much for watching. Do stay tuned. KYC is up next.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs, that will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
भाषण सुना उसके बाद मेरा पहला एक्रोनिम निकाला मैंने, वो था RRR, रिस्पॉन्सिबल, रिफॉर्मिस्ट, और मैंने कहा रिवॉल्यूशनरी। हाउ डिड यू अराइव एट दिस नंबर ऑफ 12 लाख रुपीस?
हमें लगता है टैक्स पेयर उस लेवल नंबर से टैक्स भर रहा है, क्या उनको हम कुछ कर सकते हैं?
प्राइवेट सेक्टर कैपेक्स अभी तक वो इन्वेस्ट क्यों नहीं कर रहे हैं, जबकि आपका इकोनॉमिक सर्वे ही बताता है कि वो कैश पाइल पे बैठे हुए हैं।
अगर कंजम्पशन बढ़ता है और उसके तहत लगता है कि ग्रेटर इन्वेस्टमेंट का पॉसिबिलिटी है, वो भी अच्छा ट्रिगर हो सकता है।
एआई बहुत तेजी से आ रहा है, तो जॉब के चैलेंजेस होंगे, स्किल के चैलेंज पहले से हैं, तो जो ट्रांजिशन पीरियड का स्ट्रगल है, नौकरी मुझे अभी चाहिए।
पूरे साल का एक्सपोजर दिलाने के लिए हम इंटर्नशिप प्रोग्राम ले आए और इसके साथ साथ इस बजट में भी ट्रेनिंग फॉर एआई, इसके लिए सेंटर्स बनाए हैं।
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company? Hello and welcome. This is KYC, a show designed to give regular investors powerful, actionable insights into the fundamentals of a single NSE-listed company every day. Today, we are talking about a real estate company, that's Mahindra Lifespaces. Well, in terms of what the company does, as I've mentioned, it is engaged in the development of residential facilities and to a certain extent commercial complexes as well. It does identify as a growth gem by the Mahindra Group, as when about 51% of the stake is owned by Mahindra and Mahindra. They are in fact the promoters of this particular company. And the company is planning to scale its business to as much as 5 times over the course of the next 5 years, where the potential of the business could be around 8,000 to 10,000 odd crores. At the moment, this company is a small cap company. It has a market cap of a little less than 6,000 crores, and it does seem like it has a lot of distance to cover, and it does seem like it does have plenty of ambitious plans on the annual as well. In terms of the residential buildings and the business, the company has completed about 50 projects across since 1996. The company is essentially catering to markets in Mumbai and Bangalore, and about 39 million square feet worth of projects have been completed. It is also in strategic partnership with Actis and HDFC Capital. Well, moving on, in terms of some key integrated cities and industrial clusters that the company is focusing on, they also have a partnership going on with TITCO, RIICO, IFC, as well as Sumitomo. And moreover, the company has in large integrated cities under the brand name Mahindra World City. So that's the brand name that you can keep an eye on. And of course, smaller industrial clusters, which is brand as Origins. Now, that said, what we usually tend to do in any show is that we intend to talk about the fundamentals of the company, and then we take a look at how the company has in fact done. So we start by taking a look at the revenues, but perhaps in the real estate space, we actually talk about the operating metrics a little bit more because they are a little bit more recent and forward-looking. The income statement is only a consequence of all the business that has happened and closed in the quarter gone by, but all this business, well, was a consequence of the accumulation over the past few periods, which eventually led to that income statement. The balance sheet, of course, gives you an idea about where the company stands with respect to the several elements like debt and equity, and cash flows will also give you a better picture in terms of the net cash flow specifically. Moving beyond that, well, we also talk about the shareholding, street credentials, of course, outlook, and also what the street is making of the company going forward. But with that, let me get in my colleague Anushi Vakharia, who's also going to shed more light in terms of how things potentially pan out for the particular company. So Anushi, good morning and thanks for joining in. Let's start by talking about the key operating metrics, which are the most pertinent here.
Right. So Agam, as we discussed for a real estate company, the key operational metrics in terms of how the launches have panned out, how the launches have resulted in the pre-sales is something which is important to focus on. Now, if we see in the last 3 fiscal, what has happened, the pre-sales growth has been on a strong trajectory for the company. In FY22, they had recorded about a 48% growth at 1,028 crore. Then in FY24, we saw this number at 2,328 crore. So we are looking at a 48, 76% and 28% of growth respectively. Even the pre-sales volume has seen a significant pickup in terms of where this number is concerned. Collections, the number of 1,153 crore has moved upwards to 1,385 crore. If you look at what is happening in terms of the launches and completions, again in tandem of what the growth numbers have been for the pre-sales is something that we are focusing on. However, if you come back to the recent period, that's a 9-month FY25 picture, pre-sales has seen about a 41% of a growth, while pre-sales volume was up around 32%. But it's the launches that has seen a downtick of around 7% in this 9-month period, while collections have, again, in line with pre-sales growth, collections has also seen about a 41% growth and completions has seen 12%. But launches is something we need to focus on, because even in the other real estate players, what we've seen in terms of the volume of launches, there has been a kind of a downtick in the last 2-3 quarters. This is also because of other challenges like lack of approvals and other results resulting to this downtick that we are seeing. So in terms of the key operational numbers, this is what we are seeing. But Agam, what is in terms of income statement check?
Right. So, Anushi, as we mentioned, that it's more of a consequence of all the completion projects and the realization, which actually eventually leads to the top line and the bottom line, which is why the income statement is not as important a statement as compared to some of the operating metrics that Anushi's spoken about. That said, we should still talk about them. So at least in terms of how things have panned out over the last 9 months odd or so, and over the last financial year as well, well, we're talking about your revenue growth, which has tripled, not tripled, but doubled for sure over a span of time. And for FY24, however, the revenue stands at around 212 odd crores. And that's actually a sharp drop. So it's not like the company has not seen its bout of volatility to come through. And in terms of net profitability, it has a net profit, but on an operational level, it's a loss-making company. So obviously, there are other avenues of income from which the company is currently making some sort of case for that bottom line. And perhaps Anushi can come in on this one as well. In terms of revenue, of course, we are looking at, in the last 9 months, we're looking at about 83% growth. And an EBITDA loss of around 114 odd crores. But its net loss also standing at around 23 odd crores. As far as your FY24 numbers are concerned, it does have a bottom line profit despite the fact that its EBITDA is a loss-making one, and that is largely on account of one-offs. But actually, it's not necessarily a neutral one. I would give it a thumbs down, because, well, at least as far as FY24 is concerned, we are not looking at satisfactory numbers here. But Anushi, if there is anything else that you can add here and also take us through the balance sheet.
So I'll just make a quick pointer on the EBITDA now. The expectation is that people should be focusing on the EBITDA margins level also. But the company has clearly indicated that it's not the EBITDA number that one needs to focus on, but rather the IRRs. And the target for the company is to get projects in which they can have a target of around 20% plus IRR. So that is something that we can keep a focus on. But coming to where the balance sheet is concerned now, if you are looking at the net worth value, more or less in a similar range, 1,613 crore to 1,543 crore. In terms of where the gross debt is, this is where we are seeing a significant pickup. 238 crore was the figure in FY23, but we are looking at 868 crore right now. And cash in bank also has seen a considerable pickup, 64 crore, which is increased to 97 crore. So this is as far as where the balance sheet numbers are concerned.
Right, and as you can see on the balance sheet, right, the only reason why we gave it a neutral is because this gross debt has moved up, and in relation to the net worth as well. It's something that we will quiz the management on as well. But let's talk about cash flows then. And again, as far as cash flows go, it's a net cash flow positive number, even though cash flows from operations are negative and in fact have well come off quite a bit. But again, because of the fact that it's a net cash flow positive number, and a lot of these positive cash flows on account of well, investing activities and financing activities specifically is the reason why we're getting a net cash flow number here, and hence we're going to go on with a neutral rating coming down to this particular company. So that's as far as your overall statements are concerned, the financial statements and your key operating metrics. And a lot needs to still be figured out with respect to this particular company. But I will just jump on to talk about the shareholding. And as far as the shareholding is concerned, again, it's a relatively stable company, a well-held company. As I was mentioning, about over 51% stake held by the promoters. In this case, the promoter is Mahindra & Mahindra, that's the automaker. And moving on, as far as FIIs are concerned, that remains stable, 10% holding, about 21% holding from domestic institutions, and all your marquee AMCs, your big AMCs hold stake in Mahindra Lifespaces. Also, your outstanding shares with respect to others, that is out in the public in HNIs, that remains at around 18%. So not much has changed over the past couple of quarters. And that remains also a positive. And because of the fact that it's a well-held company across not just the promoter but also institutions is the reason why we'll give this a thumbs up as well. But Anushi, in that case, let's talk about how the stock has done in terms of its prices.
Right. In terms of where the stock price return is concerned for the investors, it's not been such a great 6 months or rather a 1 year period also for the company. In fact, we've seen about a 43% decline in terms of where the stock price is concerned. And same in even the 1 year period, we are looking at a 44% of a downtick in terms of their share prices. If you go and see the long-term picture as well, that's the 3-year return, it's fetched about a 16% of a return. So we are giving this a thumbs down because if you compare this with some other real estate players, now while in the last 3-4 months or so, there has been correction with a lot of these realty players. In the last 3 years, you'll observe that most of these players have recorded around 100+% of gains. So the stocks have doubled here. But Mahindra Lifespace, we are not seeing those kind of returns as compared to where the other real estate players are concerned.
Okay, so that's as far as street credentials are concerned. Before I get in, Anushi, to talk about the outlook, also want to take a look at what the street is making of this. So street coverage is something that I will pull up right now. And in terms of street coverage on the consensus, we have about 6 buys and 1 holds, no sells. So in general, overall, a positive outlook as far as the analysts on the street make up Mahindra Lifespaces. And in terms of the consensus price target, that entails a 75% upside from current market levels as well. That's as far as your street coverage is concerned. And overall, this of course is also positive, which is why this will be a thumbs up too. But Anushi, finally, let's talk about the outlook, which I'm assuming is also positive.
Right. If you look at the overall outlook, in the opening remarks only, we've mentioned that the business aim is to grow 5x in the next 5 years and make it a 8,000 to 10,000 crore of a size for the company. In line with that, we have a couple of launches that one needs to focus on, and Q4 they have 3 big launches, which includes Vista Phase 2 in Kandivali along with Zen 2 in Bangalore, which is adjacent to Zen 1. Along with this, Citadel is also launching a new tower for which the company has also received approval so far. Other than that, they are also exploring funding options. In fact, in the recent updates also, if we see, the board has received a 1,500 crore of approval for a rights issue. This is in line to grow their business forward. In the con call, the company had indicated about 3,000 crore of size. So what needs to be asked is whether there are more fundraise plans on the table, considering the company has set a higher target for GDV, that's the gross development value additions as well going forward. Other than that, in terms of whether net debt to equity is concerned, that should remain below the 0.5x level. So they are targeting to maintain the net debt level also in a similar range. All the real estate players after the COVID, they have sped up their game in terms of whether net debt to equity ratios are concerned, and in line with this, the company is also expecting a below 0.5 times of a ratio for where the outlook is for this company.
Okay. Well, on that note, I reckon that it's a good time to bring in the management into the conversation and take a look at what they are saying about the ongoing business. We have, in fact, with us Amit Kumar Sinha. He's the MD and CEO of Mahindra Lifespace Developers. Well, Amit, good morning and thank you so much for taking the time out. Amit, firstly, I wanted to get a better understanding of the business itself. So, from what I understand is that the business is divided into 2 areas. One is, of course, residential. The other one is integrated cities and industrial clusters. If you could give me an idea about how the business is split between these areas and what's the outlook going forward, because from what I understand is that you want to, well, you're looking at a 5 times growth in business over the next 5 years. What are these areas which will in fact drive towards your targets here?
Thank you. Thank you for having me. Let me just answer that question swiftly. The industrial business is, as you explained in your analysis, attracts manufacturing companies to set up their operations in a plug-and-play fashion in our industrial parks, either world cities or origins. We have a lot of land in 5 locations, and we are the master developers. We provide plug-and-play infrastructure to all these companies. These companies, a range of multinationals, like our Chennai has BMW plant, Jaipur has JCB's largest plant, and so on and so forth. So they attract marquee investors which are looking at Make in India, both for domestic as well as global. Given the profile of the business, we have roughly 400 to 500 crore of lease revenue annually for the next 4-5 years for sure, and it may go beyond that. So that's the revenue potential that you see. From the residential side, we were, I think, as you showed, 2,328 last financial year. We're trying to grow that business 5 times in the next 5 years, so between 8 to 10,000 crore. That's our key priority. That requires acquisition of GDV, which we have done really well in the current financial year. Just for your reference, one of the operating metrics that we track carefully is how much of land bank that you're acquiring for projects. So as a reference, F20, we had acquired 1,000 crore of GDV. In F24, we acquired 4,400 crores. And in F25 year to date, we have done 18,000 crore. So just as an example of how the business is, we are trying to scale the business. This GDV over the next few years, as we get the approvals and design done, will translate into sales for the company on the residential side. So that's the composition of our business. So so far it's 23, 28 plus, let's say, 500 on the industrial side. But over the next few years, the industrial will continue to be similar size, given that's the potential of the business. But the residential will scale up significantly.
Okay, well, that's the outlook for both of these segments that you've mentioned. But Amit, I want to focus more on the residential side. Now, if you look at the 9-month period, pre-sales and collections both have recorded about a 40% of a growth. Considering the next 1 to 2 years, want to understand the picture in terms of growth what is the kind of sustainable range that we should be looking at? Along with that, how are the realizations going to shape up along with this pre-sales and collections growth as well?
Yeah. So, you're absolutely right. So I look at this industry as a long-term industry. Given the lumpiness of the way this industry operates, if you get one approval, suddenly you have the ability to clock a very high pre-sales in a month or in a quarter, to say the least. And we are trying to build a company for the long term. So overall, long term, we want to grow the company to a level where we are meaningful, create great products, and have profitability, hopefully in line with our peers and hopefully superior. So that's what we're trying to build. So I would look at it a 5-year or longer period of time. Given the GDP that we have actually clocked already, 5x growth translates into somewhere around 25 to 30% CAGR, maybe a little bit more. So we will target overall 5x, but if you were to break this down on an annual basis, this should be our trajectory for the next few years.
Right, Amit, can you give us an idea about the launches which have been planned in the fourth quarter, ones which have happened in the fourth quarter, ones which are potentially about to happen, as well as FY26 to give us a better picture?
Yeah, so we had planned 3 or 4 launches. 3 approvals have already come to us. There was one launch for our marquee project, flagship project in Pune, which is Citadel, which has tower 1 tower was launched. We have Wagoli, the project is called Ivy Lush. We got the RERA at the end, just the start of this calendar year. And then we got the RERA for Carnivali Phase 2, which was our flagship project that we launched around the same time last year. So we released additional inventory on the residential side as well as on the retail side. We are evaluating the retail side. So those 3 launches happened. Zen 2 that I see on the screen, we are awaiting the final approval. The approvals lately have been slow. We have done our part of the submissions, etc. We are hoping to receive approvals any day, which will allow us to launch the Bangalore part also. For F26, we have a whole host of launches planned. Some of them that are marquee are Navy, which is in Malad. This is a redevelopment project, society redevelopment project that we have been pushing hard to bring it to the market. That's a very important one. We have a few planned, like Zen 2, if it happens, great. But we have plans for Zen 2 as well as Alembic in Bangalore. And then in Mumbai, we had acquired a huge piece of land, Bhandup, as part of joint development. It's a 37-acre land parcel. We're trying to accelerate the approval and hoping that it comes through toward the end of next financial year. So these together are just an example of the portfolio that you have in terms of the new launches. And additionally, we'll have the phase launches of projects that we have already launched. So that should give us a huge amount of potential inventory that can be converted into sales for the next financial year.
Okay, so considering the launches that you spoke about in Q4 and the FY26 also, where you have a couple of these launches lined up, just want to get a number on what is the GDP potential that you're seeing from these launches. And again, if you look at what is happening in the industry for some of the key players, that they have seen a lack of approvals in some of these launches are concerned. So are you also seeing some similar signs for your business? Just want a clarity on that.
Yeah, absolutely. You're right. I think there is generally a slowdown in the approval that we have seen in the industry, especially in Maharashtra as well as Karnataka. And there's also issues with respect to EC. There's a Supreme Court going on. So even the construction, we have ready projects, sold project. We are waiting for some of the clearances to start construction. So there is an overall slowdown. But that's the nature of the industry. I think we need to build sizable portfolios so that 1 or 2 projects don't slow down the trajectory of the company. And that's what we're trying to build at Mahindra Lifespaces for the future. In terms of next year GDP, I think it's tough to say. We have right now when we started our transformation journey a year and a half back, around the time I had joined, we thought that 45 to 50,000 crore GDP is the right potential for us to scale up to our 5x aspiration. And touch wood, we have covered the 5-year GDP of 45,000 to 50,000 crores. 75%, roughly 37,000 crore is already with us now. So huge amount of land bank has been created and gives us confidence that as we execute well on the design, as we create innovative, creative, sustainable design for our customers and able to fulfill the regulatory requirement, we should bring them to the market at the earliest. So that's what we're trying to do. The Mahindra life spaces of the past was very different. Mahindra life spaces of future is going to be very different. And I would say the best is yet to come.
Well, no, that was clear to understand. Now coming to the capital raise plans that you have, in the conference call, if you see, there was an indication of about 3,000 crore of a fundraise requirement for the business. Now in the recent update, you've got the board's approval for 1,500 crore of a fundraise. This is via the rights issue. Want to first understand what are you going to be using these proceeds towards, and are there going to be more fundraisers considering the first half 1,500 you've received, so there would be another 1,500 crore as well?
Yeah, so I think we are thoughtfully looking at our capital. First of all is trying to make sure that we use we bring those projects that are capital efficient. So example that is, if you were to acquire a very large parcel of land in outright model, it will require a huge amount of capital and your IRRs will get affected. So especially in Bombay, JDA and society redevelopments are quite big. So of the 37,000 I had mentioned, roughly 50% of our portfolio is capital efficient. So you don't need to put upfront capital to lock those land and to get approval and launch those projects. So while we talk about 3,000 crore, I think the first step is sign up good projects which are capital efficient, which we have done in a remarkable way over the last few months. And we'll continue to be very thoughtful about the balance sheet aspect of it. The second part is, how do we use the funds? So first tranche is 1,500 crore. That's almost, our net worth is around, it shows 1,600 in your chart here, but it's close to 1,800 crore. So our fundraise of 1,500 crore is close to 100% or 80-90% of that. So that's the maximum you could do. We will use these funds as our growth capital. In the short term, we may use to retire some of our debt, which will make our balance sheet even more healthier. So that's what we'll do. And as we develop and execute projects on the ground, we have support from our promoters, Mahindra and Mahindra as a group, which is solidly behind us. The 1,500 initial commitment or current commitment just shows that we are a growth gem for them, and they will continue to support us from a balance sheet point of view as long as we execute on our commitments on the ground.
Sure. Well, Amit, there is actually plenty more that we haven't stopped you, but I guess that's all the time that we have. So thank you so much for joining us and at least giving us so much insight with respect to some of the crucial questions that we did in fact have for your company. Thank you very much for joining us here.
Thank you for having me.
But there you have it. That's the management of Mahindra Lifespace Developers telling us about all that in fact can be expected from the company going forward. But on that note, we are completely out of time on this edition of KYC. To very quickly take you through the ratings that we've given to the company, as you can see, a thumbs up for operational metrics, a neutral stance for income statement, balance sheet, and cash flows. And moving on to the next set, well, the outlook remains positive, as is the case for street coverage, and that brings us a total score of about 5.5 out of 8. But on that note, it is a wrap on this edition of KYC. Stay tuned to NDTV Profit.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the trading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Reviksit Bharat.
बजट भाषण सुना उसके बाद मेरा पहला एक्रोनिम निकाला मैंने, वो था RRR, रिस्पॉन्सिबल, रिफॉर्मिस्ट, और मैंने कहा रिवॉल्यूशनरी। हाउ डिड यू अराइव एट दिस नंबर ऑफ 12 लाख रुपीस?
हमें लगता है टैक्स पेयर उस लेवल नंबर से टैक्स भर रहा है, क्या उनको हम कुछ कर सकते हैं?
प्राइवेट सेक्टर कैपेक्स अभी तक वो इन्वेस्ट क्यों नहीं कर रहे हैं, जबकि आपका इकोनॉमिक सर्वे ही बताता है कि वो कैश पाइल पे बैठे हुए हैं।
अगर कंजम्पशन बढ़ता है और उसके तहत लगता है कि ग्रेटर इन्वेस्टमेंट का पॉसिबिलिटी है, वो भी अच्छा ट्रिगर हो सकता है।
AI बहुत तेजी से आ रहा है।
Hello and welcome to NDTV Profit. You're watching Markets at 12. My name is Rutra Somaya. And let's have a quick look at how the markets are doing right now. Definitely mixed cues in trade today. Nifty 50 is largely trading flat as we speak right now. But Nifty Bank is really strong since the start of the trade. This one is up in the trade today as we speak right now, up about 0.5%. That's interesting after a few sessions of a bloodbath that we saw on the Dalal Street. But let's also pull up the advanced decline ratio. 1:4.6 is what we could see over here, definitely in the favor of declines as we speak right now. But who knows when the reversal will come up, and this is what we are seeing since a couple of sessions right now. There's a fear in the market, traders, investors, every rise of opportunity seems like profit booking as the markets are faring right now. But let's also pull up the sectoral heat map. We have only the banking and the finance space which is in the green. Rest all other sectors are in the red. There you go. Media, realty are the top losing ones, down about 2% in trade. But banking and finance is up almost 0.5 to 1% over here. As there are some news from RBI, we'll definitely cover that one. But let's also speak about the constituents which are pulling the Nifty 50 index down. We have Ultratech, which is the topmost loser, down about 6% in trade now. Ultratech is also one of the top stocks in focus right now. But the other ones that are losing out are Trent, Hero Moto, M&M. Well, we'll definitely cover about the kind of preview numbers tomorrow on the show. But up in the green, we have Shriram Finance, Bajaj Finance, Indusing, HDFC, a lot of banking names is what we could see over here. But an interesting one is Wipro over there. But with that, let's pull up the Nifty IT index as well. Well, IT is also volatile since the start. NVIDIA came out with earnings overnight yesterday. Earnings were pretty good, above expectations, but doesn't seem to have been reflected in the Indian IT space. Wipro Infield largely trading flat, and the ones which are losing are the mid-cap ones. Remember that these mid-cap names lose the most in bloodbath and gain the most when the things are pretty green above there. But also let's talk about the Nifty banking names. Banks like Canara Bank, Kotak Mahindra, down about 1%, the top losing ones. But up in the green are AU Small, IndusInd, HDFC, ICICI, and Axis as well. But also let's move on to the
top stock right now, Ultratech, is in focus. Well, the cement maker is set to foray into cables and wires industry, which is actually pushing other cable stocks downwards. As we speak, Ultratech is also down about 6%, but the other competitors in the space are also down, likes of RR Cable, etc., not doing pretty well. But why is Ultratech under pressure itself? Is it the concern over diversification, or is it something else? Mika joins us with more details.
It's an 1,800 crore investment. You're right about that. Over the next 2 years, they're planning a plant in Gujarat. But the question lies if Birla Group as a whole is over-diversifying. In terms of your past ventures, they did announce India jewelry ban. They were going to invest close to 5,000 crores and open 100 stores in the next 18 months. And they aim to make it one of the top 3 jewelry retailers in India within 5 years. Another one was Birla Opus. We've spoken a lot about it. It's the paint brand. They announced its entry in 2021 and launched products in 2024. And the company does target 10,000 crore revenues and to turn net profit positive in FY28. And the Birla Group as a whole is already in a battle in 2 segments. One is a telecom with Bharti Airtel and Reliance Jio, and in the apparel segment as well with Reliance, Trent and Shopper Stop. Now, what was common, Grasim, in the paint industry and what helped, and you saw kind of pressure on other paint companies, is that the distribution network of Birla White and Birla Wall Care Putty, and around 70% of its dealers also sold paints, which helped Birla Opus and made the dealership reach second when you compare it to Asian Paints. But when you compare Ultratech and whether it has anything common with the wire and cable industry, the simple answer right now is no. They have negligible synergies in terms of stuff like raw material sourcing, distribution, as well as transportation. And the influencers are also different. In cables and wires, it is electricians, whereas in cement, it is contractors, and neither cement dealers sell wires as well as cables. In terms of what could go wrong, well, amongst wires and cables is growing faster. One is because of higher demand from sectors like power, data centers and other infrastructure projects. But on the flip side, cables do take 2.5 years in terms of product development, manufacturing and other things. For wires, on the other hand, the time to enter the market is low, and some analysts do believe that because of Ultratech's better brand recall, it would help. Lastly, potential financial impact. I'll just go through over that. 1,800 crore capex has been announced. An assumed 4.5x asset turnover gives a revenue potential of 8,100 crores at a 10% EBITDA margin, 810 crore EBITDA level, which is 4% of the FY27 consensus estimates. But there is investor concerns about the capex allocations that brokerages have been citing.
Definitely, there is some investor concern out there, but what impact will Ultratech's foray into wires and cables will have on other competitors? Well, we spoke to the expert Pravin Sahai, the research analyst at PL Capital earlier today about the same. Listen to the slice of the conversation.
The entry of Ultratech with a very high capex announcement of 1,800 odd crore considered to be the way forward competitive intensity to heat up in the sector. But definitely, in this sector, it's not like putting up the capacity, especially in the cable. It further takes around 3 to 4 years time frame for a lengthy approval process to supply of the cables. Whereas wire is quite easy as compared to the cables to venture out. It's required a distribution and the brand is already with Ultratech. So I think they will start with where they had not disclosed, but I believe they will start with the wire. I believe with their a lot of penetration in the retail in the different verticals. So this definitely treated as a sentimentally negative for the existing large peer set. Also, we know that large part is in the wire and cable is organized, or around 6 players account for around 54-55% of the market. So definitely, it's going to be a pressure to them.
Okay, well, that was the cement sector, but let's also look at SRF, which is buzzing right now. Well, the stock is up about 3%, and this is on the back of a brokerage note, MK. They say that they are very much positive on the stock, and therefore they maintain a buy rating. Well, the stock is a little down from the day's high, but they also say that the worst is behind for all the businesses of SRF, and the growth is expected to come from the existing business also, and the stabilization of an incremental contribution from the new products as well. And they also say that within the specialty chemical space, they do expect a recovery, but this recovery will largely be gradual in nature, and they also expect firming up of refrigerant gas prices globally, and expect improvement in the packaging films business as well. So all this will largely drive the growth up. The company is also best placed in terms of capex in specialty chemicals business is what the brokerage house mentions over here, and the company should also benefit from agrochemical cycle turnaround is what they say, and therefore improving refrigerant prices globally is what the brokerage house mentions. Well, the target price is set at 3,250 rupees from the current levels of 2,800. So that is what we have on SRF. But I also want to talk about RailTel. Well, this one has secured 2 orders from South Central Railway. These 2 orders, talking about the first order comprises of 111 crore rupees. This one is to be executed by August 2026. Second order is of around 57 crore rupees to be executed by May 2026. Well, the total order book stands at about 4682 crore rupees, and this is as of FY24, and that is the latest number that we have from the company. Well, taking a little brief on the third quarter earnings over here, revenue up about 15%, margin came in at 15.8%, net profit was up just about 5%. So 3Q earnings were not that great for the company, but the stock is buzzing. Actually, it's down about 3%, even though the company have announced the order win. Definitely that might be impact of the broader markets as a whole, but we'll definitely see what RailTel has to give us in the fourth quarter. But okay, let's also move on to talking about the railway stocks. Well, on the big brokerage call of the day, Morgan Stanley has maintained overweight rating on Titagarh Rail, but cut the target price to 1,090. Anushi, who tracks this sector closely, joins in with more details from the report.
Yes, that's right. If you're looking at, it's a significant cut in the target price that we're looking from Morgan Stanley in terms of whether Titagarh Rail target prices, they've cut the target price to 1,090, which is again, if you look at a 16% of a cut from 1,300 that they earlier had. Now, this is on the back of several concerns that the brokerage note has pointed out. Firstly, near-term execution challenges, which may impact the revenue trajectory going forward. Now, what we've seen is that the company has 2 divisions. One is the freight rail care, and another one is the passenger rail. So, while passenger rail has already seen downtick in terms of where the revenues are, now it is concern is with the freight rail also seeing similar trajectory, seeing some challenges going forward. Now, this is due to the inadequate wheel sets from the Indian Railways, which has constrained the Q3 offtake going forward. So, focus would be on the fourth quarter and the first quarter of the next financial year. Also, if there is recovery in this, Indian Railways have also extended the delivery timelines considering the same production supply side issues that have been taking place. In other side, we have seen that the railways budget had been maintained at 2.65 trillion rupees. So this is the same as compared to last year. There has been no pickup in terms of where the railway budget expectation was, but Titagarh remaining one of the key players and key beneficiaries of these robust rail capex. If you look at the ordering, the expectation was from H2 there would be a pickup in ordering, which we've not seen so far translating actually. So that is another concern on the street. Another one is execution in Vande Bharat, which has been delayed by 9 months because of a change in the car design plan. So a couple of execution related challenges and how the supply side challenges would result in the delay in some of these timelines which were pointed earlier has resulted a reduction in the EPS forecast, and hence we are looking at revised PE multiples as well, because of which we are looking at a cut in the target price that is given.
Interesting thing over there. But Anushi, stay with us and talk to us more about Prestige Estates. Well, this one is also what you cover in your radar. Well, Prestige Estates remains in focus after Axis Capital, the brokerage house, has come out with a note on the stock. Well, is this an initiating note if I'm not wrong, Anushi?
It's a year in this case. Axis Capital has initiated a buy call, and this is with a target price of 1,810. So we are looking at an upside of around 52%. Now, what the brokerage note has said is now they are looking at a near-term recovery in terms of where the pre-sales is concerned. Do note that in the last 2-3 quarters, we have seen the company posting lackluster pre-sales number, and this is because of approval challenges which have been happening in some of their key launches. So Axis Capital sees around 34% of a CAGR growth in pre-sales, and this is for the longer term picture that we are looking at, that is FY25 to 28. Another note that they've mentioned is they are on track to achieve their multifold growth in the annuity business also. Balance sheet and the holding structure is also already cleaned up, so they are entering into self-sustaining phase of growth as well. So the launches, which have been one of the major concerns for the business, is something that one should continuously track for Prestige Estates if there is recovery here, because when we spoke to the management, they had already cited around a 50,000 crore plus of a GDV potential going forward for the business. So hence we are looking at a initiating buy call from Axis Capital and a target price of 1,800, which is a 2% of an upside.
All right, thank you so much for that. Well, the other stock on our radar is Hindalco. Well, Kotak has upgraded the stock to a buy and has also given a target price of 725 rupees. A lot of brokerage calls that we have on the show right now. But Mika, do talk to us more about Hindalco.
Yeah, so Kotak has upgraded the rating from a reduced earlier to a buy. The target price has also been hiked to 725 rupees versus 640 rupees earlier. They've also increased the EPS expectations for FY26 and FY27 by 2.5% and 3.2% respectively. Now, the major reason for certain upgrades is because they're stating that the concerns around the scrap spreads, the US tariffs, as well as aluminium prices and their impact on Hindalco as well as its subsidiary Novelis are overblown. They do not expect the scrap spreads to worsen further, and they said that it likely bottomed out in Q3 FY25. There are also certain macro factors that will help expand the scrap spreads, which will pose as an upside risk for Novelis margins in FY26. And for the India business, well, the Indian upstream projects and the company's focus on the aluminium upstream segment will be value accretive for the company. The planned capex projects will have early to mid-teens return on capital employed. And lastly, while there have been concerns about whether aluminium prices will hold up, they do expect it to remain firm at levels of 2,625 in FY26 and 2,650 per ton in FY27, and this is in dollars.
Well, this stock, even though this is a bullish call, the stock is not doing really well, largely flattish in trade. Over the last 6 months, this was actually given negative returns of about 12%, and over the last 1 year, given returns of just about 22% over here. But also, let's shift focus to the buzzing sector. In relief to the non-banking financial companies, the RBI, that is the Reserve Bank of India, lowers the risk weights of bank loans to NBFCs to 100%. Well, this comes after the RBI in November 2023 had increased the risk weight on the exposure of the bank to NBFCs by 25%. Puneet joins us with what the brokerages are saying and what are they actually wanting the investors to do.
All three are thumbs down, and very weak set of numbers for all three companies. Let's start with Utkar Small Finance Bank. The Small Finance Bank, as well as the smaller banks, have not been performing very well because of higher provisions, and this story is no different. The NII is down roughly about 14% in this particular quarter, coming at 458 crores, and the overall provisions were up 103% just on a quarter-on-quarter basis, coming in at 423 crores for this particular quarter. On a YOY basis, it's gone up roughly 3 times compared to 103 crores in the same time last year. Net loss, because of that, they reported a net loss of about 168 crores versus a profit of 51 crores in the previous quarter. So very weak set of numbers. Some of the key highlights was that credit cost has gone up by to 8.8% versus 4.3% quarter-on-quarter. And the collection efficiency has also dropped by 400 basis points to come at 88% versus 92% on a quarter-on-quarter basis. Higher leverage at the borrower level has been one of the key points that the company has highlighted in its investor presentation. The second one's an auto ancillary company, Jamna Auto. Now this one specifically, caters to the commercial vehicle market largely, and that's why the volumes have been subdued on the OEM side for players like Tata Motors and Ashok Leyland. And hence, the numbers have been very down. Revenue down 7%, EBITDA is down 10%, overall dragging the net profit down 20% in this particular quarter. They have mentioned that the new product share has gone up on a YOY basis to 47%, and this should help margins once growth come back. And the MHCV NDTV production changes have gone up on a quarter-on-quarter basis by 12%, which is the high margin business. So watch out for that key aspect, but overall numbers are weak. And finally on Centum Electronics, so this EMS player essentially reported a 5% fall in revenues, and that's dragged the EBITDA as well as the profitability. EBITDA is down 32%, while margins overall have gone down by roughly 3.7%.
Okay, let's move on to the India's budget airline player, which flew back to the positive territory. Earnings reported a profit of 25 crore for the quarter of December. Mahima joins in with key highlights from the earnings and more.
So, in terms of the key highlights of the earnings, well, there was an improvement of around 18% in available seat kilometers. The company has turned profitable, but this is because of one-off other income. In terms of the passenger, the revenue passenger per kilometer rose by around 23% quarter on quarter, and passenger load factor also has risen to 84% from 81% QOQ. Lastly, cost per available seat kilometers also improved QOQ. So, operational metrics in terms of SpiceJet are improving. It came out with both its Q2 as well as Q3 earnings, because Q2 earnings were pending to be reported. In terms of Q2 earnings, revenue was down by 36%. EBITDA lost to 210 crore and net loss stood at around 442 crores. But Q3 revenue was down by about 35%. EBITDA stood at 85 crore, margin stood at 6.9, and net profit at 25 odd crores. And this is of course because of a one-off rise in other income. This other income stood at around 419 crore, and this was this other income came along from restructuring of lease obligations with lessors. Now, in terms of a report on SpiceJet on the back of earnings, INCRED says that it believes that a scale-up of its operations could reduce FY26, could reduce in FY26. The company will be able to retain the entire benefits of the reduction in overall cost per available seat kilometer, and they have factored in that SpiceJet's entire fleet will be operational by FY26. In terms of QIP utilizations, overall 3,000 crore was raised, out of which 2,400 has been utilized. Out of which 600 odd crores have been utilized to pay off GST, TDS as well as EPF dues, and around 1,200 odd crores have been used to settle the disputes with aircraft lessors, and the claim was around 1,700 odd crores. Lastly, auditors of course have continued to flag off the going concern which is in danger, but management is of the view that the accounting needs to be done on going concern basis, and it's appropriate accompanying the company's statement. So both the views are contradicting, but this has been the case for SpiceJet since last year as well.
Okay, with that also, let's talk about the airfares which remained firm in the March quarter, which otherwise is a seasonally weak travel period, as airlines leveraged pricing power on one key destination where fares surged beyond rupees 50,000, and we all know what that is. Well, this is a level that even flights to Asian international destinations typically do not reach during peak tourist season. Somit, who has tracked this closely, tells us more about that.
Well, yes, airfares have remained very high in this fourth quarter, which is usually a seasonally weak quarter for the airline companies. Now, yes, they were much higher for one destination, that is Prayagraj. But apart from that, also, if you look at the top 20 destinations, prices have remained higher. So what we have done is we have checked the ticket prices for the top 20 routes in India. Now, these prices were checked on 24th of February. Now, we checked the 7-day forward fares and the 2-month forward fares just to take an understanding of how the fares are faring when it comes to the holiday period as well. Now, when it comes to the 7-day forward fare, now compared to pre-Mahakumbh, if you look at only 3 routes have seen a decline in the prices. 4 routes prices have continued to remain the same, while the remaining 13 routes have seen an increase in their prices of anywhere between 2 to 46%. Compared to last year, even if you check, 10 routes have seen a decline, but that is only around 4 to 19%. But 10 routes have seen an increase in the prices of anywhere between 5 to 49%. So which are those routes which have seen the highest increase and the highest decrease compared to last year? Firstly, when you see on the higher side, it's Delhi Patna, which has seen a 49% jump in the ticket prices compared to last year. And then there is Patna Delhi, which has seen an increase of around 34%. Apart from that, it's Hyderabad Mumbai, Bangalore Mumbai, and Delhi Hyderabad, which have seen an increase in the ticket prices of anywhere between 8 to 22%. On the downside, if you look at, it's Mumbai Kolkata, which has seen a decline of around 19%. Pune Delhi, Bangalore Delhi, Delhi Kolkata, and Delhi Bangalore have seen a decline of anywhere between 9 to 13%. Now, when we compare the 2-month forward ticket prices, which gives us a fair idea of how ticket prices are faring when it comes to the holiday period, which is again a key quarter for the airline companies. Now, compared to pre-Mahakumbh period, if you look at, 4 routes have seen a decline of prices of anywhere between 1 to 9%. 3%. 6 route prices have remained unchanged. 10 routes have seen an increase in price of around 2 to 34%, and compared to last year, 12 routes have seen a decline in the range of around 3 to 21%, while 8 routes have seen a rise in the ticket prices of anywhere between 1 to 18%. So what we are clearly understanding here is that Q4 will turn out to be a strong quarter for the airline companies, given the fact that ticket prices have continued to remain high, but the Q1 of FY26, which is the key period of holiday season for any airline, there at least the early trends are suggesting that ticket prices are weak.
Okay, well, thank you so much for that. But Prateek Parekh of Nuvama Institutional Equities believes that the cautious needs are to be practiced further as more earnings slowdown is expected going into Q4. Listen to the slice of the conversation.
If you look at the main reason for the correction that we have seen in last 2-3 quarters is the weakening of earnings. If you look at the earnings per se, in F24, we had 8% top line growth, but 20% plus profit growth. We outpaced emerging market earnings by a mile. Emerging market earnings were very weak to contractionary. But what has happened in F25 is that the margin expansion has stalled. I mean, mind you, margins are still holding up at very high levels. But given that the expansion has stalled, the profit growth and top line growth have reconciled, both to single digits. And at the same time, emerging market earnings, owing to a very low base, have also come back. So in some sense, what has happened is that India's earnings premium has condensed very significantly. And as a result, the valuation premiums too have come lower. Because if you look at the last 6 months, the entire correction is more an India-specific phenomena rather than a global phenomena. Emerging markets, if anything, have actually moved up by 10 to 15% in last 6 months at the same time where India has actually corrected. This is exact reverse of what happened in 2023 and 2024. So in some sense, a reconciliation is taking place. To a reasonable extent, I would say that the India-specific reconciliation has somewhat played out. The global uncertainty and the global risk, I think those are yet to be priced in by the markets is what I would say, per se, Neeraj. With regards to what we are telling clients from a market standpoint, that have valuation compressed enough for us to go out and buy lock, stock and barrel? Answer is probably no. If you look at it, valuations on various metrics, whether you look at market cap to GDP, price to earnings, price to book, for the broader market, they are still anywhere between half to 1 standard deviation plus expensive. At a time where earnings growth is weakening and there is a very serious risk to the very high margins. So to that extent, we are still somewhat on the cautious side. Having said that, we certainly do see opportunities emerging in a few spaces. The most interesting space to us at this point is the banking space in India. The simple reason is that while there as well, the growth concerns remain, but at least the regulatory aspects are getting better. And more importantly, valuations there are quite comfortable and are not really pricing in a big growth recovery of sorts per se, Neeraj. So overall, from a market standpoint, yes, it's still not yet reached a place which is very comforting to us, but there are certainly a lot of pockets where we think the worst is behind and probably it's worth accumulating some of those spaces per se, Neeraj.
Well, that's all the time that we have on the show from myself and the team members who's put the show together. Thank you so much for watching. Stay tuned to NDTV Profit. Lots more action on the other side.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the trading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
Private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Reviksit Bharat.
बजट भाषण सुना उसके बाद मेरा पहला एक्रोनिम निकाला मैंने, वो था RRR, रिस्पॉन्सिबल, रिफॉर्मिस्ट, और मैंने कहा रिवॉल्यूशनरी। हाउ डिड यू अराइव एट दिस नंबर ऑफ 12 लाख रुपीस?
हमें लगता है टैक्स पेयर उस लेवल नंबर से टैक्स भर रहा है, क्या उनको हम कुछ कर सकते हैं?
प्राइवेट सेक्टर कैपेक्स अभी तक वो इन्वेस्ट क्यों नहीं कर रहे हैं, जबकि आपका इकोनॉमिक सर्वे ही बताता है कि वो कैश पाइल पे बैठे हुए हैं।
अगर कंजम्पशन बढ़ता है और उसके तहत लगता है कि ग्रेटर इन्वेस्टमेंट का पॉसिबिलिटी है, वो भी अच्छा ट्रिगर हो सकता है।
AI बहुत तेजी से आ रहा है, तो जॉब के चैलेंजेस होंगे, स्किल के चैलेंज पहले से हैं, तो जो ट्रांजिशन पीरियड का स्ट्रगल है, नौकरी मुझे अभी चाहिए।
पूरे साल का एक्सपोजर दिलाने के लिए हम इंटर्नशिप प्रोग्राम ले आए और इसके साथ साथ इस बजट में भी ट्रेनिंग फॉर AI इसके लिए सेंटर्स बनाए हैं।
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Hello and welcome back to NDTV Profit. You're watching Profit Buzzers. I'm your host Mika Barve, and with me is Anushi Vakharia. Well, up first, let's just take a quick look at how markets are faring. The Nifty continues to see some weakness. It's trading fairly flat, however, but with a negative bias, down about 0.09%. If you see the breadth of the market, total market, you have around 1,756 stocks declining versus just 346 stocks advancing. If you want to take a closer look to the Nifty 50, well, 35 stocks on the benchmark are in the red, while 14 are in the green and 1 remains unchanged. Something that's dragging down the benchmark is an Ultratech cement, down about 5%. We'll speak about why in just a minute. But you have some weakness in counters like Hero Motor, Trent, BPCL, all seeing cuts of over 2 to 3%. Something that, however, is gaining some strength is the Shriram Finance, up 4.5%, followed by more of your banking and financial services names, something like a Bajaj Finserv, a Bajaj Finance, as well as an IndusInd Bank, Axis Bank. That entire BFSI pack actually is what's in the green on the Nifty, on a Nifty 50. But Anushi, broader markets, underperformers, heavy correction again.
I think that's the
it's
one saying that we keep on saying every day.
Yeah.
It's a blood bath across the broader markets that we are looking at. In fact, let's pull up the Nifty Midcap 150 index and see what it is doing. Currently down about 1.52%. It's been on a downward trajectory since the start of this morning. In fact, let's pull out some of the stocks which are not doing so well in trade today. And we have stocks like KEI Industries, the biggest dragger. It's seeing a cuts of around 19, almost 20% today in trade, and this is on the back of Ultratech's entry into the cable and wire segment. In fact, let's pull up stocks from this sector. We are looking at something like RR Cable plus Polycab as well, and we are seeing similarly 14% of a cut here for RR. For Polycab, we are seeing about 16% of a down tick. So the major impact is about the EBITDAs, what this could mean for the key players, how the competition scenario would be like. But that is something that Mika is going to address later on the show. But a couple of other counters, if we see what is happening to those. Now, we have Lloyds Metals and Prestige also. Prestige, there was a Axis Capital note wherein they've initiated a buy call with a 52% of an upside. But despite that, we are looking at a 5% of cuts in trade today. Some couple of other counters, Suzlon, RVNL under pressure. But while you know there are a few specks of green also that we are seeing. We have AU Bank with about 5% of gains, M&M Finance, Bayer Crop seeing 3-4% gains, and like while on the cable and wiring segment we are looking at significant downtick. It's the NBFCs which is somewhat pulling up the index, if we can see somewhat like that. In terms of where the small cap is also there, we are looking at cuts of around 1.82%, and this is on the back of stocks like RR Cable, Vijay, Inox Wind, IEX and more. But to discuss more, one stock which is in continuous focus is the cable and wiring. But before we go to that, let's welcome our guest for the show, which is Asta Jain, the Senior Research Analyst at HAIM Securities. Asta, one question which is common in this last few weeks is again about the markets and especially the broader markets. Want to understand your take. Is there, I know that this is too early to comment on, but still, is there a hope of recovery that we can still see?
Hi, good afternoon to all of you. So since I track technicals also, so I want to comment one thing over here is that still markets are not showing any sign of recovery. In order to get a good upside momentum, at least for today, we need to pass the important resistance level of 22,600. So any close above 22,600 or 22,610 can give a positive momentum to the Nifty going ahead. But that is the major thing which we really need to look after. Till then, I think markets are still in the downside mode. And now the next level which can be seen in the Nifty can be 22,500 and 22,475.
Got it. Let's talk about, two different packs. One is a Nifty 50 company and then is the cable and wires industry. And I want to talk about Ultratech first. It's hit a 5% intraday low. It's, it's funny how an 1,800 crore capex plan has led to around 15,000 crore of market cap for Ultratech wiped off today. Now, the company did announce Tuesday evening that they're going to enter the cable and wire sector in order to expand their presence in the construction value chain. They have approved a 1,800 crore capex plan, which will be spent over the next 2 years. And they're planning to build a greenfield plant in Gujarat, and expected commissioning is by December 2026. Now, the key question is whether it enter the cable or the wire segment. Now, the industry is currently focusing its capex towards the cable sector because of the growing demand. However, cables take around 2 to 2.5 years for product development, and they also have more hurdles in terms of client approvals because that varies across sectors. Wires, however, as per Citi, is a better segment to enter because it's easier to enter, but it's seeing slower growth and low utilization levels. And if you talk about if Ultratech Cement does have an advantage, well, negligible synergies in terms of your raw material sourcing, transportation and distribution. The cement has different influencers because cement is, the point of selling contact is contractors, and while as for wires and cables for wires, especially it's electricians, and there's no right to win for the company in terms of manufacturing or distribution. And brokerages have cited concerns the entry could hurt Ultratech's positioning as a pure play cement as per Citi. JM Financials, Axis Capital as well as Jefferies have also cited investor concerns around capital allocation. One thing that stood out was when Ambit Capital says for an investor who is investing in Ultratech, why would they want to be saddled along in another business? And then on the other side, you have cable and wire companies heavily under pressure. There you go on your screens, a Polycab, an RR Cable, KEI Industries, even a Havells India and a Finolex Cables, all under pressure, all 5 to 20% of cuts, and the trigger was this news. Now, Ultratech's 1800 crore investment is actually 22% of the total gross block of the top 7 listed players. And gross block is basically the total value of a company's investment in fixed assets before depreciation. So the entry, like you can see on your screen, could hurt the industry EBITDA pool, similar to paints. Margin contraction is likely, just how we saw in paints. Analysts are also saying there's a potential for a price war, and an inorganic opportunity for faster expansion cannot be ruled out as well. And lastly, you saw Motilal Oswal actually cut valuation multiples for the entire of its cable and wires coverage. They've cut valuations for something like a Polycab India, KEI Industries and an RR Cable by 20%, and that for Havells by 10% because it does have other businesses. And they've also downgraded the ratings on KEI Industries, RR Cable from a buy to a neutral. So Asta, I'll come to you. First question, I want to understand your view from an Ultratech point of view. Do you think this could be capital misallocation, or is the Birla Group, diversifying too much?
So as we all know that Ultratech is already selling, some sort of cable and wire, and because in December only they have around 130 stores under UBS, that is Ultratech Building Stores. So they are already selling wires through those stores. It is around 4,500 stores at present point of the time. Secondly, I think this kind of investment can have a positive impact on the Ultratech, but not in the short term, maybe in the longer term, because it has a potential to move the revenue from present rates to a higher growth rate. So, but it is all a long-term story. Definitely in the short term, we all know that these companies are really facing margin pressures. So that can be case for Ultratech as well. So my idea here is this kind of news which has come, it has a negative impact across the sector and also for Ultratech, because whatever they are planning to do, it takes almost 3 to 4 years to show the results. So till that time, this kind of investment will definitely have a way on the balance sheet. And that is why we are seeing Ultratech stock is also not performing in line with what the company is saying, or it should be a positive for the company. So idea here is to stay invested in this counter, although today's news has really have a negative impact on this counter, but looking after only this news, don't get out from the stock. Let the stock stabilize and then make any sort of decision. So right now it's just wait and watch for Ultratech Cement. On the other hand, if I talk about the other cable and wire manufacturers, I think it is not a very market disruptor for them, at least in the shorter term, because they have a very established market and they have set market for long than 20, 30 years. So I think it is a negative for them in the shorter term, but not in the longer term for wires and cable.
Okay, so are you saying from a financial perspective, till at least the plant comes on stream, which is next year's this, there won't be any impact, and right now the kind of weakness we're seeing in the cable and wires counters is purely sentimental?
Yes, because this is a news based, although I mean all that business disruption will happen, it will happen in the longer term. But in the immediate term for the cable wire stocks I'm talking about, there is no so much of a big threat. Although due to the news, definitely one kind of impact is there, but in the longer term, they have their own established markets where they are selling. So I don't think in the longer term, it will create any sort of impact. Remain invested in the wires and cable stocks. The only problem with those stocks is their valuation, and that is why we are seeing more sort of beating up. I think that is the only concern for these companies. Otherwise, there is no fundamental issue as far as I suppose at this point of the time.
We've also, but there are several views that we've come onto the day, and we spoke to Praveen, the senior research analyst at PL Capital, and he spoke on how the competitive industry could, competitive intensity could increase in this sector. Do listen in.
The entry of Ultratech with a very high capex announcement of 1,800 odd crore considered to be the way forward competitive intensity to heat up in the sector. But definitely in this sector, it's not like putting up the capacity, especially in the cable. It further takes around 3 to 4 years time frame for a lengthy approval process to supply of the cables. Whereas wire is quite easy as compared to the cables to venture out, it's required a distribution and the brand is already with Ultratech. So I think they will start with where they had not disclosed one, but I believe they will start with the wire. I believe with their a lot of penetration in the retail in the different verticals. So this definitely treated as a sentimentally negative for the existing large peer set. Also, we know that large part is in the wire and cable is organized, or around six players account for around 54-55% of the market. So definitely, it's going to be a pressure to them.
Okay, so that was the overall outlook on the cable and wire industry, along with what the potential impact it could bring with Ultratech's entry into the sector. But shifting focus in a relief to non-banking financial companies, the Reserve Bank of India lowers the risk weights of bank loans to NBFCs to 100% from 125%. Now this comes after RBI in November 2023 had increased the risk weight on the exposure of banks by NBFCs by 25%. To tell us more about this development, we're joined in by Shtabana to give us a breakdown on the same.
NBFCs and banks, will benefit the most from this move. Now, there are two things to this. Now, the first measure, what the RBI has done is that they have lowered the risk weights, where they have rolled back, the November 2023 circular, where they have lowered the risk weights from 125% to 100%. Now, bank lending to NBFCs had increased. So, what the RBI was nudging so far that, NBFCs should diversify their borrowing. So, in that regard, bank lending to NBFCs was increasing, so they had increased the risk weights. Now that they have lowered the risk weights, a lot of lower rated NBFCs or non-deposit taking NBFCs could benefit from this, because access to capital will be cheaper for them. So FY26, we can see that borrowings for NBFCs could become slightly cheaper. Now in another move, what they have done is that they have clarified that bank loans to microfinance institutions will be exempted from such high risk weights. Now, back in November 2023, when they had announced higher risk weights on personal loans, overall consumer credit and bank loans to NBFCs, they had excluded housing loans and gold loans and such other loans. So they had not specifically mentioned MFI loans then. So in another circular, they have clarified that MFI loans will continue to be exempted from high risk weight norms, which means that internally, when the MFI stress had begun, a lot of banks had increased their internal risk weights to such loans. Now they can normalize those risk weights. They can normalize their internal credit risk parameters. So this is going to be a big move for banks and NBFCs. It's a major relief for the sector.
A big development for the NBFC players, but in fact, there are a couple of brokerages also saying about the RBI's move and financials in general. Puneet joins in with more details on the same.
Well, thanks for that. So brokerages have come out with what they think of this particular measure and who could be one of the biggest beneficiaries. So let's start out with Macquarie first. Macquarie mentioned that, this is one of the biggest messages in terms of, the regulatory overstate. They mentioned that a more accommodative RBI, which bodes well for all these particular players. Now, they believe that this will be good for the financial sector re-rating going forward. And it's reiterating Macquarie's bullish view on these particular stocks as well. They've also mentioned that unsecured loan growth has come down from roughly 25% to 10% in the period my colleague Subhana just mentioned. So the unsecured growth has also come down as well in this particular time weight. They believe in due course RBI is also likely to reduce the risk weight assets on these particular loans as well, and banks should see a 20 to roughly 250 basis points positive impact on the CET1 ratio as well. They see IndusInd Bank and Bandhan Bank as one of the biggest beneficiary of this particular move, so watch out for these stocks in trade today. The second brokerage is CLSA. Now, they mentioned that, after a lot of regulatory tightening over the last couple of years, this is one of the biggest positive moves for the particular sector. They see that clearly good things are happening for the banking sector in a much meaningful way, which should contribute in the numbers as well. And they estimate that Bandhan Bank will be one of the biggest beneficiaries based on, the MFI risk asset being recalibrated as well. And finally, on Morgan Stanley, on this particular topic as well, they mentioned that, they are expecting the CET ratio, which, Macquarie is also estimating estimating by 20 to 50 basis points. For Morgan Stanley, is roughly between 10 and 80 basis points, and the positive impacts for banks that they cover in their coverage. And they see that the mid-sized private banks should get higher benefit of this. So overall, it's a big positive move, as my colleague Subhana also highlighted, and some of the key stocks to watch out for, of course, with the higher MFI focus as well as NBFCs in this particular time frame as well.
Okay, well, thanks for that, Puneet. Some of the key stocks that Puneet was talking about, in fact, we can look at something like IndusInd and Bandhan Bank. Both of these have higher exposure to the MFI side. Let's look how they're doing. IndusInd about 1.65% up. Bandhan Bank seeing about 2% of gains. Let's also pull out some stocks like Fusion Microfinance. That is up in trade today, 5% or so. Oh, okay, it's lost some of the ground and it's about 2% up. Asta, I want to come to you on this development. Now, this is a big move for the NBFC sector. Want to understand your take on this development and some of the key players. What could be the impact on them? It's a key positive that we are looking at.
Definitely, it is a key positive, but still, I would like to bet upon the other NBFCs rather than the names which have been mentioned. And the reason behind it, first of all, yes, in the microfinance segment, we are not very much optimistic because there's a risk associated with that. So in that segment, not very much positive we are on right now, although the news is positive for the companies, but I think it is a momentary thing. So only one company, that is Credit Access Grameen, is looking little better in the entire space if I talk about the MFI space regarding the news. But we are still positive on the big NBFCs like Bajaj Finance. Secondly, M&M Financial is also looking decent to us at this point of time. And third, gold loan financing, in which Muthoot Finance is there. So these are few counters which we are still liking, despite the fact that this news which has come will be beneficiary for the other segment in which the MFI NBFCs are there. But still, we would like to recommend these counters in the NBFC space, and in the MFI, only Credit Access Grameen is looking good to us. So for Bajaj Finance, our target is 9,500. For M&M Finance, our target is more than 300. And for Credit Access Grameen, our target as of now is somewhere at around 1,100.
1,100 target for Credit Access Grameen, who, by the way, is doing pretty well in today's trade. It's up 13%. But something that's not doing is India's budget airline player, and that's a SpiceJet. It is under pressure now. Its profits did, bounce back to the positive around 25 crores, but this was because of a one-off income. We have Mahima joining us to give the key details of the company's Q3 earnings.
So, in terms of the key highlights of the earnings, well, there was an improvement of around 18% in available seat kilometers. The company has turned profitable, but this is because of one-off other income. In terms of the revenue passenger per kilometer rose by around 23% quarter-on-quarter, and passenger load factor also has risen to 84% from 81% QOQ. Lastly, cost per available seat kilometers also improved QOQ. So, operational metrics in terms of SpiceJet are improving. It came out with both its Q2 as well as Q3 earnings because Q2 earnings were pending to be reported. In terms of Q2 earnings, revenue was down by 36%. EBITDA lost to 210 crore and net loss stood at around 442 crores. But Q3 revenue was down by about 35%. EBITDA stood at 85 crore, margin stood at 6.9 and net profit at 25 odd crores. And this is, of course, because of a one-off rise in other income. This other income stood at around 419 crore, and this was this other income came along from restructuring of lease obligations with lessors. Now, in terms of a report on SpiceJet on the back of earnings, INCRED says that it believes that a scale-up of its operations could reduce FY26, could reduce in FY26. The company will be able to retain the entire benefits of the reduction in overall cost per available seat kilometer, and they have factored in that SpiceJet's entire fleet will be operational by FY26. In terms of QIP utilizations, overall 3,000 crore was raised, out of which 2,400 has been utilized. Out of which 600 odd crores have been utilized to pay off GST, TDS as well as EPF dues, and around 1,200 odd crores have been used to settle the disputes with aircraft lessors, and the claim was around 1,700 odd crores. Lastly, auditors, of course, have continued to flag off the going concern which is in danger, but management is of the view that the accounting needs to be done on going concern basis, and it's appropriate accompanying the company's statement. So both the views are contradicting, but this has been the case for SpiceJet since last year as well.
Thank you, Mahima, for giving us those details. Asta, I'll come to you. Some operating metric improvement, but when you dive deeper to the numbers, they're not that great. Would you still prefer an Indigo over a SpiceJet?
Sure, because Indigo definitely the financial performance is much better. They have got a very strong market share. So I think definitely the momentum is better for Indigo in the stock prices wise. And that is why Indigo is still looking good to us, because in the SpiceJet still we are seeing losses. And at the operational level also, if we exclude other income, the performance is not very, very great. So all in all, we are preferring Indigo over SpiceJet at this point.
Okay, so Indigo over SpiceJet is something that Asta is favoring on. But from airlines, let's shift focus to the railways. And this is on the back of a brokerage note that we are seeing Titagarh Rail in focus, the stock down about 4% after Morgan Stanley has cut the target price to 1,090 versus 1,300. So it's a 16% of a cut that we are looking in terms of where the target prices, which is quite significant. They've pointed out a couple of reasons as to why they are concerned about the trajectory going forward for the business. Firstly is the near-term execution challenges which would affect the revenue trajectory. Now do note that the company has two segments, one is passenger rail and the freight rail. While freight rail we've seen healthy set of numbers in terms of the revenue growth which is concerned. It's passenger rail which have been clocking in 50% of a downtick because majority of their orders are still in design phase. So this to actually turn into revenue is something that we should be looking forward to. But now the concern is on the freight rail. This is on the inadequate wheel sets from Indian Railways, which is constraining the offtake for the business. This is something that was seen in Q3 as well. The company pointed out in their conference call. So how this could affect the revenue is something that we should be watching out for. Now, despite being one of the key beneficiaries of the rail capex which is there, ordering, if you look so far, it has remained muted. In fact, in the passenger rail, the company in the 9-month period has not clocked any new orders as such. So this is something that we should be focusing on. Do note that in the rail sector, the government, the budget allocations stood at roughly 2.65 lakh crore, which was unchanged from last year's level. But Titagarh is a key beneficiary this, and along with this, execution in Vande Bharat delays with 9 months due to a change in design plans is something also that the street is now factoring. That's why we are looking at the EPS cuts on what the forward EPS were and revised PE multiples, and thus the target price now being revised to 1,090. Asta, coming to you for something like a Titagarh Rail, your outlook on the same, do you agree with some of the concerns that the brokerage note has pointed out?
Yes, I do agree, because let us address the fact that the company is the only Indian company which is into the wagons as well as coaches manufacturing, and a very strong market share in the wagon manufacturing of around 25 to 30%, with a very strong order book as well. But I think the execution risk is always there, and we are seeing that there are the delays in the execution as well. So I think that is the major concern about this counter as of now. Although financial performance was decent in the Q3 of FY25, but the execution delays is still, overhang on the stock, and that is why even we are seeing that the stock prices are not moving in the positive direction. So right now, our idea here is to stay, away from the stock. Don't invest in this counter. Just looking after that it has shown us decent, sharp correction on the downside. So let's wait for some more stabilization in this counter and then make an entry into this counter. So stay away from this counter as of now.
Right for Titagarh Rail. But on that note, let's take a quick break. But lots more lineup on the other side. Just stay tuned.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
for every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Reviksit Bharat.
बजट भाषण सुना उसके बाद मेरा पहला एक्रोनिम निकाला मैंने, वो था RRR, रिस्पॉन्सिव, रिस्पॉन्सिबल, रिफॉर्मिस्ट, और मैंने कहा रिवॉल्यूशनरी। हाउ डिड यू अराइव एट दिस नंबर ऑफ 12 लाख रुपीस?
हमें लगता है टैक्स पेयर उस लेवल नंबर से टैक्स भर रहा है, क्या उनको हम कुछ कर सकते हैं?
प्राइवेट सेक्टर कैपेक्स अभी तक वो इन्वेस्ट क्यों नहीं कर रहे हैं, जबकि आपका इकोनॉमिक सर्वे ही बताता है कि वो कैश पाइल पे बैठे हुए हैं।
अगर कंजम्पशन बढ़ता है और उसके तहत लगता है कि ग्रेटर इन्वेस्टमेंट का पॉसिबिलिटी है, वो भी अच्छा ट्रिगर हो सकता है।
AI बहुत तेज़ी से आ रहा है, तो जॉब के चैलेंजेस होंगे, स्किल के चैलेंज पहले से हैं, तो जो ट्रांजिशन पीरियड का स्ट्रगल है, नौकरी मुझे अभी चाहिए।
पूरे साल का एक्सपोजर दिलाने के लिए हम इंटर्नशिप प्रोग्राम ले आए और इसके साथ साथ इस बजट में भी ट्रेनिंग फॉर AI इसके लिए सेंटर्स बनाए हैं।
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in?
Hello, welcome back. You're watching Profit Buzzers. Let's focus on Jubilant FoodWorks as they host their maiden analyst meet today. Mahima joins in with the key takeaways of the meet.
Jubilant FoodWorks is set to host its first physical analyst meet today, and before that they've released their investor presentation. Now a couple of guidances that they've given in the presentation. First one, that they've said that they'll open 5 new food platforms this coming year. They've also said that the store count by FY28 will reach 3,000 stores. In terms of the town network, they will reach 700 new town networks, and they're targeting brand power growth in Gen Z segment by around 500 basis points. They aim to double in fact, they've said that their revenue and profits both will grow at a double-digit CAGR, and a 200 basis points margin improvement is something that they're observing. In terms of their overall built-in food platform, around 1,000 crores of annual sales is what they're expecting, and this will happen along with scale-up of their digital platforms. Free cash flow maximization is something that they're expecting overall. Now, all of these things, of course, have been mentioned in their investor presentation, but a couple of things to watch out for will, of course, be questions like the competition coming in from Zomato and Swiggy, how DP Eurasia after the acquisition has performed because Q3 was weak for them, and of course, how and what is their outlook with respect to Popeyes and etc. So, all of these questions will be something to keep an eye out in their overall investor presentation, and of course their meet as well.
Okay, well, thanks for that, Mahima. Asta, coming to you, your view on something like a Jubilant FoodWorks?
So what we have seen in the 9 months financial was the result of a revamped strategy which this company has made, and we are positive on this counter also. My idea here is to stay invested in this counter with a price target of somewhere at around 720 to 740 at the initial levels.
You on the QSR sector, if we see?
So, we are confident on the QSR sector, especially if I talk about the Jubilant Food, their LFL, like-for-like growth, which is a very important parameter for these companies. So, it has remained a strong, I suppose. And with the, there are other brands also are working very good. I suppose Popeyes is there, Coffee is there, Domino's Bangladesh is there. So, I think for Jubilant, it is a really healthy outlook which we are seeing for this counter, and for the QSR space also we are positive on the back of their LFL growth.
Another stock which is in focus is Prestige Estates, and this is after Axis Capital has initiated a buy call on the stock. Now, what we are looking is with a target price of 1,800 and not 52% of an upside that we are seeing. A couple of reasons that they have pointed out. Firstly, near-term recovery which is inside. Along with that, they're targeting a 34% of a CAGR growth in terms of where the pre-sales are concerned, and this is over FY25 to 28 period. Along with this, they're on track to achieve a better growth in their annuity business also. Now, if you do look back to the couple of quarters, Prestige has reported a downtick in terms of where the pre-sales numbers have been concerned on lack of approval challenges. So, Asta, your view, it's a significant upside that has been given by Axis Capital. So, want to understand your view on Prestige Estates.
So the strong launch pipeline is definitely there for this counter, which we are seeing. And in fact, their capex plans are also very, very strong. So this counter, I think it is a strong counter in the real estate space. But right now, I believe that due to the high valuation, and we really need to see how these, pipeline, how this project pipeline will get executed. So I think idea here is if anyone has this counter in the portfolio, they can remain invested. But for making a fresh entry, it's better to wait for the lower levels. Maybe at around 1,080 or 1,090 are the good levels to make entry into this counter. Right now, wait and watch is the strategy which we are recommending for this counter.
Thank you, Asta. But now we're shifting our focus back to one of the top stories of the day, and we're focusing on KI industry because we're getting joined by the management just right now. Joining us to have a conversation is Mr. Anil Gupta, the CMD at KI Industries. Welcome to the show, Mr. Gupta. My first question to you, I mean, there's a lot of chatter after Ultratech has announced its foray into the cables and wires industry. Your view on, do you expect the competitive intensity in the industry to now, further rise?
Good afternoon. I don't think it will have any impact on the existing well-entrenched cable companies. Reason is that Ultratech will take another 3 years to come into the market, another few years to establish themselves as a brand and their channels. Secondly, the market is growing significantly by 13 to 15% every year. And by the time they come, the market would have grown by almost 70% and almost double. So there is a space for another entrant for another 5 to 10,000 crore market share. And I don't think it is going to impact our growth and our margins in any manner.
Mr. Gupta, good afternoon. Neeraj here. The question mark may not be necessarily only about the next couple of years, sir, but what happens over the slightly medium term, wherein there were, let's say, 2 or 3 key leaders in you and a couple of others, but now there is a large, deep-pocketed competitor who will come in, and while it's a low margin business and therefore price competitiveness is difficult, but might still cap operational profits due to competitive intensity by a deep-pocketed competitor?
Sir, the competitor is deep pocketed, but our company is also deep pocketed. We are also absolutely zero debt company, and with very high cost efficiency in production and in all operational areas, and a very strong, well entrenched channels, and also the direct marketing in the, all over the world. So I don't think that any competitive intensity will lower our margin. Even if a new competitor try to disrupt the market by reducing the prices, they will not be able to take the market because of the limited brand visibility and limited capacities and accessibility. I mean, these are fears which are, I think, overreaction of the market, and I would like to allay this fear to our investors and the viewers.
Which is good to know, Mr. Gupta. One of the questions that was there, that while some people who are talking about how there is not enough synergy between the existing products of Ultratech and the space that they've gotten in, which is dominated by you, let's say, but the B2B market is open for a company like Ultratech to sell and capture market share. Is that a valid argument, sir?
You are absolutely right. This is an unrelated product to them. And I don't think that it relates to any value chain in synergies of their existing product. Secondly, B2B marketing is much more difficult. In the cable industry, B2B means we are selling to EPC contractors and various other contracting companies, big or small, and which is generally done with the, this is most of the credit sales and generally done on the past experiences with the customers. We have a lot of SKUs available with us, which will not be available to Ultratech, because the kind of cables we make for every sector of economy, a newcomer will take 15 to 20 years to learn and understand that business. So I'm in no way Ultratech will be in any manner a competition to us in any manner.
Mr. Gupta, this is Anushi joining in. While you're saying that there would be no impact on competition, there are still a lot of concerns about the margin contraction which can take place. Now, while currently the near term we are looking at volatility in the prices that are there, assuming that Ultratech's entry would result in higher competitive intensity, how do you see the margin picture panning out?
See, in this industry, margins are already, anywhere between 10.5% to 11%. How much one can, dent their margins? If somebody has come to only enter the market without any price levels, so one has to understand, once the prices are broken, it is very difficult for them to also to increase the increase the prices. So I'm sure that they will not be disturbing the market by price points. Maybe they may try to use their channels of cement and paint to sell the wire to the to the construction industry. Beyond that, I don't see any risk, and the impact on cables will be very, very small.
Moving on, I just want to get your sense of, the demand picture. You have exposure to cables as well as wires. We've seen the growth in wires kind of being subdued. It's, tilting towards the cable segment. Your outlook for the next, 2 to 3 years, do you see, the demand for wires picking up?
Demand for wire and cables is very healthy. In my earlier interviews, I have said that our product mix is 75% cable and 25% of wires and flexibles, and we will continue to maintain the same projection in our product portfolio. And I do not see any reason for any margin contraction due to entry of Ultratech or to the competition intensity.
Mr. Gupta, sorry, please finish your point, sir. Please finish your point.
No, I have finished my point.
Okay, fine. I have a couple of questions, sir. One is in the previous answer, the channels that you said a company like Ultratech or whoever else might have been in this case can use, right, direct EPC contractors to the paint dealers, etc., etc. Does that give them a head start versus any new competitor coming in and trying and taking away some market share? Not now, let's say 2 years out. And could that be something that people should watch out for?
See, in any industry, it takes many years to learn that business. We are although a professionally run company, but still, directly managed by promoters who knows the business for almost more than 40 years now. And, disrupting the businesses by price points does not happen. For cable business, you have to go through a lot of approval processes, which we have also gone through, and it has taken years. One has to understand the dynamics of this industry. A lot of stocking is required, pan India to meet the delivery requirements in just in time. I mean, I can't say beyond that because it is an unrelated industry for Ultratech, and I mean, the kind of SKUs which are operative in industries are hundreds and thousands. So until a company is able to, learn that, it will be very difficult for them to, disrupt the market.
I have one question, sir, on your plans. I mean, you mentioned in the past that you believe that over the next 2 or 3 years, you might actually see margin expansion based on efficiencies and growth, etc. Do you stick to that, one, right now in the current context, not just for the next 1 year, but maybe say 2 years? And two, would you believe that there will be a need to shore up the balance sheet, raise some capital if indeed, like you said, you are also deep pocketed, so I completely appreciate that. But because there is one more competitor there, would you feel the need to do any kind of shoring up of the balance sheet with capital over the course of the next 12 to 18 months, if indeed the expansion plans get aggressive?
Our expansion plans are already aggressive. We are, doing a capex of around 1,800 crore in this financial year as well as next financial year put together. And we'll continue to do a capex of 700 to 800 crore for next 2, 3, 4 years, and that too from our internal accruals. And so far as efficiencies and deep pocketing is concerned, we are also a cash-rich company without any debt, and we don't need to raise any further capital to go aggressive on our capex plan. And we continue to maintain that we should be able to grow at a 20% CAGR level for next 5 years, and maintaining a EBITDA of anywhere between 11 to 12% of maybe once we achieve these economies of scale.
Gupta, one of the big capacity expansion plans that I'm assuming that you're talking about is the Sanand facility. Want to get a sense on what is currently the update on the capex over there, the incremental revenues from where on we can expect that. And considering all the chatter about the new entrant, do you still maintain the revenue guidance that you've given for the next 2-3 years, which is in the upwards range of 16 to 17%?
I said that our first phase of Sanand is expected to be operational by July this year, and we maintain that we should be able to grow by around 20% plus CAGR level for next 3 to 5 years, and the whole project should be completed by March 26 in Sanand.
One last question is on your order book, a pending order book around 3,800 crores. How much could we expect, coming in Q4, and what are your order book growth, expectations as well?
See, our order book will remain similar to these figures, 3,800 to 4,000 crore, because we normally execute our B2B orders maximum within 3 to 4 months, and the 50% business which comes through dealer network is executed within 15 days out of stocks. we do not take into consideration in our order book the orders coming from dealers market. Only the B2B orders are shown in the order books. So our order book will not look very big as you see in the EPC companies.
Got it. Thank you so much, Mr. Gupta, for joining us, giving your investors as well as the industry investors some kind of relief, and we wish you all the best for your future plans. Well, that was the management of KEI Industries talking to us in much detail, and has stated that Ultratech or any other new entrant in the market will not have a margin impact on the company. But we now shift our focus to multiple order wins and MOUs that have been signed in the last 2-3 days, and we have Rucha joining us. Rucha, most of these were with the Assam government, weren't they?
I'll start with Mastech. Well, the company has gotten multiple contract orders from UK Public Services Department, which is spread over a period of 2 years, and the contracts are worth over $85 million. The order book as on the third quarter stands at about 2,140 crore rupees, which is up about 1.5% YOY on a constant currency terms. Moving on to Cupid, well, this one has also received purchase stores department. Well, not much a bigger contract. Contract is just worth about 42 crores, but yes, this has to be executed between May and July 25. Moving on to RailTel, this one has secured 2 orders from South Central Railway. First one is of 111 crore rupees approximately, to be executed by about August 16, 2026. Second order is about 57 crore to be executed by May 13, 2026. The total order book stands about 5,280 crore. Next up is EGR Infra. Well, yes, as you rightly mentioned, they entered MOU with Government of Assam. This one is for establishment of development of ropeway. Now, this one is to remain valid for a period of 12 months from the date of signing, and the proposed investment in the project stands at about 270 crore rupees. Moving on to talking about Tata Power. Well, this one has signed an agreement with Assam government for 5,000 megawatts of renewable energy project. This project will involve about 30,000 crore investment, and the project will include renewable projects around solar, wind, hydro, and energy storage as well. The company's subsidiary will collaborate collaborate to increase rooftop solar adoption, and this project is expected to create about 3,000 jobs for local youth. So even though all these stocks have positive news, most of them are down in the red. As I talked about Tata Power, this one is down about 2.5% in trade. RailTel was largely trading flat, but yes, this is because of the bloodbath in the overall market and the market sentiment that we saw over the last couple of sessions as well. But this is positive news which I mentioned for the respective companies.
Okay, well, thanks for those details, Rucha. Asta, coming back to you, a couple of interesting names that Rucha was talking about in terms of developments with the Assam government. Firstly, Cupid, RailTel Corporation, GR Infra in focus. We also have something like a Mastech, which has received multiple contracts. Any of these names that stand out to you?
So I think RailTel is a better place to go on rather than these other counters. Now, talking about this counter, although we know that the company is not able to perform strongly in the stock performance wise, if I talk about. But yes, I know due to the overvaluation, we have seen a strong downside momentum in the counter. But these order books are so strong that definitely it gives a strong revenue visibility to the company going ahead. So RailTel is looking good to us, and we are recommending hold, not a buy, because this time the stock is in the downward trajectory. So maybe it fall more from the current level and gives a better opportunity to buy into. So at around 270 or 265 odd level, which is a good entry levels also for this counter. But for a person who has this counter in this portfolio, can remain invested with the initial price target of 330.
Okay, well, thanks for that, Astha. But you know what, now let's shift focus, and we have Somit talk to us more on the expected flows on the MSCI adjustment. Somit, what can you tell us about this?
Well, as the MSCI announcement for the changes were announced long back, but what will be happening tomorrow is that the flows regarding the changes that the MSCI has announced will be coming in, and the flows are expected in the last half an hour of trade. So the net passive inflow is expected to be anywhere between $850 million to $1 billion in the last half an hour of trade. and which are the stocks that we need to watch out for. Firstly, it's Hyundai, which has been added to the MSCI index, and $255 million of inflows is expected, which is nearly 11 times its 20-day average volume. Apart from that, few stocks which are seeing an increase in their weightage, like IndusInd Bank, which is expected to see an inflow of 258 million. Then there is Zomato, Varun Beverages, Mankind Pharma, Torrent Pharma, which could see inflows of anywhere between 43 to 107 million US dollars. And then there is PB Fintech and Torrent Power, which could see inflows of around 8 to 32 million US dollars. On the flip side, one stock that is moving out of the index is Adani Green Energy, and because of that, there could be an outflow of close to 167 million US dollars, which is nearly 4 times its 20-day average volume. So keep an eye out for these stocks in trade. The flows are expected in the last half an hour of trade, around 850 million to 1 billion US dollars on a consolidated basis.
Got it. But, Sumit, stay with us, because airfares do remain firm in the March quarter and otherwise a seasonally weak travel period. Now, as airlines have leveraged their pricing power on one key destination where fares surged beyond 50,000 rupees, a level that even flights to Asian international destinations typically do not reach during peak tourist seasons. What do you have for us?
Well, yes, airfares have remained very strong when it comes to the fourth quarter, specifically because of the Mahakumbh event also. But apart from that also, when we check the top 20 routes in India, what we understand is the airfares have continued to remain on the higher side compared to what we had seen last year, and also compared to what we had seen pre-Mahakumbh event. Now, we checked the airfares on Feb of 24th, and we have done it for two data points, that is the 7-day forward route and the 2-month forward route. Now, for the 7-day forward, if you look at compared to pre-Mahakumbh prices, for 3 routes only we have seen a decline, while the prices for the 3 routes, it has declined by around 4 to 16%. For 4 routes that we had seen, the prices have remained unchanged, while for all the remaining routes, we have seen prices increase by anywhere between 2 to 46%. Now, this is compared to the pre-Mahakumbh period. Now, if you look at compared to last year, 10 routes have seen a decline of around 4 to 19%, but the remaining 10 routes have seen a hike in prices of anywhere between 5 to 49%. So that's a massive hike coming in the fourth quarter compared to last year. Now, which are the routes which have seen the highest increase? It's Delhi Patna, which has seen an increase of around 49%. When there is Patna Delhi, 34% increase. Hyderabad Mumbai, Bangalore Mumbai, and Delhi Hyderabad have seen a hike of anywhere between 8 to 22%. On the flip side, routes that have seen the highest decline is Mumbai Kolkata, 19% downtick compared to last year. Pune Delhi, Bangalore Delhi, Delhi Kolkata and Delhi Bangalore routes have seen a decline of anywhere between 9 to 13% compared to last year. Now, if you look at the 2-month forward rate, which is the holiday period or the key earnings period for an airline company, that is the April month. Now, in that, among the top 20 routes, prices for 4 routes have seen a decline of anywhere between 1 to 9%. Apart from that, 6 routes prices have remained unchanged, while the remaining 10 routes have seen an increase of anywhere between 2 to 34%. So, a solid increase that we are seeing compared to the pre-Mahakumbh period. For the 2-month, however, if you look at compared to last year, if you look at, prices of 12 routes have seen a decline of anywhere between 3 to 21%. So this could be a concern coming in, given the fact that this is a strong period for an airline company, and compared to last year, if you're seeing a decline, their earnings could also take a hit. And prices for 8 routes have seen an increase of just 1 to 18%. So routes which have seen the highest increase, firstly, if you look at, it's Patna Delhi, again standing here, 18% increase compared to last year. Hyderabad Delhi, Mumbai Hyderabad, Bangalore Mumbai, Delhi Pune have seen an increase of just 5 to 9%. But on the flip side, the routes which have seen the highest decline, Kolkata Delhi has seen a decline of nearly 21% compared to last year. Then there is Kolkata Mumbai, a decline of around 18%. Delhi Hyderabad, Chennai Delhi and Delhi Kolkata, which are one of the top major routes in India, have seen a decline of anywhere between 14 to 16%. So what we understand out of collecting of this data is that Q4 could be strong for airline companies, but the holiday period of the first quarter of FY26, at least the early trends are suggesting that ticket prices could be weaker compared to last year.
Thank you, Sumit, for giving us those details. Astha, I'll come to you. I know we already spoke about airlines. You gave your view on SpiceJet, you gave your view on Indigo. But I want to spin this in a different angle in terms of, your tourism counters. Any one from this pack that, catches your eye?
Yes, first of all, Indigo is always a favorite choice because it holds 62% market share in the overall aviation industry. So here would like to give 4,700 as a price target. And in the tourism sector, I am more positive on hospitality industry, in which Indian hotels and Taji Vicky Hotel, these are few counters which we really positive on at this moment.
Okay, well, thank you so much, Asta, for that, and in fact sharing details on other various counters in this last 1 hour or so. But that's all the time that we have on this show. Stay tuned to NDTV Profit. Lots more updates coming on the other side.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
भाषण सुना उसके बाद मेरा पहला एक्रोनिम निकाला मैंने, वो था RRR, रिस्पॉन्सिबल, रिफॉर्मिस्ट, और मैंने कहा रिवॉल्यूशनरी। हाउ डिड यू अराइव एट दिस नंबर ऑफ 12 लाख रुपीस?
हमें लगता है टैक्स पेयर उस लेवल नंबर से टैक्स भर रहा है, क्या उनको हम कुछ कर सकते हैं?
प्राइवेट सेक्टर कैपेक्स अभी तक वो इन्वेस्ट क्यों नहीं कर रहे हैं, जबकि आपका इकोनॉमिक सर्वे ही बताता है कि वो कैश पाइल पे बैठे हुए हैं।
अगर कंजम्पशन बढ़ता है और उसके तहत लगता है कि ग्रेटर इन्वेस्टमेंट का पॉसिबिलिटी है, वो भी अच्छा ट्रिगर हो सकता है।
एआई बहुत तेज़ी से आ रहा है, तो जॉब के चैलेंजेस होंगे, स्किल के चैलेंज पहले से हैं, तो जो ट्रांजिशन पीरियड का स्ट्रगल है, नौकरी मुझे अभी चाहिए।
पूरे साल का एक्सपोजर दिलाने के लिए हम इंटर्नशिप प्रोग्राम ले आए और इसके साथ साथ इस बजट में भी ट्रेनिंग फॉर एआई, इसके लिए सेंटर्स बनाए हैं।
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really
welcome to NDTV Profit. You're watching Top Trades. I am your host Varsha, and let's see, how are the markets faring up. Well, to begin with Nifty 50, it's down almost 1.07%. Let's see, who are the constituents. Let's see who are the losers. When it comes to benchmark index, you have Ultratech Cement, which is down. Of course, Ultratech is planning to invest into cables and wires segment. They're going to invest almost 1,800 crores of investment into construction segment. Then you have Hero Moto, then you have Trent, BPCL, Grasim, which are in the losers when it comes to benchmark index. But let's talk about gainers as well. You have Shriram Finance, you have Bajaj Finserv, you have Bajaj Finance and IndusInd Bank, who are gaining today. There you go. Then let's pull up heat map. Let's see which are the sectors buzzing or losing today. Well, I think except Nifty Bank, everything is under pressure. You talk about Nifty Metal, you talk about Nifty Infra, everything is in pressure except Nifty Bank. Let's just talk about broader markets as well. Let's talk about Nifty Midcap 150. What it's doing? It's Nifty Midcap is down almost 1.31%, mirroring the benchmark indices. Let's see what are the losers on this broader market. So you have KEI Industries, you have Polycab. Now KEI Industries and Polycab are under pressure, and also on the back of Ultratech venturing or coming into cables and wire segment. Of course, there's going to be pressure when it comes to all these counters. Even we'll also see in small cap segment also, RR Kabul is also under pressure on the back of this news. But sticking to Nifty Midcap 150, Adani Wilmar is also under pressure. Prestige is pressure. Now, one of the reasons might be the ongoing investigation, income tax surge going on into the premises of Prestige. That was the yesterday's, or rather day before yesterday's news. Well, on the gainer side, you have AU Small Finance Bank, Bayer Corp, L&T Finance, and M&M Finance as well. But joining me, we do have Somit. Somit, how are you looking at markets?
Well, it continues to remain sideways, not much of an action that we are seeing. Well, yes, as you were mentioning, Ultratech, Polycab, KEI Industries have been declining on the back of the announcement that the company will be entering the wires and cable segment, but they have capped the investment at around 1,800 odd crore rupees. But moving out of that, onto an NDTV Profit exclusive, IKEA launches its online delivery in Delhi NCR. The online service will be available in 9 northern markets outside Delhi. My colleague Sesha spoke to Suzanne, the CEO of the IKEA India branch, about this new quick commerce services. Listen into that right.
When it comes to quick delivery, when it comes to furniture, I think we are quicker than many others. So the day after you order, you can get your whole furniture home. And if you want to have a full kitchen, you can in a week get it delivered, installed and ready to use. I think that's quicker than many others could supply. But when it comes to the smaller items, we are with a very curious mind looking into what is really the need from consumers. So we are trying now to understand in our sector and our segment of home furnishings and accessories, is it 10 minutes or is it 2 hours or is it a day? What is it that makes sense? And of course we will accommodate to the needs of consumers in this case. But it's something unique that is happening in India with the quick commerce, not seen in any other country in the same way.
Right, but affordability has been a key strategy for IKEA, and you have been trying to reduce the prices in order to cater to all kinds of customers. So what is the current average prices that IKEA sells, and also how has been the journey towards affordability? By how much have you been able to reduce prices, and what kind of consumer demand have you seen as a result of this?
Yes, affordability is key thing for IKEA, and to be affordable you need to be low cost. So it's a value of IKEA to do everything as low cost as we can, not the products though, but the way we operate. So we try to always be very cost sensitive to be able to keep our prices down. Then we work with the whole value chain to create the volumes and the scale of advantage, being smart in logistics and in any possible way save where we can save without compromise compromising on the quality. That is how the IKEA low price has been created over the years. And in India, we know that it's even more important than in many markets to be affordable, to have affordable prices. And here we, of course, have price and quality ladders in every function. And in every function, we make sure we have something that has a low price to be affordable. And we have 1,000 products under 200 rupees to make it possible for most people to buy something at IKEA.
Right, absolutely. Also, Delhi is a market where you have started with online first and then offline. What led to this change in strategy? And does it mean that you will go on offline expansion in a slower pace than you had done earlier?
I wouldn't say we go offline slower, but if you build a flagship IKEA store, it takes more time. But the main reason for going online first is what we have experienced in Bangalore and in Mumbai when we opened, that gives us an insight in what are the customer preferences. We learn more about the market. We can plan the offline experiences better and create stores that are even more relevant for the market. So it is a good way to start with the backbone of logistics and online, and then build a full omni-channel experience with offline.
Well, on to the biggest news of the day, Ultratech's investment in the cable and wire segment. They have said that they will invest close to 1,800 crore rupees in the cable and the wire segment. But what would be the impact on Ultratech of this and on the cable and wire makers? We have Mihika joining us with all those details.
It's an 1,800 crore investment. You're right about that. Over the next 2 years, they're planning a plant in Gujarat. But the question lies if Birla Group as a whole is over-diversifying. In terms of your past ventures, they did announce India a jewelry ban. They were going to invest close to 5,000 crores and open 100 stores in the next 18 months. And they aim to make it one of the top 3 jewelry retailers in India within 5 years. Another one was Birla Opus. We've spoken a lot about it. It's the paint brand. They announced its entry in 2021 and launched products in 2024. And the company does target 10,000 crore revenues and to turn net profit positive in FY28. And the Birla Group as a whole is already in a battle in 2 segments. One is a telecom with Bharti Airtel and Reliance Jio, and in the apparel segment as well with Reliance, Trent and Shopper Stop. Now, what was common, Grasim, in the paint industry and what helped, and you saw kind of pressure on other paint companies, is that the distribution network of Birla White and Birla Wall Care Putty, and around 70% of its dealers also sold paints, which helped Birla Opus and made the dealership reach second when you compare it to Asian Paints. But when you compare Ultratech and whether it has anything common with the wire and cable industry, the simple answer right now is no. They have negligible synergies in terms of stuff like raw material sourcing, distribution, as well as transportation. And the influences are also different. In cables and wires, it is electricians, whereas in cement, it is contractors, and neither cement dealers sell wires as well as cables. In terms of what could go wrong, well, amongst wires and cables is growing faster. One is because of higher demand from sectors like power, data centers and other infrastructure projects. But on the flip side, cables do take 2.5 years in terms of product development, manufacturing and other things. For wires, on the other hand, the time to enter the market is low, and some analysts do believe that because of Ultratech's better brand recall, it would help. Lastly, potential financial impact. I'll just go through over that. 1,800 crore capex has been announced. An assumed 4.5x asset turnover gives a revenue potential of 8,100 crores at a 10% EBITDA margin, 810 crore EBITDA level, which is 4% of the FY27 consensus estimates. But there is investor concern about the capex allocations that brokerages have been citing.
Well, thank you, Mihika, for that detailed analysis. Well, let's also welcome in our guest, Prashant Tapse, Senior Vice President, Research Analyst with Mehta Equities. Prashant, coming to you on this announcement that Ultratech has done, do you think was this diversification even worth, given the fact that at best the upside to the EBITDA would be just 4 to 5%, that too even in FY27, FY28?
I think, as per my understanding, it's a over diversification by the group, which will not be benefiting the company immediately for next 2 years. Obviously, the sector is very high competitive. Even Polycab, KEI, or RR Cable, they are fighting for getting a EBITDA margin of 10 to 15% in the last few years. But obviously, Ultratech is thinking they can utilize their brand to explore and go and reach to the end customer. But I think it's a very difficult decision they have taken. And obviously, today the price is showing that a lot of analysts like me are not happy with the decision right now. With 1800 crores investment, they may be doing 3 to 4x of asset turnover ratio, which is around 7 to 8,000 crores. Obviously, even that is very much below to Polycab, which is almost 21,000 crores market cap, 21,000 crore top line company with a EBITDA margin of 14%. I think it's a very risky call taken by Ultratech.
Well, moving on, let's also pull out SRF. Let's see what that counter is doing in trade today. Well, it's almost up 3%. Now, the stock is buzzing about 3%. This is after MK released a note saying that they are positive on the stock and they've maintained the buy rating. Let's see what are they saying. So they are expecting a gradual pickup in specialty chemicals on stabilization of existing products and benefit of newer products. They say that the worst is behind for all the businesses of SRF, and the refrigerant gas prices firming up stands positive for the company according to Brokerage, and the packing film business is expected to improve on narrowing of demand supply gap in the next 2 to 3 years. Now, according to MK, SRF is best placed with capex ready in the specialty chemicals business and a complete basket of refrigerant gases to garner benefits of the agrochemical cycle turning around and improving the refrigerant gases globally. And the new AIs, that is the active ingredient. So the new AIs will start contributing meaningfully from FY26 and reach optimal utilization by FY28 as per MK. The total opportunity of manufacturing of this AIs would be almost 1 to 1.5 billion US dollars, and the SRF is actually targeting 35 to 40% of market share in manufacturing these AIs. MK is estimating an ROE to expand to 18.57 by FY27 versus 12.3 versus in FY24. But Prashant, coming to you, how are you seeing this counter SRF? Do you believe what MK says will eventually, pan out for the company?
I think yes, I am also very positive on the specialty chemical. It is about to turn around with respect to all the raw material prices as well as the demand from the China plus one strategy. Obviously, but at this valuation, I may not be very much bullish on the stock at this point of time. I will see some kind of correction in the price because of the broader market sell-off in the Indian markets. Anywhere between 2,500 and 2,400 if the stock comes down by any reason. So that at that point of time, I will be very much bullish because fundamentally it's a very strong company.
Well, another stock that remains in focus is Jubilant FoodWorks, as the company is hosting their first ever physical analyst meet today. What were the key takeaways coming out of the presentation that the company uploaded in the morning on the exchanges? Let's get in Mahima to get in more details on the same.
Jubilant FoodWorks is set to host its first physical analyst meet today, and before that they've released their investor presentation. Now, a couple of guidances that they've given in the presentation. First one, that they've said that they'll open 5 new food platforms this coming year. They've also said that the store count by FY28 will reach 3,000 stores. In terms of the town network, they will reach 700 new town networks, and they're targeting brand power growth in Gen Z segment by around 500 basis points. They aim to double in fact, they've said that their revenue and profits both will grow at a double-digit CAGR, and a 200 basis points margin improvement is something that they're observing. In terms of their overall built-in food platform, around 1,000 crores of annual sales is what they're expecting, and this will happen along with scale-up of their digital platforms. Free cash flow maximization is something that they're expecting overall. Now, all of these things, of course, have been mentioned in their investor presentation, but a couple of things to watch out for will, of course, be questions like the competition coming in from Zomato and Swiggy, how DP Eurasia after the acquisition has performed because Q3 was weak for them, and of course, how and what is their outlook with respect to Popeyes and etc. So, all of these questions will be something to keep an eye out in their overall investor presentation, and of course their meet as well.
Prashant, in the third quarter we did see some kind of a recovery when it comes to the entire QSR space. How are you looking at the QSR segment altogether, and what is your top pick here?
I think with respect to QSR segment, we are very much bullish, not with Jubilant at this valuation, but we are very much aggressive in terms of Zomato. the way they are growing faster. I think the industry is growing almost like 40 to 45% month on month, and lot of positivity in terms of people using Zomato very oftenly, not going to Domino's Pizza or any other places on a regular basis. Zomato would be the only app which can help them to get things ordered to their home. So overall, I'm very much bullish on QSR segment, but Zomato would be my best pick at this point of time.
Okay, so bullish on QSR and Zomato is the best pick. Well, moving on, India's budget airline player flew back to positive territory, earning a profit of 25 crore for this December quarter. Mahima will join in with the key highlights from the earning and more.
So, in terms of the key highlights of the earnings, well, there was an improvement of around 18% in available seat kilometers. The company has turned profitable, but this is because of one-off other income. In terms of the revenue passenger per kilometer rose by around 23% quarter on quarter, and passenger load factor also has risen to 84% from 81% QOQ. Lastly, cost per available seat kilometers also improved QOQ. So, operational metrics in terms of SpiceJet are improving. It came out with both its Q2 as well as Q3 earnings, because Q2 earnings were pending to be reported. In terms of Q2 earnings, revenue was down by 36%. EBITDA lost to 210 crore and net loss stood at around 442 crores. But Q3 revenue was down by about 35%. EBITDA stood at 85 crore, margin stood at 6.9, and net profit at 25 odd crores. And this is of course because of a one-off rise in other income. This other income stood at around 419 crore, and this was this other income came along from restructuring of lease obligations with lessors. Now, in terms of a report on SpiceJet on the back of earnings, INCRED says that it believes that a scale-up of its operations could reduce FY26, reduce in FY26. The company will be able to retain the entire benefits of the reduction in overall cost per available seat kilometer, and they have factored in that SpiceJet's entire fleet will be operational by FY26. In terms of QIP utilizations, overall 3,000 crore was raised, out of which 2,400 has been utilized. Out of which 600 odd crores have been utilized to pay off GST, TDS as well as EPF dues, and around 1,200 odd crores have been used to settle the disputes with aircraft lessors, and the claim was around 1,700 odd crores. Lastly, auditors of course have continued to flag off the going concern which is in danger, but management is of the view that the accounting needs to be done on going concern basis, and it's appropriate accompanying the company statement. So both the views are contradicting, but this has been the case for SpiceJet since last year as well.
Right. Thank you, Mahima, for all the details. Prashant, though, if I talk about the Q3 numbers, though PAT boosted by one-off income, how are you seeing this counter, considering the Q2 and Q3 numbers that it came around?
Sector is growing, but I think SpiceJet is under still a lot of trouble due to his operational capacities, and I think he's not operating the full 100% capacity as of now. I think there are a lot of worst scenarios still to be concerned in the business operations of SpiceJet as well as the industry. In this, I think Indigo would be the best player, but I'm still worried why SpiceJet is trading at these valuations. Obviously, I think a lot of things are going to come out very soon. So there are a lot of negativity about to come in the stock as well as the company. So I think one should avoid this stock at this point of time. Industry is growing because of all the tourism sector being very much aggressively growing, and I think that will help the sector to grow. But Indigo would be the best pick. SpiceJet is still neutral to negative for mine.
Right, got it. Moving on, there was this brokerage note on Alchem Labs by Nomura. Let's see what they are saying. So they have upgraded to buy for this counter, and the target price is at around 5,430 rupees. They say that valuations are attractive after correction of the historical levels that you've seen, and they expect better domestic growth rates in FY26 on a lower base. Better pricing and volume growth is going to help Alchem Labs when it comes to FY26, and the contract related upsides will actually help this company for US based earnings, which is a key highlight of this note. Company's US biologic CDMO facility can present upsides over medium to long term. Now we all know that the CDMO sector as a whole, a lot of pharma companies and even chemical companies are venturing into CDMO aspects, considering the double-digit growth that the segment is expecting. So this is one of the benefits that Alchem Lab will have in medium to long term. But they're lowering FY25 to 27 earnings estimates by 1 to 4% to reflect slower revenue growth and higher costs that the Nomura is expecting. But Prashant, how are you seeing this Alchem Labs considering the corrections that we have seen, over the few months?
The domestic formulation, I think it's the fifth largest company which is operating in India, and a lot of children medicine-based products are being marketed by Alchem. So that is the main important product of Alchem in India. So overall on the valuation side, obviously I'm also very much comfortable at this correction. I think with the price earning ratio of almost forward 20 and price to book value of around below 3. So I think that would be a great opportunity for investors to pitch in this stock for a long-term investment. Overall, the sector looks very much positive, which is focusing more on the domestic formulation business.
On that, any other alternative counters that you have in your mind when it comes to CDMO sector as a whole, because that sector has been buzzing since quite a few quarters?
I think Alchem would be the best in class stock, which we should be focused on CDMO, because they are now entering into the segment, and that is the high growth sector. I think Alchem should be the only best stock one should focus on.
Got it. Well, moving on, we have multiple MOUs and order wins are on our radar. You have Mastic, which receives multiple contracts. Cupid bags almost 42 crore order from Tanzania government. GR Infra enters MOU with Assam government. Rucha joins it with the consolidated list and details.
Okay, Varsha, I'll start with Mastic, as you rightly mentioned, gets multiple contracts from UK Public Services Department. This is spread over a period of 2 years, and the contracts are worth over $85 million. Order book as of the latest quarter stands at about 2,138 crore rupees. Now, this is on the basis of a 12 months backlog, and this was up about 1.5% YOY on a constant currency terms. Moving on to Cupid, well, this one has received a purchase store department order worth about 42 crore rupees. Well, although a small amount over here, this could be executed between May and July 2025. Well, moving on to Railtel Corporation, this one has secured 2 orders from South Central Railway. The first order is of 111 crore approximately to be executed by August 2026. Second order is of 57 crore approximately to be executed by May 2026. The total order book stands at 5,280 crore. Stock is down actually about 3.5% in trade despite of such a good news. GR Infra is another one, enters into an MOU with Government of Assam for the establishment of a ropeway. Now this is set to remain valid for a period of 12 months, and the proposed investment is at around 270 crore rupees. Now this one is for GR Infra, and the stock is largely trading flat in trade. Last one is Tata Power signed agreement with the Assam government for 5,000 megawatts of renewable energy project. This project will involve 30,000 crore investments, and renewable of course includes solar, wind, hydro and energy storage as well. The company's subsidiary will collaborate to increase the rooftop solar adoption, and the project is expected to create about 3,000 jobs for the local youth. Now the stock is down about 3%. So even after good news on all of these stocks are either trading flat or down in trade amidst the bloodbath that is happening since a few sessions.
Right. Thank you, Rucha, for all the details. Well, Prashant, of all the names that Rucha mentioned, any one or couple of counters that interest you?
I think Railtel would be the one stock one should focus more on the order book. The visibility is very strong. I think the way how the railway telecom industry is going. So I think that would be the one stock which I am very much interested, even though the stock is down today. The valuations are almost like 25 forward P and 3 to 4x price to book valuations. So I think very much comfortable to add this stock, but not this level. But again, I would like to wait for more broader selling pressure in the counter. Second would be again Tata Power. Again, I'm waiting for a right level to add on this stock to my clients. But with respect to valuation, again with 25 forward PE, it would be a best-in-class power stock going forward with the summer theme, which is coming very near to us, where we will see a lot of deficit in terms of power demand. So I think Tata Power and Railtel would be 2 stocks among these order books.
Right. Well, another clutch of stocks that we need to keep an eye out for is the stocks that would be impacted on the back of MSCI flows. Now, MSCI announcement regarding the changes had come in long back, but the adjustments or the inflows or outflows regarding the same are expected to happen in the last half an hour of trade tomorrow. Now, the net passive inflow expected to be anywhere between 850 million to $1 billion US in the Indian equity markets in the last half an hour of trade on Friday. Now, which are the stocks that we need to watch out for on the back of these inflows and outflows? On the inflow side, firstly, it's Hyundai, which will be in focus because this stock was added to the MSCI Global Index, and because of this, the inflows are expected to be around around $250 million, which is nearly 11 times its 20-day average volume. Few stocks have seen a higher weightage coming in the MSCI index. Those are IndusInd Bank, which could see an inflow of nearly $258 million, which is nearly 5 times its 20-day average volume. Apart from that, it's Zomato, Varun Beverages, Mankind Pharma, Torrent Pharma, PB Fintech and Torrent Power, which could see inflows of anywhere between $8 to $107 million. So keep an eye out for these stocks. On the negative side, it's Adani Green Energy, which could see an outflow of close to $167 million on the back of deletion from the MSCI index, and that is nearly 4 times its 20-day average volume. Prashant, any coverage of any of these stocks, any stocks that you think is interesting buy at current post the fall that we have seen in the markets? Hyundai, IndusInd Bank, Varun Beverages, Mankind Pharma?
I think Zomato should be focused more. I think that technically as well as positive fundamental impact should see some kind of positive momentum despite the MSCI changes tomorrow. So I think that should be one stock one should focus today ahead of the news.
Well, thank you, Prashant, for answering the questions. And this is all we have on this show. But stay tuned to NDTV Profit.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breathing also. You have to come down. So the correction and healthy correction is a very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers, and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
भाषण सुना उसके बाद मेरा पहला एक्रोनिम निकाला मैंने, वो था RRR, रिस्पॉन्सिव, रिस्पॉन्सिबल, रिफॉर्मिस्ट, और मैंने कहा रिवॉल्यूशनरी। हाउ डिड यू अराइव एट दिस नंबर ऑफ 12 लाख रुपीस?
हमें लगता है टैक्स पेयर उस लेवल नंबर से टैक्स भर रहा है, क्या उनको हम कुछ कर सकते हैं?
प्राइवेट सेक्टर कैपेक्स अभी तक वो इन्वेस्ट क्यों नहीं कर रहे हैं, जबकि आपका इकोनॉमिक सर्वे ही बताता है कि वो कैश पाइल पे बैठे हुए हैं।
अगर कंजम्पशन बढ़ता और उसके तहत लगता है कि ग्रेटर इन्वेस्टमेंट का पॉसिबिलिटी है, वो भी अच्छा ट्रिगर हो सकता है।
एआई बहुत तेज़ी से आ रहा है, तो जॉब के चैलेंजेस होंगे, स्किल के चैलेंज पहले से हैं, तो जो ट्रांजिशन पीरियड का स्ट्रगल है, नौकरी मुझे अभी चाहिए।
पूरे साल का एक्सपोजर दिलाने के लिए हम इंटर्नशिप प्रोग्राम ले आए, और इसके साथ साथ इस बजट में भी ट्रेनिंग फॉर एआई, इसके लिए सेंटर्स बनाए हैं।
Welcome. This is India Market Close. Well, it's turning out to be yet another disappointing session. Maybe not so much for the benchmarks, but certainly for the broader markets. But I'll start with the Nifty 50. It's flat, consolidation continues. There's no real change there. And this is despite the fact that today is the monthly expiry, and we were expecting some traction, but that hasn't come through. You never know, the last 1 hour trade could perhaps change things. There's always a probability of something large happening in the last hour of a monthly expiry. But that said, for as far as the Bank Nifty is concerned, that is advancing by 0.5%, but consolidation continues there as well. What's going to be really interesting to keep an eye on is the options market, but we'll come to that in just a bit. Let's talk about the heat map of the Nifty 50. Let's talk about how things are panning in terms of the big movers, which will include Shriram Transport, Bajaj Finance and Bajaj Finserv, along with IndusInd Bank. So a handful of financials up and about in trade. But what is weighing down on the indices is names like Ultratech Cement, something we're going to talk about in the show as well, along with Trent, M&M and Bajaj Auto. Let's not forget something like a Hero MotoCorp is also under pressure. So clearly the auto sector is what's weighing down on the index. Well, moving on to the advanced decline ratio for the benchmarks. Let's see how things are panning there. Oh, that's a wide gulf. And it's just about less than 4 advances for more than 18 declines. So the market breadth has certainly only worsened from what we saw last Tuesday. And well, moving on to the broader markets, let's see how the mid-cap and the small-cap indices are shaping up. Not very well. 1.5% cut for the mid-cap index, and the small-cap index is also down around 1.8%. And it does seem like this is not an amazing time, a very challenging time indeed for those who are in fact invested in the broader market. Speaking of some of these names in the broader market indices as well, let's pull up the BSE 500, and where we do have advances for Credit Access, that's up around 13%, followed by AU Small, L&T Finance and EIH. All of them advancing by as much as 5%, but what's weighing down the indices is KEI Industries. Polycab is down 17.5%, along with GNFC, Indiabulls Real Estate and Apart, all of them losing around 6.5% to 7%. Well, it's not an encouraging day, and it's very evident in the kind of cues that we're seeing. I reckon that it's going to be about the last 1.5 hour of trade, whether or not we in fact do see volatility induced on account of the monthly expiry. But that's a wait and watch, Neeraj.
Okay, wait and watch indeed. Let's try and understand if our experts are waiting and watching for the time being, or are they initiating trades depending on what they feel is happening in the markets currently. Kush Bora, founder of kushbora.com, with us on the show. Kush, good having you. Thanks for joining in. Good afternoon. How are you approaching trade today, Kush?
Hi, Nilesh. First, very good afternoon. Well, with a bit of caution and skepticism. I mean, the reason I say that is because we've been expecting a short covering bounce for a while now, hasn't really come about. Now, while Nifty is still testing those support levels of 22,500, Bank Nifty is something that's giving us that rebound. So, if any long positions do need to be considered, it should be in Bank Nifty. Again, here too, we are seeing a bit of a falling channel. The resistances might come in, but even they come in at 49,200, 49,500 kind of zones. So if this rally does extend, then that's where you're likely to be rewarded for a long position. As far as Nifty goes, we're seeing quite a bit of massive open interest at the 22,550 and 22,600 call options. So in all likelihood, the expiry could be around or below those levels. Now, if on a closing basis 22,500 is broken, then the lower levels of 22,300, perhaps even 22,000, could come into test. So Nifty is still a wait and watch. The risk-reward ratio on the downside not favorable, and you're not getting that much anticipated rebound. But Bank Nifty on the rebound for levels of 49,200, 49,500 can still be considered on the long side.
All right, and Kush, what stocks are you betting on this afternoon? Towards the short of any of them?
Still going with a mix of a long and a short. It's just that sometimes both of them pay out, if not at least the short ones too. For example, ONGC was a call that we discussed the day before, 4 targets of 231 and 228. Now the stock's approaching that second target. So as I said, given the texture of the market, not a bad idea to remain hedged in a market like this. So for today, we've got a long and a short. Long is on Berkshire Paint. The stock's actually seen quite a bit of rally, from the lower levels of 440, and a rather steady one. relative strength apparent. Now, the stock might find resistance around the 520 mark where the 200-day moving average resides, but with the kind of momentum, and the kind of relative outperformance that you're seeing, the stock is likely to head higher. So 520, 535 are your targets, 490 is the stop loss. On the short side, I've got PEL, Piramal Enterprises. 900 was, a near-term support zone that the stock was resisting for about a month and a half. It's given way. Now, on the downside, you're looking at targets of 890, 880, 915 being your stop loss. So, a long on Berger Paints and a short on Piramal Enterprise.
Long on Berger Paints, that's interesting. The other aspect, Kush, is what to do with, let's say, an Ultratech today. That's amongst the key talking points, and the stock has stayed lower throughout the trading day today.
Well, I wouldn't really venture, a trade into this one just yet. I know for all the news around it, the price action also is not very encouraging. While you could say that, the stock has rebounded from those lows of, 10,000 to the odd. The kind of support zones that were and, that were taken out in today's move, that's a little concerning. 10,500, 10,400, those are the, near-term, that's the near-term support zone. If a closing does come in below that, then I think, the stock could perhaps test levels of 10,000 and below before seeing any kind of a recovery. So I wouldn't really venture a trade into this just yet. Let the stock find its feet, let it settle down and consolidate. Then perhaps it might make for a good trade. At the moment, stay away.
We're getting queries on whether or not Trent should be bought. My question is, should it be short at this point in time?
Not a bad trade. Trent short is not a bad trade right now. The reason being that the 5,000 mark, 49.80 to be precise, was actually the support zone on Trent for a while now, or for the last week or so. That's been broken. There was a positive divergence emerging on the, that's been negated. The trend and the trajectory is down for the moment. And on the downside, any meaningful support actually comes in at 4,700. So there is a room for short trade on Trent. However, I would suggest keeping a tight stop loss, not because of what the stock is doing, largely because of the kind of move that the market has seen, and even the market entirely is due for a bit of a short covering rally. So if that comes about, you might see Trend head for higher levels. But yes, I mean, given the structure, independently speaking, the stock is a good shorting candidate with a stop loss around the 49.80 mark, and the levels being 4,700 on the downside, and once that is taken out, perhaps even 4,500.
Okay, well, the wire and cable company Polycab is certainly shaken up today after Ultratech announced a foray in this sector. In fact, all the companies in that pocket are currently languishing. Puneet joins us to tell us more about Polycab in particular. Puneet.
Well, thanks for that. So definitely, the key trigger is Ultratech's entry into, the cables and wire segment. They will be investing roughly about 1,800 crores over the next 2 years to build up the key factory. For Polycab specifically, it has currently the highest market share in terms of all the other listed players at roughly 15.7% at the end of FY24. It was expected to grow and build on this aspect with capex of over 1,000 crores each over the next 2 years as well, and that could be one which has been impacted because of its highest retail market share and could see a maximum impact as well. It was also one of the most expensive stock in the cables and wires segment, highly regarded by brokerages and mutual fund industries as well. So definitely we're seeing a sharp correction in that aspect as well. Over the last 3 years, revenue has grown at 27% CAGR, and that has been multiplied with the valuation multiples also going over 50 times for the particular company as well. Today, Motilal Oswal has come out, it's cut its target price as well, and valuation multiples now for FY27 price to earnings is cut to 40 times versus 50 times earlier. The price target has also been revised to 6,950 versus over 8,380 rupees earlier. So definitely a stock which might see a lot more pressure once brokerages come out with their key ratings going forward as well. But stock definitely under pressure because of a new big giant entry into the cables and wire segment.
Puneet, well, we do have Rajesh Jain, Chief Financial Officer at RR Cable, who also joins us on the show. It just so happens that with that sharp knock that we're seeing across a lot of these companies, RR Cable's stock price has now also gone below its issue price back when it listed back in 2023. But let's take this up with Mr. Jain. Mr. Jain, with this announcement of Ultratech, which of course is could turn out to be a significant player and a competitor in your markets. How are you reading into this particular situation?
Yeah, thanks, and good afternoon to you and all viewers. It's see when you see this as an announcement and you analyze that with the investment of 1,800 crores, and if we assume that it will take 2.5 years to enter into the market, and it may take another 2 to 3 years to establish in market. And by that time, what we are expecting is that currently the industry size is around 90,000 crores. And even if it grow with, in the range of 13 to 15% year on year, then it may be like 1,050 1,50,000 crores by FY 28 or 29. So in that way, it may not affect that much. And of course, this is like for players like us, it is very good opportunity that when players like Ultratech enters in the market, it is good that the bigger and the good players will remain in the market, and the unorganized market may get impacted by this.
So, Mr. Jain, there is, of course, on the other hand, an argument that the unorganized segment is significantly large, still large for all the players to be and exist and be a part of this, this ecosystem. But the question then is that because of the fact that this area is also extremely competitive, it can in fact impact, well, the ability to price products better. Your view on this one?
There are two parts. When we see unorganized market, you will see that in last 5 to 6 years, the listed or bigger players are growing at much faster pace than what the industry average, and it shows that unorganized market is getting shrink. And at the same time, like even within the listed players or bigger players, also who are the quality advantage or distribution advantage, like we have more than 450,000 registered electricians in our loyalty management program, which is largest in the country. So in that way, it is not like very easy to replicate or to make that kind of distribution and dealer network overlap. So let's see how things move, but it is not that much impact what we see or how the market is reacting.
Good afternoon and thanks so much for joining in today. I just had one follow-up question. I think if you can quantify, currently wires contribute roughly 70% of your revenues, right? So do you see that this segment, when compared to cables, because you need a lot of order execution as well as you need to be eligible for getting into the power transmission cables. So do you see that entry of the new player will more largely be in the wire space and essentially, while lack of a better term, easier to enter into this particular segment? And how are you seeing in terms of pricing? What could this have an impact? Because the listed entity that's entering into the space has a lot of reserves in terms of copper mines as well. So just any kind of outlook that you can quantify on this aspect.
So first, if you see industry as a whole, then almost there 65% is cable and only 35% is wire. Since we started our journey from wire, and that's why still our market share in our share in sales wire is 70%. But going forward, and when we see our expansion plan, and it is very natural that the way we are planning to grow in cable. So in future, we are also focusing more in cable market, and it will increase our it will change our revenue share also. So in that way. And secondly, see, ultimately copper prices are directly linked with international prices, which is directly linked with energy. So it is. I don't think it will give any extra value to them based on their copper manufacturing capabilities.
Mr. Jain, you mentioned that you would be looking to increase your focus on the cables division. I just want to understand, have you already started, while you're already in business in this aspect, how are you seeing the competitive intensity going forward? Do you see that, because for power transmission, do you see that the demand is getting better, and any kind of outlook that you can give on exports as well specifically?
We are the largest exporters in wire and cable industry, like almost our 28 to 30% of revenue in wire and cable is coming through export. And at the same time, in cable also, now we have a very focused approach, and if you see even our expansion plan, like currently we are going through a capex of 500 crores, which was spread in FY 24 and 25, and largely focused on cable only. And even the new capex, what we are targeting from April 25 onwards, which will be again focused largely on cable side of it. And since we have very limited capacity in cable and the market is very big, so naturally, and even if when we break up within wire and cable, then it seems cable is expected to grow at much higher pace than compared to wire. the way India is moving in green energy or power transmission or even export opportunities are and data center. These are the very big opportunities. So cable is expected to grow at higher rates, and we have like complete focus on that area also.
So with a higher focus and higher growth expected for cables, what is the kind of revenue share from cables over the medium term, say FY 27-28 that you are expecting?
So like currently it is 30% is cable and 70% is wire, and it may go up to like say almost 50 or 45 by FY 28.
Would margins also be roughly higher by 150-200 basis points for the cable division? Would that be a safe assessment?
Yes. Since we are rightly we have very smaller volume, so once we get the scale, then we get the benefit of scale also. Like immediate availability of stock is also one of the very important criteria where right now I have some limitations. So this will improve my margins also, availability also, and sales also.
Okay, well, Mr. Jain and Puneet, thank you so much for joining us and, well, giving us that view on what the impact could be on the sector. But on that note, we do in fact have Sandeep Agarwal, fund manager and co-founder at Sectoral Investment Managers, who joins us on the show. Sandeep, good afternoon. Thanks for joining in. What are you making of Ultratech's entry into cables and wires? How do you think that things could pan out here for the entire sector now?
So I think, it is very hard to comment on a specific company because we run a PMS, but let me give you some perspective on the sector. So obviously what we have seen with paint industry also a few months back when, a new entrant came, after that, the multiples have got derated because there is obviously a fear that then when a challenger, the competition comes in, it is in a challenger position and it tries to gain market share through playing on the margins. So that is a risk because of which, there is always a derating when a new competition comes in. And I think with Ultratech's announcement, while practically, things may change on the ground maybe in 2029 or maybe later. But what happens is that this sector's multiple, whatever they were, now people will be wary to give those multiple anytime soon unless the growth numbers go up substantially from what has been forecasted. So if let's say today growth forecast is 20% and it actually turns out to be 25-30%, in that case, the multiples can again recover. But otherwise, a new entrant and a well-funded good name coming in always leads to derating for sure.
Right. Well, moving on. What are you making of BSE at the moment? I guess you can't talk about stocks, Sandeep, so why don't you just give me your view on the capital markets sector in general and whether or not there are opportunities here?
So, we love this space, the financial intermediary, the capital market space, the brokerage space and all these spaces because, see, the penetration of equity in India is still very, very low. And we believe as equities penetration keeps going up with more financial awareness, I think, all these stocks will do well. Now, at a particular point of time, obviously, these stocks do discount a lot of positives which will happen in future. And because of that, sometimes what happens that, the stocks can go through some time correction or some correction at a point of time. But we believe that this whole space, whether it is the depositories, whether it is the exchanges, whether it is the brokerages, whether it is the wealth management business, I think structurally they are going to be very good for next 10-15 years. And that is the way we have positioned ourselves also.
Okay, Sandeep and Kush, stay on. One more stock that could be in focus tomorrow is Jubilant FoodWorks, right? They're hosting their maiden in-person analyst meet today. Mahima joins in with the key takeaways. Mahima.
Jubilant FoodWorks is set to host its first physical analyst meet today, and before that they've released their investor presentation. Now, a couple of guidances that they've given in the presentation. First one, that they've said that they'll open 5 new food platforms this coming year. They've also said that the store count by FY28 will reach 3,000 stores. In terms of the town network, they will reach 700 new town networks, and they're targeting brand power growth in Gen Z segment by around 500 basis points. They aim to double in fact, they've said that their revenue and profits both will grow at a double-digit CAGR, and a 200 basis points margin improvement is something that they're observing. In terms of their overall built-in food platform, around 1,000 crores of annual sales is what they're expecting, and this will happen along with scale-up of their digital platforms. Free cash flow maximization is something that they're expecting overall. Now, all of these things, of course, have been mentioned in their investor presentation, but a couple of things to watch out for will, of course, be questions like the competition coming in from Zomato and Swiggy, how DP Eurasia after the acquisition has performed because Q3 was weak for them, and of course, how and what is their outlook with respect to Popeyes and etc. So, all of these questions will be something to keep an eye out in their overall investor presentation, and of course their meet as well.
Yeah, so the takeaways were from the investor presentation, of course, that Mahima showed you, and analyst meet to happen today. Now, ahead of the meet, a clutch of reports have come in on QSRs as well. Some positive on the space, but not on Jubilant because of the valuation reasons. Sandeep, do you look at the QSR space at all? Have you invested or have you looked at investing?
So we look at this space in a very interesting way, Neeraj. I will tell you how we look. So, we believe that the OTT platforms like Netflix and all are enablers of this kind of businesses because generally you order this kind of food when you are on an OTT platform or you are enjoying some content. And the key risk to this segment or the key draggers to this segment is the whole health awareness things, whether it is, some food advisories, some kind of recommendation, some health experts, and also the way to look at this space is that you will keep on getting growth from the rural side, and you have to reduce the access of growth from the urban side because in urban side there is a lot more awareness against this food because of all the programs which are run by health experts and the social media and all, and at the same time there is an aspiring rural population which keeps on aspiring for more and more of this food. So the growth rate has to be rural minus urban, and that is the way you have to forecast. So if you do that math, then whole this QSR space, if you see, seems to be a little expensive given what kind of growth can happen in next 5-10 years. So that is the only risk. Otherwise, it is a fantastic space to be in.
Well, at least in terms of stocks and the way the price movement has come through, again, more or less falling in line with what the broader markets have done. That's not very encouraging. So you have Devyani International, which saw a little bit of perk up about a few weeks ago, but once again it was sold into, as is the case for Westlife Development, pull up something like a Restaurant Brands Asia, and that exactly hasn't done well. In fact, Restaurant Brand is on a very prominent decline, unlike something like a Devyani International or Westlife. Maybe we can take one of these names and take a technical view as well. Let's take up Devyani International. Kush, if you can, give us some sort of an idea about how to trade this one at this point in time.
Well, among all the names that you mentioned, this is the only one that stands out, technically at least, because it's the only one holding above or just around the 200-day moving average, other than Jubilant FoodWorks, of course. Most of them have been, beaten down and how. So even this, by the way, is just consolidating. It's got a falling trend line resistance. So this space is more of a wait and watch kind of a list. You want to pick the one which has least underperformed. You don't want to be a part of such a list. So I wouldn't really recommend to trade into this. But if you were to pick one, then Devyani International is something that you can consider with the stop loss near the 168 mark. But as I said, all in all, as you rightly pointed out, most of these players have been beaten out of shape. And the ones that are holding ground are just that, they're holding ground. There isn't any particular traction or momentum just yet in some of these names.
Okay, hold that thought. We move on and take a look at the aviation space. We have India's budget airline player who flew back to positive territory in earnings, a profit of around 25 crores for the December quarter. And Mahima is back with us to tell us about the key highlights from the earnings. Mahima, the street is not looking impressed with the earnings. What can you give us in terms of details?
So, in terms of the key highlights of the earnings, well, there was an improvement of around 18% in available seat kilometers. The company has turned profitable, but this is because of one-off other income. In terms of the revenue passenger per kilometer rose by around 23% quarter-on-quarter, and passenger load factor also has risen to 84% from 81% QOQ. Lastly, cost per available seat kilometers also improved QOQ. So, operational metrics in terms of SpiceJet are improving. It came out with both its Q2 as well as Q3 earnings because Q2 earnings were pending to be reported. In terms of Q2 earnings, revenue was down by 36 odd percent. EBITDA lost to 210 crore and net loss stood at around 442 crores. But Q3 revenue was down by about 35 odd percent. EBITDA stood at 85 crore, margin stood at 6.9 and net profit at 25 odd crores. And this is of course because of a one-off rise in other income. This other income stood at around 419 crore and this was this other income came along from restructuring of lease obligations with lessors. Now in terms of a report on SpiceJet on the back of earnings, INCRED says that it believes that a scale up of its operations could reduce FY26 could reduce in FY26. The company will be able to retain the entire benefits of the reduction in overall cost per available seat kilometer, and they have factored in that SpiceJet's entire fleet will be operational by FY26. In terms of QIP utilizations, overall 3,000 crore was raised, out of which 2,400 has been utilized. Out of which 600 odd crores have been utilized to pay off GST, TDS as well as EPF dues, and around 1,200 odd crores have been used to settle the disputes with aircraft lessors, and the claim was around 1,700 odd crores. Lastly, auditors of course have continued to flag off the going concern which is in danger, but management is of the view that the accounting needs to be done on going concern basis and it's appropriate accompanying the company's statement. So both the views are contradicting, but this has been the case for SpiceJet since last year as well.
Interesting. Okay, thanks, Mahima. Well, you know, Kush was on the button this morning wherein he said that he doesn't quite like, this morning or yesterday, he doesn't quite want to go out and look at SpiceJet. Sandeep, last week a clutch of reports came in which said that because of the Kumbh, Interglobe will benefit. What will help Interglobe will probably help SpiceJet as well, right? So is this stock bottoming out, you reckon? I know it's that business which is not high ROC, high quality, etc. right now, but is it attractive from near-term triggers perspective?
So Neeraj, fortunately, I was also I visited Mahakumbh and I was at the airport like 7 hours before the departure back to Ahmedabad. And I spoke to a lot of people there on the airport who are handling the airport. So it was a temporary airport in which approximately around 20 aircrafts of SpiceJet and 20 aircrafts of Indigo lands every day, with a total capacity of 80 aircrafts landing. So I can tell you a little more about that. So, you know, everyone has made a killing in Kumbh. There is no denial about it. And my view is that, you know, can only Indigo carry the number of people the way India is growing? I think that is not possible. Obviously, there is Air India along with Vistara, but I believe that there is space for more airlines. And while, you know, SpiceJet's balance sheet is very, very stretched and it is levered, and this kind of balance sheets are not liked by every investor. So I think from a stock bottoming out or not is very hard to give that call. But I believe that, you know, there is a space for one or two more airlines because the amount of traffic which the country has and the amount of traffic, the way it is growing, there will be, you know, space for more players. And if there is a rational player who can keep control on the cost and efficiency, there is money to be made. Indigo has shown us that, you know, money could be made in this industry.
So are you biting the bullet, let's say, and going out and thinking that it's worth maybe going for a SpiceJet at the current levels?
You know, it is very hard to comment on specific stocks because we run a PMS. But let me tell you, we don't have so much guts actually. We don't take so much risk.
Okay, fair call. Yeah, I'm sorry, Sandeep. I didn't mean to get you a buy, sell, hold call from you, but just trying to understand this. Okay, just before we slip into a break, and you know, we'll speak to Kush about this as well. But an interesting story, which we can name as Mahakumbh impact. The airfares remain high in March, which in an otherwise seasonally weak travel, which is otherwise a seasonally weak travel, right? As airlines leverage pricing power on one key destination, which Sandeep just spoke about, where fares surged beyond 50,000 rupees as well. How do the prices look? Somit joins us to tell us more about the same.
Well, yes, airfares have remained very strong when it comes to the fourth quarter, specifically because of the Mahakumbh event also. But apart from that also, when we check the top 20 routes in India, what we understand is the airfares have continued to remain on the higher side compared to what we had seen last year and also compared to what we had seen pre-Mahakumbh event. Now, we checked the airfares on Feb of 24th and we have done it for two data points, that is the 7-day forward route and the 2-month forward route. Now, for the 7-day forward, if you look at compared to pre-Mahakumbh prices, for 3 routes only we have seen a decline, while the prices for the 3 routes it has declined by around 4 to 16%. For 4 routes that we had seen, the prices have remained unchanged, while for all the remaining routes we have seen prices increase by anywhere between 2 to 46%. Now, this is compared to the pre-Mahakumbh period. Now, if you look at compared to last year, 10 routes have seen a decline of around 4 to 19%, but the remaining 10 routes have seen a hike in prices of anywhere between 5 to 49%. So that's a massive hike coming in the fourth quarter compared to last year. Now, which are the routes which have seen the highest increase? It's Delhi Patna, which has seen an increase of around 49%. Then there is Patna Delhi, 34% increase. Hyderabad Mumbai, Bangalore Mumbai, and Delhi Hyderabad have seen a hike of anywhere between 8 to 22%. On the flip side, routes that have seen the highest decline is Mumbai Kolkata, 19% downtick compared to last year. Pune Delhi, Bangalore Delhi, Delhi Kolkata and Delhi Bangalore routes have seen a decline of anywhere between 9 to 13% compared to last year. Now, if you look at the 2-month forward rate, which is the holiday period or the key earnings period for an airline company, that is the April month. Now, in that, among the top 20 routes, prices for 4 routes have seen a decline of anywhere between 1 to 9%. Apart from that, 6 routes prices have remained unchanged, while the remaining 10 routes have seen an increase of anywhere between 2 to 34%. So, a solid increase that we are seeing compared to the pre-Mahakumbh period. For the 2-month, however, if you look at compared to last year, if you look at, prices of 12 routes have seen a decline of anywhere between 3 to 21%. So this could be a concern coming in, given the fact that this is a strong period for an airline company, and compared to last year, if we're seeing a decline, their earnings could also take a hit. And prices for 8 routes have seen an increase of just 1 to 18%. So routes which have seen the highest increase, firstly, if you look at, it's Patna Delhi, again standing here, 18% increase compared to last year. Hyderabad Delhi, Mumbai Hyderabad, Bangalore Mumbai, Delhi Pune have seen an increase of just 5 to 9%. But on the flip side, the routes which have seen the highest decline, Kolkata Delhi has seen a decline of nearly 21% compared to last year. Then there is Kolkata Mumbai, a decline of around 18%. Delhi Hyderabad, Chennai Delhi and Delhi Kolkata, which are one of the top major routes in India, have seen a decline of anywhere between 14 to 16%. So what we understand out of collecting of this data is that Q4 could be strong for airline companies, but the holiday period of the first quarter of FY26, at least the early trends are suggesting that ticket prices could be weaker compared to last year.
Very warm welcome to you all for this NDTV Profit conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every anlom, you have to have vilom. You can't just keep doing up and up in the breathing also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers, and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
भाषण सुना, उसके बाद मेरा पहला एक्रोनिम निकाला मैंने, वो था RRR, रिस्पॉन्सिव, रिस्पॉन्सिबल, रिफॉर्मिस्ट और मैंने कहा रिवॉल्यूशनरी। हाउ डिड यू अराइव एट दिस नंबर ऑफ 12 लाख रुपीस?
हमें लगता है टैक्स पेयर उस लेवल नंबर से टैक्स भर रहा है, क्या उनको हम कुछ कर सकते हैं?
प्राइवेट सेक्टर कैपेक्स अभी तक वो इन्वेस्ट क्यों नहीं कर रहे हैं, जबकि आपका इकोनॉमिक सर्वे ही बताता है।
This is India Market Close, and it is that time of the show when my colleague Swami Sarkar tells us all about the chatter from the dealing room. Swamit, welcome to the show. Tell us what you're hearing on the street.
Well, firstly, what dealers are indicating is that Coal India is one counter which large HNIs have been accumulating, and dealers are indicating that there is a possibility of a price hike to come in, and that is one of the major reasons why we have seen accumulation from large HNIs on this counter. Second is the housing finance name, LIC Housing Finance and PNB Housing Finance. Both these, if you look at the NBFC pack, have been weak in trade, but what I understand is that there is institutional buying on both these counters at lower levels. Domestic institutions are lapping up this counter, LIC Housing and PNB Housing Finance. Then there are stocks like Varun Beverages and IEX. Both the stocks are under pressure in trade today. But some buy flows are seen in both these counters at lower levels, that is Varun Beverages and IEX. And lastly, it's Aisha. Now, there are large sell flows on the HNI desk when it comes to Aisha. Do remember that after a couple of days, the company will be coming out with the Feb sales number, and what dealers are indicating or their channel checks are indicating is that the numbers for Aisha could be slightly on the weaker side for the month of Feb, and hence there are some sell flows coming in for Aisha Motors as well.
Okay, interesting. Would Feb be weak? And clearly dealers are betting on that for Aisha at least. Let's see if it's the same for some of the others. And today is what, 27. So I think we start getting the numbers on the weekend, over the weekend, and maybe some numbers on Monday. Thanks, Amit. Thanks for that. So some interesting names out there. Keep them in mind. Okay, Kush and Sandeep. And Sandeep, final question to you, and then a question to Kush on some of these names as well. But Sandeep, to you first, and which is some of the two-wheeler names or auto names which will come out with the numbers. Now, do you expect any fireworks, or do you expect it to be a tepid month?
Honestly speaking, the way things are moving and the way there was a liquidity crunch in between, I believe that this month will not be exciting. But let me put it this way, that the relief which has come in income tax, that will definitely have a positive impact going forward. The only challenge we are facing is that this is a sector which has been a blue-eyed sector for everyone for quite a bit of time, and I think the positioning in the sector is very aggressive. So almost everyone is overweight. Almost everyone wants to have these names. So while there is a tailwind because of the tax side and all, there has to be really good numbers or strong numbers to maintain the momentum. That is the way we look at it. So it is in a good run up, good times. So it is continuing within good times. So that is the way I would put. So price to perfection is the risk.
We leave it at that. Thank you so much for joining us and taking us through your views on the markets. Well, since we are talking about two-wheelers, that there are a bunch of things I want to address. Firstly, if you consider two of your largest two-wheeler names, that's Hero MotoCorp and Bajaj Auto, they are actually trading at lows. But that is not the case for something like an Aisha Motor and TVS Motor Company. So if that's just to consider your top four two-wheeler companies. And it does seem like your relatively heavier weighted two-wheeler companies are currently under a lot more pressure as compared to something like an Aisha Motors or, for that matter, TVS Motor Company. The question then, Kush, is for you. Your view on a Hero MotoCorp or a Bajaj Auto. What would you do with these at this point in time?
Agam, if I put these charts next to each other, or in fact, if I overlap chart for these two stock from September, taking out the absolute number, they would seem identical. Not only in terms of the kind of support that they've taken and then broken down, also in terms of the convergence that some of these names are seeing towards their daily averages, and that's on the downside. That's the kind of setup that both of them have. Then luckily for me, my work set out where one view will apply for the second one as well, where both these stocks took support around the key support zones. So for example, for Bajaj Auto, it was 8400. It's broken below that. If I were to talk about Hero MotoCorp, that number comes to 3800. It's broken below that on the back of rising volumes. So for me, I think the pressure on some of these names could continue. And as Swamit was saying, TVS and iShares, these are the two stocks that actually are holding above support zones. But if the numbers weren't to come out great for iShares, the 200-day moving average near the 4880 mark, which it is so dearly trying to hold on to, might give way and the stock would slip to 4700 level. So all in all, pressure on Hero Moto and Bajaj very evident. Any weakness in numbers could perhaps push and continue that weakness and overflow to iShares as well.
Right. Well, on that note, let's get in Aditya Agarwal, Head of Research and Investments at Invest for Edu, who joins us on the show. Good afternoon, Aditya. Let's start with your view on the indices. What are you making of them?
Hi, Agam. Good afternoon. Good afternoon, Neeraj. Thanks so much for the show. Oh, it's a difficult question to answer at the moment. I think if I talk about the headline index, Nifty, that is trying to form a base for sure. 22,500 is somewhere where bulls are trying to support that area and provide some kind of a cushion. From there, Nifty is trying to bounce back. What is interesting is if I flip the charts to a lower time frame, I do see oversold territory and a lot of positive divergences on the Nifty. So I am not too bearish on the Nifty from here on. Maybe a 50-60 point correction or maybe a max 100 point correction cannot be ruled out. But on the upside, I think so Nifty is poised towards a short covering rally in the next expiry and can test easily levels of 23,000 on the upside. And the first indication of that is from the bank Nifty, Agam. If you take a look at the way banks are performing, and it's the private sector banks which are leading the charge in today's trading session, 49,000 on the upside. For the bank Nifty is a crucial level to watch out for. If we trade today during close or maybe tomorrow, bank Nifty manages to take out 49,000, I think so that will lead to a good short covering rally, and Nifty too can scale close at about 23,000. So keep the broader markets aside, the mid cap and the small cap. I think Nifty and bank Nifty should do fairly well in the coming expiry, which is the March month, and should see higher levels from here on, because bulls clearly have their back against the wall. And from here on, I see a short covering rally in both the indices.
That's an understatement, because tomorrow is the last trading day of February. And if we don't see a sharp short covering rally tomorrow, it's going to be the 5th straight month where the Nifty will have ended in the red. And I don't know, it's over 20 years since the last time we saw... 25 years? Yeah, there you have it. 25 years, over 25 years since the last time we saw 5 straight months of this grueling, slow grind, which has been, a part of the market. And I reckon that this may be even more frustrating for a lot of these traders, especially. But, coming back, Aditya, why don't you tell me about some trading ideas as well at this point in time?
So I've got a buy and a sell for our viewers, because clearly market direction is all over the place. But because I feel that there could be a short covering rally, I've got a buy as well. SRF is looking very interesting to me. From the chemicals pack, this is one stock which is standing out, continues to make higher highs, higher lows. So I've got a buy recommendation here for a target of 3,000 on the upside with a stop loss at 27.75 on the downside. LTTS is a sell. Clearly, most of these mid-cap IT stocks are looking weak and can correct further. So I've got a sell recommendation here for a target of 44.50 on the downside with the stop loss at 47.30 on the upside. So this can be sold at current levels.
Okay. Well, let's see if we see that bounce back or no. I think with the current series ending in the red, we are at 5 straight series in the red for sure. Yeah. The 28-year record happening that way. So it's the series, the month. Let's see how good or bad March is. By the way, the top 3 stocks, before we get hopefully a bullish voice on the show, the top 3 stocks for the day, SpiceJet, SRF, Railtel, and while we spoke a bit about SpiceJet, Mahima Johnson with the key details of all of them. Mahima.
Right. So I'll start with SpiceJet. In terms of its Q3 numbers, there was an improvement of around 18% in the available seat kilometers. PAT was boosted by a one-off income, which I'll talk about. The revenue per passenger kilometer rose around 23% QOQ, and passenger load factor also improved from 81% to 84%. This is quarter on quarter. And cost per available seat kilometer also improved QOQ. Now, in terms of the earnings, it came out with both Q2 as well as Q3 earnings, because Q2 earnings were pending. Revenue was down 36%, EBITDA loss of around 210 crores for Q2, net loss stood at around 442 crores. But this changed in Q3, where around the net profit was around 25 crores. This was because of a one-off, other income that stood at around 419 odd crores, and this was this came from restructuring of lease obligations with lessors. In terms of the QIP utilization, they've given up a breakup of 3,000 QIP that they've raised. 2,400 has been utilized, around 600 crore has been utilized for GST, TDS, EPF dues, and 1,200 odd crores has been used to settle disputes with aircraft lessors as well. The next stock on my radar is SRF, where they've maintained buy with a target price of 3,250 and upside of 17.5%. What they're saying is that the worst is behind for all businesses. They expect growth to be driven by stabilization of existing products as well as incremental contribution coming in from new products. They should see a gradual pickup in specialty chemicals and expect firming up of refrigerant gas prices as well as improvement in packaging film businesses. And lastly, MK believes that the company should benefit from agrochemicals cycle turn around and improving refrigerant prices globally overall. And the last one on my list is Railtrail Corp. It has secured two new orders from the South Central Railway. The first order is 1,100 odd crores and to be executed by 16th of August, and the second one is 56 odd crores which is to be executed by May 13th. Both of them are 2026, and the total order book for them as of 31st December stands at 5280 crores, and as of FY24 the total order book was around 4682 crores. So these are the top 3 stocks on my radar today.
Thanks, Mahima. Thanks for that. Now, let's bring in one more guest, and the presentation that they've put out, India Avenue Investment Management, it's a unique way to benefit from the world's leading growth story, which is India. They have a multi-year view on India, and they believe it's a multi-decade growth story. And the managing director, Mugunthan Siva, is with us in the studios to talk about this. Mugunthan, I must say, you are like the odd one out currently because the street is bleeding. Right? It needs to hear a long-term view, and the long-term view is positive. But tell us a bit about this fund, because I presume you have clients across Australia and India and some other regions. And tell us about your optimism around India.
Yeah, so firstly, our client base is essentially Australian and New Zealand. Those are the 2 areas where we raise money. And our view is always long-term. In fact, one of our funds is called India 2030. So the focus is always towards directing investors to looking at increasing their exposure. Most of them don't even have any exposure towards what we say is almost a no-brainer investment towards the India growth story. So my job is to educate clients overseas, like Australia and New Zealand, towards the virtues of investing in India.
Okay. Yeah. So how large are these funds? Because we normally, when we talk about FI investors, right, Europe comes to mind, US definitely out there, some Asia Pacific. Australia, New Zealand is not quite in the thick of things, right? So how large is your fund? How receptive have investors been to India? And especially in the last 4 or 5 months wherein US exceptionalism been out there and India hasn't quite performed.
Yeah, so our funds today are about 850 crores. We're in the early stage really of India acceptance. Typically, Australian investors have got exposure to India through emerging market or Asia funds, not as a direct exposure, but that's starting to change. And I think what we're seeing now is an environment where our clients are actually saying to us, tell me when to add, not I'm worried about this sell-off or, I'm worried about what's happening at the moment. Yeah. It's very much about education that you give them as to, okay, there's always cyclical slowdowns in a structural story.
Right, right. So speaking of when to add, there is a big change happening with respect to interest rate regimes. The way the dollar has seen an impact, potentially will see an impact on account of the new president in the United States. What are the challenges in the near term with respect to fund flows in India that you anticipate at this point in time?
Yeah, so what I've heard in my trip here this time is a lot of focus on US dollar, but actually the Australian dollar has been just as weak as the rupee. So in 8 years of our business, the Australian dollar has hardly moved against the rupee. So it's not so much of a question we face. I think the interest is the diversity that India offers. It's a commodity importer versus Australia being a commodity exporter. The currencies behave very differently. So we actually say it's adding to your diversity to have exposure to an economy like this. And the US exceptionalism really has found its place in the last 5 to 10 years.
Right.
If you go back 20 years, then India stands pretty much head and shoulders above most equity markets.
Right. And areas that you are investing as far as India goes?
So it's a broad-based equity fund, essentially. And areas we've had success in the last 3 or 4 years, definitely in the pharmaceutical space.
Yeah.
Early days post-COVID, we had some overweight exposure to the real estate stocks. And information technology is another place that we're overweight at the moment.
Okay. But then the other question is relative valuations. A lot of conversation always comes about India being expensive, and the bulls say that, in Hindi they say achhi cheez mehengi hoti hai, that India is expensive for a reason.
Yep.
Now my question is, do you believe India at the current juncture also deserves to trade above long-term averages? What is your sense here?
Yeah, look, I do think that when we look at the earnings growth of India, the volatility of India's earnings growth is far lower than a cyclical region like Brazil or South Africa or Korea. So I think when you're in India looking outside, it always looks problematic. But when we look at it from outside, we go, hey, this is a shining light for earnings growth. There's going to be periods of overvaluation.
Yeah.
We've talked about huge inflows from domestic investors, and that's going to create, call it a bubble or excessive valuations from time to time.
Right.
But ideally, over the long term, we feel clients should be adding exposure. Being completely devoid of any India exposure doesn't make sense to us.
Right. And safe to assume that most of your investments will be large market capitalization stocks in Indian companies?
Actually, our universe is the top 800 stocks in India.
Okay.
So we certainly don't want to be an index hugger or, following benchmarks.
Sure.
We look to try and really find, when we explain to our investors, we talk not just about India GDP growth and the large 20 stocks and liquidity. We also talk about how do you really find the growth story, and you have to dig deeper than just looking at the index.
So how have you really found the growth story?
Yeah, look, I think apart from the US, there's no other exception to India. When we talk to clients, they generally say, I agree with what you're saying. I'm a little scared because I don't know so much about the region. So that's the job of education and knowledge that will transfer that fear into this makes sense.
Okay. Okay, I have one more question, if I can, and which is, Mukundan, that in the last 3 years, a lot of newer themes have gotten formed in India. If it used to be a country with maybe 30 sectors, it is now 67 or 68 sectors and counting. The internet theme, suddenly power resurgence, so on and so forth, EMS, and this whole manufacturing, etc. Whether your portfolio advisors or your own research, as the case may be, tell you, where is it that you are the most constructive in amongst the newer sectors that have gotten formed? Because they may not be large, and therefore maybe some of your investors, or for your sake, might not be as liquid, but they are certainly large enough. They may not be in the Nifty, but they're large enough.
Yeah. So again, the point you raised there, we leave that decision making to the advisors in our portfolio. Ideally, we might look at our advisors' portfolio that they run for Indian clients and look at what they're advising us and look at perhaps what the differences might be. But typically with these new age companies, I'll use that term, we know that they're not all going to be successful. So it's a process of identifying which are the ones you want to invest in, because our turnover is generally around 30%. So it's not really set for a momentum or trading style environment. It's more about buy and hold.
Right. And given where Australia and New Zealand are in terms of their own current economic environment, what do you think the scope could be? What kind of funds do you anticipate? And I know I'm not asking you for an exact number. What kind of funds can we, in fact, expect to flow from these nations to Indian markets?
So Australia and New Zealand are only just getting started.
Right.
So there's, I think, if you look at Australia as a country, relative to its population, superannuation enforced savings has made it one of the world's largest pension long-term savings market. And if you think about it, the average Australian has less than 0.5% exposure to India.
Right.
So given that it's 4% of global equity markets, 4% of GDP, that's way underweight. So we're coming at it from that perspective. So I think funds flow of direct money to India funds, when we started 8 years ago, there was about 250 million only in India funds. Today, that's north of 1 billion. And we feel that compounding will really accelerate from here.
So, what's your long-term target in India? Let's say, because you're looking at long-term, right? Do you believe it will be a 10%, 12%, 15% CAGR growth story? Markets, not the GDP.
Yeah, so if you're looking at earnings growth, we think somewhere between 10 and 15% is where we expect. The last 4 years has obviously been a reset from the pandemic, and we think now we're recalibrating to normalize growth.
Okay, fair call. Great. Great, Mukundan, wishing you all the best. Keep on getting the money to India. We welcome it wholeheartedly, I guess. But thank you for lovely talking to you today.
Likewise, thanks very much.
Thank you. That's Mr. Mukundan Siva. And they are long-term bulls on India. In fact, one of their funds is titled India 2030 or something like that. But that shows the extent of the breadth of time that they are keeping in mind when they are looking at funds. We need to slip into a break. Up next, more conversations with our experts. Stay tuned.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
भाषण सुना, उसके बाद मेरा पहला एक्रोनिम निकाला मैंने, वो था RRR, रिस्पॉन्सिबल, रिफॉर्मिस्ट, और मैंने कहा रिवॉल्यूशनरी. हाउ डिड यू अराइव एट दिस नंबर ऑफ 12 लाख रुपीस?
हमें लगता है टैक्स पेयर उस लेवल नंबर से टैक्स भर रहा है, क्या उनको हम कुछ कर सकते हैं?
प्राइवेट सेक्टर कैपेक्स अभी तक वो इन्वेस्ट क्यों नहीं कर रहे हैं, जबकि आपका इकोनॉमिक सर्वे ही बताता है कि वो कैश पाइल पे बैठे हुए हैं.
अगर कंजम्पशन बढ़ता है और उसके तहत लगता है कि ग्रेटर इन्वेस्टमेंट का पॉसिबिलिटी है, वो भी अच्छा ट्रिगर हो सकता है.
AI बहुत तेज़ी से आ रहा है, तो जॉब के चैलेंजेस होंगे, स्किल के चैलेंज पहले से हैं, तो जो ट्रांजिशन पीरियड का स्ट्रगल है, नौकरी मुझे अभी चाहिए.
पूरे साल का एक्सपोजर दिलाने के लिए हम इंटर्नशिप प्रोग्राम ले आए और इसके साथ साथ इस बजट में भी ट्रेनिंग फॉर AI इसके लिए सेंटर्स बनाए हैं.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize.
Welcome back. This is India Market Close. We now have with us Aditya Shah. He's a founder at Hercules Advisors who joins us in the show now. Aditya, good afternoon and thanks for joining in. There's plenty to talk about, and before I get in Ultratech's latest play, I actually do want your view on the auto sector. And we've been talking about and taking technical views on the two-wheeler space particularly, but it does seem like if you could just come in on names like Bajaj Auto and Hero MotoCorp, what would you do with them? And in comparison, something like maybe an Eicher Motors and TVS Motor Company. How are you approaching these names?
Good afternoon, Agam. So for us, we've been very bullish on TVS Motors, and the company has done exceptionally well over the period of last 1.5 to 3 years. The company is gaining market share, the margins are expanding, and the stock has done pretty well from that perspective. So again, the topic within the two-wheeler space will continue to remain TVS Motors. Then Bajaj has also done pretty well with their new Chetak coming up within the EV space, and their export market also is doing pretty well for the company. It's a good dividend, cash-rich company, pays a lot of dividend as well. From that perspective, I am bullish on Bajaj Auto as well. If you look at it, then the third company that I would put in the order is Eicher Motors. Eicher also has done pretty well. However, it has got its own set of unique challenges. So that will remain number 3. And lastly, Hero MotoCorp will be there. A lot of problems ensue Hero MotoCorp. It is losing market share. Their EV scooter in the name of Vida is really very expensive. So that's also a problem. While the stock is really very cheap, but there needs to be a big turnaround in Hero MotoCorp for investors to make huge amount of returns there. So my top pick within the two-wheeler space will continue to remain TVS.
Okay. And Kush Bora, maybe we've spoken about this, maybe we haven't, but I'm just trying to understand. Somit had this view, feedback from dealers that Eicher numbers may not be that great either. Any quick thoughts on two-wheeler stocks?
Most of them are in a bit of a pressure. Eicher is one of those stocks which is holding out, but I wouldn't really buy into it just yet. The 200-day moving average support comes in at 48.80. If there's any kind of a disappointment on the numbers and that gets broken, then you're looking at the stock testing the lower end of the range, which is 4650, 4700 kind of zone. So just a little cautious because it's rather delicately placed on the 200-day moving average.
Fair call. Okay, now let's show you the bull versus bear case for arguably the biggest crack on an index name today, and that is Ultratech. The foray into cables and wires has brought the stock, if not to its knees, then certainly at the lowest point of the day. Mihika Johnson with the bull versus the bear case. Mihika.
Yeah. I'll start with just the basic venture. On the bull side, the company is diversifying from cement to other products, and it aims to enhance and build its presence in the construction value chain. However, as per brokerage estimates, this venture could only have a 4 to 5% incremental EBITDA potential when you look at FY27 estimates for the company. Then it's a limited investment of 1,800 crores versus the company's operating cash of 10,000 crores as of December, which is a good thing for the company. However, analysts are citing concerns on capital misallocation, as this is an unrelated line of business for a company that's always positioned itself as a pure play cement player. Then on, in terms of distribution, well, the B2B side may benefit due to, the company's relations with realty players. However, on the B2C side, there are limited synergies as the influencers are different. For cement, Ultratech has dealt with contractors, but if it were to enter the wires market, it's electricians who are, the main influencers. Then cement demand, which is, expected to be very strong going ahead, stands a good investment, investment trigger for the company. However, the valuations do remain expensive for Ultratech. They're 1 year forward. EV to EBITDA, which is how, we take the multiple across the cement, space, is at a 12% premium to the 5-year average. So there you have it, the bull and bear for Ultratech.
Okay, Mihika, thank you so much for getting us all around Ultratech's latest foray into a new business. Aditya Shah, what are you making of Ultratech's latest development here?
I think disaster is a word that I will use. Okay. For the paints business is still a lot of capex heavy business. On top of it, they are entering into another capex heavy business, which is the wires and cables. For the initial years, they will need to invest in a lot of distribution. And on top of it, they don't even have a resolution for Vodafone Idea. So I don't really understand what is the reason why the company is expanding into different businesses. This is a jacks of all trade and master in none. So in my perspective, the market is right. The market is not really very happy with what Ultratech is really doing. And in my perspective, I would want the company to stay into its own business rather than diversifying into all other types of businesses. What this will definitely do is, as it did with Asian Paints, the crazy valuation at which all those FMEG companies were trading, like KEI Industries or Polycab, those will start to get checked, and the sector devaluation will happen, and valuation will come to the same levels. But I don't think that this is a great move by Ultratech person.
Okay, well, and I think Puneet has done some work on why there are more questions than answers out here. Puneet, now why do you say that?
Specifically, the sales channels, while it's similar in terms of the home building products material specifically, I think for cement as well as in terms of wires and cables, it's quite much different. So because we do see that the key influences for the wire market is generally an electrician or a technician that comes into place, but for cement it's a dedicated cement dealer, and that's one of the key reasons that Ultratech will have to build the sales and the network specifically for this particular business. We also mentioned that the distributor dealer for wires and hardware is generally hardware stores, which is something that's untapped opportunity. While for Ultratech, it could take a significant amount of time to build into this as well. When you look at the market size now, and that's something that a lot of management has spoken about, that it's 80,000 crores in terms of market cap. 25,000 is roughly for the wires segment, where majority of the players like RR Kabil and Polycab are built into roughly 70% of the revenues from. That's a smaller market. Roughly about 55,000 is for the cables market, and we just speak to the management as well that this is the high margin market, and it is possible that Ultratech might start with the wires business and then get into the cables business going forward as well. Revenue potential is also higher in the wires business if it comes in terms of operationalizing it very quickly as well. When you look at for cables specifically, of course it's a tender driven market where the power transmission as well as the electrical, you need to have those kind of tenders and be eligible to apply for these tenders as well. And and that might take roughly 3 to 4 years to build as well in terms of network. It's also a tougher market to crack in terms of when compared to a wire segment specifically. However, the total market size for the building material wire space is around 25,000. And eventually it will be that Ultratech will be applying the cement, the paints also within the same group, as well as now the wire segment. That's something to watch out for. When you look at, the key question that everyone has, why has Ultratech been chosen as the investment vehicle for this kind of venture? And that's something which has been a lot of questions around. While the current paints business of the group has been wired through, Grasim specifically, the other entity, Hindalco, is roughly around $10 to $11 billion in capex. So it would be that current leverage about less than 1 time could be one of the benefits, but the stock getting reacted negatively could be because if it's the most efficient use of capital or no. Currently, Ultratech has roughly 3,000 to 4,000 UBS stores, what they call it, Ultratech Business Solutions, where they have all kinds of materials apart from cement as well. And initially, I think the wire segment could overlap. They currently do sell the wires and cables there, but of course, the other companies that could replace. So some of the demand could come from here itself. But what's also interesting is that Hindalco actually acquired an entity in the CC rod plant, basically from Polycab itself, which is a raw material for the wire segment. Essentially for the copper. So that is another one thing that it's now going to be using that aspect. And finally, the revenue potential according to analysts. Currently, Ambit is building in roughly 5 to 7,000 crores for this business in the next 3 to 5 years. They're also estimating that EBITDA, while the asset turn will be 4 to 5 times, the EBITDA margins could be in the 10 to 12%, which is currently lower than the cement business, but the asset turn and the return of capital will be higher. So that could be something that the management might be targeting. And the other the last bit is for Havel specifically, I think if it eventually enters into the switchgear market as well, that's a key question to watch out for going forward as well.
Thanks for that, Puneet. We've now dissected Ultratech through all angles possible, including technicals and fundamentals. There is a market beyond this big news story, of course, which we've spoken in some detail, but would want to dwell a bit more. This bout of, I wouldn't call it a recovery, but a bout of a pullback in the small cap space. So 1.5% lower. It's no longer 1.89% lower. The Nifty small cap 250, essentially I'm talking about. And that is just inched up a little bit, if that is any solace, but it continues to bleed. In fact, on the flip side, the Nifty bank is off the highs of the day. So bear that in mind. And of course, these 3 names are trading at the lowest point, which is KEI, RR Kabel, Polycab. What is also corrected today are the likes of KEC International and a few others. So that's the other thing to keep in mind. Lloyd's Metal is down about 6%. And that is the other interesting piece because Aditya, one would have thought that metals would do well today considering a lot of metal stocks globally were active yesterday on China's stimulus measures. That hasn't quite happened. Any thoughts on a Vedanta, a Lloyd's, a Tata Steel?
So Neeraj, I will tend to stay away from all the metal banks. There's news that President Trump is going to impose some sort of duty on certain amount of metals such as copper and steel as well. There was news of imposition of certain amount of duty. So all these stocks are not going to react to their fundamentals now. They will now react to what President Trump is going to do. So for the time being, I would avoid the entire metal sector per se for the lookout of global events in terms of US President's tariffs.
Okay, keep that in mind. Actually, Aditya, I don't know if you spoke about this, maybe you did, but I'm tempted to revisit that and ask you because, or maybe during the close of the show, Aditya Shah, I'll ask you about whether you will buy any of the top 3 losers or no. Maybe we'll wait that for the next 10 minutes. But Aditya Agarwala, metal names for a trade?
Definitely, Neeraj. I think some of the metal stocks do look good to me. I have a slightly contra view here, just going purely by the chart setup. A few of the names that do stand out. First is Hindalco, definitely looks interesting to me. And after a good up move, stock saw a bit of a pullback and from there a recovering trade today as well. So somewhere around 620 would be the stop loss. I would prefer going along in Hindalco at current levels for a target of 660 on the upside. The second one could be a Tata Steel. That is also looking fairly good to me. I think a good short covering rally here can play out too for a target of 145. Place a stop loss at 135 on the downside.
Okay, I'm looking at the charts for Bajaj Finance, and am I getting this right? Because it's
52-week high?
Yeah.
Yes,
it's
it
at
is.
a life high.
Yeah.
Right now. Kush, you want to come in on this? Tell me a little more about this.
The sleeping giant, I think, is finally awake. I think it's been a while. It's been years of underperformance. I think it's heard all the stories. It's making a move like ITC. I think now is a good time to start considering, a buy. I know, we're speaking in the trend and after the stock making the 52-week high. But then if you speak about the underperformance that it's had over the last, 4 to 5 years, I think there's a lot of catching up to do. Good momentum, almost a consensus buy at this point in time. So not a bad idea to consider buying into the momentum rather than something that's not working. So relative strength apparent, years, 4 or 5 years of consolidation breakout, not a bad idea to, as I said, go out and buy. Positionally, I would put a stop loss around the 8400 mark. On the upside targets 9,000, 9,300. It's just incidental that this morning we had a call on Bajaj Finserv for targets of 1900 and 1935. So first target's been taken out, approaching the second target. I think this too could very well make a move towards the 2000 mark. So both the Bajaj twins, as I said, the sleeping giants have woken up.
Yeah, sleeping giants have woken up, and it's doing really well for, this one for sure. 2 quarters ago at 6,300, or 3 quarters ago at 6,300, not enough takers, the stock getting slammed down to fresh highs today. It's been quite a turnaround for Bajaj Finance for sure. What else is doing well? I mean, we're talking about stocks which are not doing well, and there are a clutch of names out there. Inox Wind is yet another stock which is cracked really badly today. Is down about 7%, as is, of course, PVR Inox, which is down about 6.5% as well. But there will be stocks which are doing well. So Credit Access Grameen up 13%. Shriram Finance, Chola Fan, all of these NBFCs are doing so well for themselves. I'm trying to understand, Aditya Shah, would you be a buyer into any of these?
Yes, so this RBI circular on decreasing the risk weight is leading to a rally in all of these NBFCs. But I would be a buyer only in Bajaj Finance because that is a company that doesn't have problems with micro lending. All the other companies have severe problems with respect to micro lending. So from that perspective, today is a relief rally. That rally will be short-lived for micro lenders. All other type of lenders will do pretty well. For example, lenders like Chola Finance or lenders like Bajaj Finance. These are the guys that you have to concentrate on. Credit Access Grameen or Bandhan Bank or Ujjivan, all those companies, you need to be very, very careful. The micro lending cycle has not turned, and it will take about 6 to 12 months minimum for that cycle to really turn around. Then only these lenders will start to make money. So right now, cautious on NBFCs, positive on bigger ones like Bajaj and Chola.
Okay, hold that thought. Let's also take a look at brokerages and what brokerages is saying about RBI's move and financials in general. Puneet once again joins us to give more details. Puneet.
Well, thanks for that. So brokerages have come out with what they think of this particular measure and who could be one of the biggest beneficiaries. So let's start out with Macquarie first. Macquarie mentioned that, this is one of the biggest messages in terms of, the regulatory overstate. They mentioned that a more accommodative RBI, which bodes well for all these particular players. Now, they believe that this will be good for the financial sector re-rating going forward. And it's reiterating Macquarie's bullish view on these particular stocks as well. They've also mentioned that unsecured loan growth has come down from roughly 25% to 10% in the period my colleague Subhana just mentioned. So the unsecured growth has also come down as well in this particular time weight. They believe in due course RBI is also likely to reduce the risk weight assets on these particular loans as well, and banks should see a 20 to roughly 250 basis points positive impact on the CET1 ratio as well. They see IndusInd Bank and Bandhan Bank as one of the biggest beneficiary of this particular move, so watch out for these stocks in trade today. The second brokerage is CLSA. Now, they mentioned that, after a lot of regulatory tightening over the last couple of years, this is one of the biggest positive moves for the particular sector. They see that clearly good things are happening for the banking sector in a much meaningful way, which should contribute in the numbers as well. And they estimate that Bandhan Bank will be one of the biggest beneficiaries based on, the MFI risk asset being recalibrated as well. And finally, on Morgan Stanley, on this particular topic as well, they mentioned that, they are expecting the CET ratio, which, Macquarie is also estimating by 20 to 50 basis points. For Morgan Stanley is roughly between 10 and 80 basis points, and the positive impacts for banks that they cover in their coverage. And they see that the mid-sized private banks should get higher benefit of this. So overall, it's a big positive move, as my colleague Subhana also highlighted, and some of the key stocks to watch out for, of course, with the higher MFI focus, as well as NBFCs in this particular time frame as well.
Okay. Well, and these stocks have certainly done well. So aside of Bajaj Finance, Aditya Agarwala, and before we take in your top closing strategy, is there a trade in any of them? Credit Access Grameen, L&T Finance, what have you? Home First, a lot of them have gone up.
I would like to avoid Credit Access Grameen as of now, because today is the first day of the move and it's extremely volatile. I would like to stick to Bajaj Twins for the time being. And apart from that, if one stock which I can look at is L&T Finance on the upside, I think so 150, 155 is something that can be seen on the stock. Apart from this L&T Finance, I think it's only the Bajaj Twins which definitely stand out for me as well. And I think so one should focus on those two stocks rather than venturing out for some high beta names like Credit Access.
Well, it's nearly 3:20, so I reckon we can take BTST or STBT calls from our experts. Kush, back to you on this one.
I'll go with BTST this time around. Chambal Fertilizers, very strong moves, not only today, but for the last month and a half. Even today, if you see the stocks actually gaining ground, near-term resistances, being taken out. In fact, the stocks moved up percent, and then some more over the last 15-20 odd minutes. The first target looks almost done. So still for the targets of 580 and 595, the stock looks good. Stop loss comes in at 590. Someone could also consider this as a positional trade, but again, holds good for BTST as well as a positional trade. Chambal Fertilizers, 580, 595 targets, 550 stop loss.
Just important to address what's flashing for you on your screen there. Indian officials exploring ways to curtail at least some import duties there, and this is of course in the wake of tariff wars, and with President Trump suggesting that there will be some import duties, or rather duties which will be levied on all the goods that are being exported from India to the United States. And I reckon that government at the moment is mulling some tariff cuts so as to bring some sort of equilibrium and perhaps a freer and more flowing trade relations between the two nations. We'll of course continue to have more updates on that one as well. But in the meantime, Aditya Agarwala, coming back to you on your BTST, STBT ideas.
So I like United Spirits, Agam. I think it's found a good base, taking support at the lower end of a rising wedge pattern. At current levels, there will be a buyer in the stock. Look for a target of 1450 to about 1500 on the upside, with a stop loss at 1300 on the downside. So risk to reward is also in favor of going long at current levels. So this is one candidate which stands strong and can be looked at for a BTST trade.
Okay. Now the key question is that the top losers today, is this a good opportunity to buy them, or would you want to wait? So the top three names which have lost today, right? RR Kabel, KEI, Polycab, they're trading at the lowest point of the day. RR Kabel is now 20%, KEI above 20%, Polycab 19%. Aditya Shah, to you first. Maybe you mentioned this already, but I want to come to you. Why is not buying these names a good idea?
I think Zomato should also be worried because maybe Ultratech is going to start 10-minute cement delivery. From that extent, there is going to be a sectoral derating that is going to happen within the cable space. We've seen a sectoral derating happening in the paint space as well, where Asian Paints is now trading at a 5-year low, and it has given up all the gains it made over the last 5 years.
Aditya, allow me to counter you just a moment. In the case of Asian Paints, the gross block amount was much higher that Ultratech was investing, and not as fragmented an industry, part two, and it is coming into being right here in 2025. In this case, it will take them to set up the capacity at least 2 years and then some more years for qualification as per the management who came today. So it's maybe 2-3 years out. Why punish them today so much?
Because market is forward-looking. Market is not.
3 years. You're fine with that?
Yes, market will not wait for the next 2 years. The risk of Ultratech coming and disrupting the entire sector is huge. Today, KEI, Havels, as well as Polycab have invested nearly about 5,000 crores in capex for the next 2 to 3 years. All of those capacities will start to come online. And at that point itself, Ultratech will also come and try to undercut all of these players. So what is going to happen is the competitive intensity is going to rise. Because the competitive intensity is going to rise, if market was giving these players 60, 70, 80 times multiple, now it will start to give 20, 30 times multiple and wait to see who is the ultimate winner into all of this competitive intensity rising. So my perspective clearly is, today we don't know how Ultratech is going to behave over the next 2 to 3 years. We don't know how the competitive intensity will shape out. If these stocks derate further and come to a decent type of valuation of about 20, 25 times, then it is a buying opportunity per se. It is very, very hard for you to buy at about 40 times multiple with the risk of competitive intensity coming about, and then you finding that there's multiple derating also in the future. So my perspective is pretty clear. Stay away from this entire sector for the time being. Of course, Polycab and KEI will say that they will not have any problem. It is their job to say that. However, as an analyst, we will be very, very careful on all of these companies. We will wait to see how Ultratech really shapes out in the ground, and then take a call. So buy none of these. Wait for the sectoral derating to get completed over a period of next 6 to 12 months, and then take a call.
There is actually yet another Aditya Birla Group entity, which is in the unlisted space, which is looking to take on another industry mammoth. And in this case, I'm talking about Indriya, that's Novel Jewels. They have, of course, recently launched their own business as well. They're looking to take on Tanishq, and that's going to be another interesting space to watch. It's wait and watch because this one is not associated to any listed company. It's a company by itself. And the question really is that at some point in time, once it does start seeing, sales, will we see an IPO there as well? But since we are talking about the jewelry sector in general, Aditya Shah, your view on how things could pan out for this particular sector as well, especially when you've had so much volatility in names like Kalyan Jewellers?
So that is one of the spaces where even if Aditya Birla's entity come in, Titan will not get affected. By a simple reason. The quality and the products that Titan supplies to customers, I don't think any of the other companies really do come even close to Titan, and it will take many years for a company like for Aditya Birla's company to build that trust and build that purity of their products with respect to Titan. So my perspective is the volatility that is being induced in the cable space, that kind of volatility will not get induced in Titan. However, Titan stock is itself very, very expensive. There could be a derating on the Titan stock, but not from a competitive intensity perspective, anything will happen. When you talk about other players like Kalyan, Senco, or Sky Gold, those players will have a real challenge when Aditya Birla comes in, because that is where the real competition would lie. And Aditya Birla will try to undercut all of these players. Also not particularly perturbed with Titan per se, but concerned for a lot of other players like Kalyan, Senco, PNG Guardian, and all of
those. Okay, Aditya Shah, thanks so much for that. Since Titan is one of the few names in the green today, Kush Bora, I'm tempted to ask you, would you buy a Titan?
For a time horizon beyond 6 months, not a bad idea. The stock is at the medium term or rather a long term support zone, 3,100. So as long as that is held, this might just turn out to be a good range play. So as I said, 6 months and beyond, if that's the view, not a bad idea to start accumulating Titan at these levels. In fact, that's holding true for a lot of other names as well. But Titan, yes, support zone 3,100 on the upside. You can look at targets of 3,330, and once that is taken off, 3,400 as well. So is shaping up well.
Okay, Aditya Agarwala, Kush Bora, and Aditya Shah. Thank you all for joining us and taking us through your views on the markets. And of course, it's turned out to be a very, very quiet expiry yet again. And it's actually was a little bit of a surprise because I was expecting a little bit of volatility towards the end of the trading session, but that didn't come through. We did have some fund buying. The end of the month fund buying that did come through. The volumes were evident, but that really didn't move the indices at all. In fact, the Nifty is once again closing, well, marginally in the red, and we haven't seen any traction in the Bank Nifty either. So it does seem like it's yet another listless expiry, and this time it's not a listless weekly expiry, it's a very, very quiet monthly expiry. That said, let's pull up the heat map now and see how things are faring there in terms of its constituents. So firstly, the market breadth on the Nifty 50 is not great. We do have gains in Sri Ram Finance, Bajaj Finserv and Bajaj Finance, of course. Bajaj Finance particularly making a life high right now, along with Hindalco also moving up. And Ultratech Cement, on the other hand, declining in trade under pressure, along with Trent, Bajaj Auto and M&M with Tata Motors. So the auto sector is essentially weighing down on the indices. Let's move on and talk about some of the other factors here as well, with respect to the advanced decline ratio. Okay, so we'll talk about this too. In terms of those which are losing out, we've seen the India Volatility Index decline, surprisingly. This is on a day of expiry. The realty index and along with the auto sector is under pressure, and what's advancing is the Nifty Metal Index. Well, this is largely, on account of Hindalco. Of course, the underlying has not moved as much, but it is showing a little bit of impact there. As far as your advanced decline ratio is concerned, that does seem to be a little bit of a concern here. So now we have less than 4 advances for well over 19 declines on the NSE. And when it comes to the broader market indices, the mid-cap and the small-cap indices have been clear underperformers in today's day of trade. The mid-cap index down 1.5%. The small-cap index is down 1.9%. And finally, to talk about the constituents of the BSE 500, well, we do have Credit Access, Vinity Organics, and AU Small Finance, along with Just Dial advancing. And on the losing end, well, some of your cable and wiring companies down, along with GNFC, Jindal, and Indiabulls Real Estate. And on that note, we are completely out of time on this edition of India Market Close, but don't go anywhere, lots more lined up. You're watching NDTV Profit.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers, and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
भाषण सुना, उसके बाद मेरा पहला एक्रोनिम निकाला मैंने, वो था RRR, रिस्पॉन्सिबल, रिफॉर्मिस्ट, और मैंने कहा रिवॉल्यूशनरी। हाउ डिड यू अराइव एट दिस नंबर ऑफ 12 लाख रुपीस?
हमें लगता है टैक्स पेयर उस लेवल नंबर से टैक्स भर रहा है, क्या उनको हम कुछ कर सकते हैं?
प्राइवेट सेक्टर कैपेक्स अब
welcome. You're watching Market Express and I'm your host Himakshi Bahuguna. Now let's get straight into the show. US benchmarks end flat with a negative bias. The Nifty ends above 22,500 mark, whereas the Sensex ends above the 74,500 levels. Broader markets underperform benchmarks, decline by over 1% each. Now, most sectoral indices decline. All sectors, barring banks and metals, end with losses. Media falls the most, followed by realty, PSU banks, and auto and consumer durables. Shares of Credit Access Grameen gain as much as 12%, while those of Bandhan Bank are trading with gains of nearly 8%. Post the recent RBI announcement of risk weightage, the Reserve Bank of India on February 25th announced that the risk weights for banks lending to NBFCs has been restored to 100% from 125% earlier from April 1, 2025. Finance Minister Nirmala Sitharaman, speaking at BS Manthan event, says that global trade needs to be completely reset. Tackling questions on economic policy and growth drivers, she says that every country wants to be treated special and that we need to rethink on most favored nation and bilateral arrangements. CLSA comes out with a note on the Reserve Bank reducing risk weight on microfinance and bank loans to NBFCs. Says good things are happening for the banking sector. Says the biggest beneficiary of the MFI risk weight reduction is Bandhan Bank. Jubilant FoodWorks gain after the company displays strong pickup in the Q3 growth. The brand's same store sales growth has hit double digits. Jubilant's delivery segment grew ahead of food delivery platforms at 30%. Jeffrey says that despite the industry's urban slowdown, quick service restaurants are seeing noticeable pickup. Turbulent skies for SpiceJet. The stock trades with cuts despite improvement of 18% in available seat kilometers. One-off income in third quarter boosts the profitability. The revenue passenger kilometer rises 23% quarter on quarter. Despite this, brokerage firm Nuvama isn't impressed. It slashed its target price for SpiceJet by 14% to 52 rupees while keeping a hold rating. Titagarh Rail loses over 4% today after brokerage firm Morgan Stanley maintains overweight on the company. The brokerage and analyst firm gives a target of 1,090 rupees. The company is a beneficiary of robust rail capex, but so far remains subdued. Titagarh's inadequate wheel sets from Indian Railways constrain Q3 offtake. MK maintains a buy on SRF with a target price of 3,250 rupees. The brokerage believes the worst is behind and that stabilization of the key products will bring in growth. Plus, incremental contribution from newer products should add to the overall pickup in specialty chemicals. Leading cement player Ultratech ceases to just be a cement player. Yes, the company plans to enter into wires and cables segment with an investment plan of 1,800 crore rupees. The plants will be set up in Bharuch, Gujarat. The company aims to materialize the plans from December 2026. Ultratech chairman Kumar Mangalam Birla says that the venture aims to expand Ultratech's presence in the construction value chain. All cables and wire stock decline on the back of this news. Motilal Oswal has cut valuation multipliers for the cables and wires under coverage on the back of Ultratech's entry in the segment. The brokerage and analyst firm has trimmed valuations for Polycab India, Key Industries, RR Cable by 20%. Additionally, Motilal Oswal downgrades rating on Key Industries, RR Cable to neutral from buy and maintains buy on Polycab India, neutral on